Good morning. It is March 29th. We're going to be streaming options, stocks, futures. Looking at some technical analysis. See what comes our way and trade away. Sub up, like up, comment down. Happy Money sticks around. If you haven't yet, you can follow us on Twitter at HappyMoneyYT, and we have a Discord server. Link for both of those are in the description. I'll pin the Discord in the chat. And I'm gonna get this shared on Twitter, the stream. You should do the same. Here we go. Okay, shared it on Twitter and Discord. Thanks guys, thanks for the support. Big gap up on the SPY pre-market. I don't see any necessarily news causing it. We're kind of saying we're still looking bullish. And here we are, gapping up almost to 400. So this is kind of the top of the range. Definitely a level here to break 400. It's kind of my first point of contention. We do break here. Let's see. Yeah, if we break 400, the next resistances are 405, I guess, 406. There's that little gap up there at 406, so maybe we can fill that gap. Brokerage is set up here. Yeah, nat gas is going down more. So it's going to get to probably one of its historic lows. Let's see. Birds continue to rally. SPY hit pre-market high again, up 1%. Wow. A few gap ups here to 20 bucks. Morning tree, good morning rally. GME is up 0.5%. BBY is getting a little pump here, pre-market. 2%. SI 1.85. Help is with the pre-market move. Did the birds investors move over to Help is? Oh, that earnings. SPY up 1.05% pre-market. Wow. Lululemon up 15%. They also had earnings. BRDS has yet to break out of this area up here. Saudi's making it super cheap. I don't think a whole lot comes out of Saudi Arabia, does it? They price capped it in Europe. They basically fixed the natural gas price. So that's part of the problem. Doing pretty good with BBY. Nice. 79 is a very cheap price for sure. So it does. It seems like consolidation before potential move up, but could be consolidation before move down. Not sure your trading plan, but yeah, this is the first time we've seen it for a while that it's traded flat for this long though. So, and it's kind of above that 75-cent mark, which was always kind of a cutoff. So yeah, it's looking good. As long as we can hold this low, we're good. And then we're just looking to break the 88, 89 range and start filling gaps. I think we'll get back up to $1 probably same day we break, or maybe we get a gap up and then island bottom. We gap down here, trading flat, gap up, kind of like it did back here. This little island bottom. So that would be neat. It's very likely actually that's how it'll play out because it will probably be from news in the after hours. So that would give us our gap. That gas falls to the lowest level since September 2020. Google has formed a partnership to combine its artificial intelligence language models with software from startup Replit that helps computer programmers write code. Fit to compete with a similar product from Microsoft. Blink Charging awarded electric vehicle purchasing contract by U.S. General Services Administration. Credit Suisse whistleblowers say it has been helping wealthy Americans avoid paying U.S. taxes. Defers the word. Defer taxes. Forward index. Does it make a good argument? He didn't make up much of an argument, did he? It was short interest is increasing and insiders are buying. Let's rally. Morning Ace, morning Blue Owl. Okay, about 5 minutes to go here. This rally on birds is very sustained though, which is good. Not just a 1 or 2 day pump so far, or 1 day pump I guess. Solid volume too, but I think a lot of this is just contributed to ZipTrader. Definitely yesterday. This could have been from the insider buying. Yeah, insider buying is a good argument. That is true. Zip, I think he's got like 500,000. He's moved stocks before for sure. Yeah, that's very common for him. So guys like that have to be really careful though. He usually doesn't mention low float stocks for that reason. And Birds actually isn't that low of a float. 196 million. So it's small, but it's not like crazy. But just because it's a penny stock, I think too, it's going to be more volatile and cause more action from him mentioning it. However, usually those are short-lived when it's a YouTube pump. Like same day. But since this is holding up and seems like it wants to keep climbing, might have some merit for sustained rally. We're bumping the Yaz this morning. What is it, 1 o'clock Eastern? GME is going to release another NFT. Bed Bath & Beyond up to... I still have Hellbait shares. Get some levels drawn here on the SPY. Now that I have some purchasing power, I can trade futures again. So next level up, not just at 400, which we're basically right at. Yeah, it's got some room to go to the upside if it keeps going. 1 point, whoa, moving even more, 1.09, 0.10. Ooze. Okay, I'm gonna shut that off for a bit. Okay. Birds is up 17%. There's the bell. Lululemon's up 14. Helba's up 16. They also had earnings. CPSH. GME's coming down. SPY big red candle. FRC down 2. SI up almost 2%. Finger motion up 4.5. Help us end birds now. So sometimes when we get a gap up on birds, my contracts fill, but didn't get that this morning. So no one was waiting to buy. I think GameStop bought back shares. I think they have to submit a filing for that, but I'm not sure. Yeah, I mean, I saw that on the 10K. Weren't people saying that they'd already done that, like back in January? Morning, Mahmoud. Humbuckle up this time. Yep, you can relax. Put your tray tables down. Put your seat back. Hey, Jan. Hey, Indy. Bet me that red spy today. Okay. Morning, Dennis. Too late to enter bird. Depends on your plan with it. You're gonna hold it for 5 minutes, 5 days, 5 months. This has been cursed with this back curse, so it's really not had any sort of stability. Little relief rallies every now and then, but I've been a shareholder for years since back here, and I actually closed, I don't know, a few weeks ago, so close to where the price is now. I like the company. Their earnings were pretty good. Insiders are buying. So yeah, for a trade, I mean it's gapped up quite a bit, but could keep going. Sure. It's hard because the chart on being a penny stock, it's just so kind of it's not a great read. We had a nice rally up here. We're kind of getting that here, but so far all the candles are pretty much red. Got a nice MACD crossover. The volume, of course, is crazy, which is good. But so far it's been basically selling volume. All the buying's been pre-market, seems like. So nice to see a green candle on the day. Elbiz is its competitor. It's also up 15%. But that's because they had earnings. Phase is up 8%. Mara's up 7. Riot's up 7. SI sitting on a red candle. SI still up 2.5. I think I like. I don't know. I think I like Silvergate potentially more. I think the run might take longer. Birds, I don't know how sustained the run will be. That's the thing. Go finger. Are you still? Did you get back in finger? I thought you sold it. I'm just trading options on birds, which is kind of weird because it's super illiquid. Evatol up 8.8. I like Evatol maybe better also because it hasn't had a crazy move yet. I mean, yesterday's move was pretty crazy, but it sold off from there. So I haven't looked at IPOs in a bit. There are quite a few though available on Webull. Evatol up 8%. Okay. I was gonna average into this one. Yeah, we'll pick up some more eVTOL shares. Birds hanging out at the highs. Okay, got more eVTOL shares. It's early, so it might be a bad buy. Usually buying in the morning is pretty risky. GME's red candle, but basically flat. Break even right now. Bed Bath also break even. Birds sitting there at 20%. Who's asking about Mullen? Mullen's having a little bounce here, but it's in an awful downtrend still. Oh, eVTOL, there you go. Was that from my order? eVTOL 11%. SI 5%. Okay. This consolidation appears tremendous. Super League's up 8%. The crypto stocks are rallying. Morning, Gene. Oh, you sold G&E. Well done. Birds 18%, Helbus 13%. Seems like sometimes when there's too many pre-market runners, it's hard to get one that really goes crazy because day traders kind of have to, they spread out their capital more or less. They kind of start consolidating on one that will kind of shine, but I kind of noticed that before. So eVTOL 9%, Silvergate 7%. Whoa, Silvergate's moving pretty good. So I'll probably sell some more covered calls here on Silvergate. And do weeklies, but what, it's Wednesday. Yeah, DRS does show dedication, I guess. Not sure if institutions are looking for that from retail necessarily, but positive news. I don't know. I think they need to see earnings. They typically don't invest too much just on news. You'll get pops, but it's not like long-term funds. SPY kind of hanging out up here. Birds holding up really well. Top 10 individual accounts had 10 billion, 13 billion. Taxpayers bill out the rest. Well, if there was 20 billion bailout, taxpayers paid for all of them. America paid for all of them. Working people. Birds coming down a little bit. Today's a beautiful day. Lululemon gapped up on good earnings. Elbit's kind of giving it back some. SPY looks like it wants to break. Oh, it actually hit 400 in pre-market. BBBY up 1.3. SI holding up pretty well, 6.5. Always has been. Yep. eVTOL 9.9. So if you look when eVTOL runs, it's usually with a volume candle. The last big runs we had You know, this one started with a lot more volume than we had, but let's see for these days. Yeah, this one just came out of nowhere. This one, here's your first big day. Started trend up, and then the first big day with 4 million volume kind of signified a run. This is what Dom was looking at, the volume on it. But then you'll get these kind of random spikes with pretty good volume, but don't amount to anything. We actually played this one. But now this looks like more of a trend on the upside. And then yesterday's volume was very good, 3.3 million. So I haven't seen a trend like this really until like back here, since back here. Because even here, like, it didn't really look the same. That is neat. GME doing stuff. Yeah, it is 1.6%. Okay. I actually have some options to buy and sell in here probably. Nice little consolidation channel still going on with GME. 24, probably be a pretty good break on it. AMC kind of popping a little bit too. BBBY. Oh, without extended hours, it looks so bullish. And then you just see this extended hour barcoding. Data, not really that I saw, not necessarily. Oh, I think there were some CPI numbers or something overseas. I didn't see it tweeted about. But maybe that was bullish. Maybe the CPI is coming down. Yeah, I didn't see anything. Market's just ready to rally, man. Yeah, I mean, it was futures. It was just gapped up, so didn't come out from beta. The chart's still bullish, and we just hit that 400, so this is the first kind of make it or break it. The rallies past here, we're probably on our way back up to this gap fill. 406, 407 area. Evital 12.3%. I didn't get enough shares of that actually. Shoot. Might pick up some more. And I'm out of buying power. Birds 18. Elbiz. Uber never made a profit. I'm not sure if they've never made one or not. Spies back up at the highs here. Evital 12.3. There's DoorDash. We saw high volatility. Starts just before dawn. SI up 5. GME's ripping a little bit. I'm putting 2406, that area. So we're getting a move up on SPY. GME's following suit, but maybe with some more strength. AMC moving up a little bit. But yeah, GME is the leader out of those. General Motors is also up to 2.25. Buy, new high on the day. I don't want to go long. I don't even really know where next big level is on the SPY. I mean, it's here. $402. And there's your red candle on GME. We'll stop looking at her now. BBY up 2%. SPY rejecting that breakout. Evatol 11.18. SLGG 7. SI also reversed. Broke down 3 VWAPs up 2.25 now. I'll put up a queue for some cover calls. Okay. Probably need to roll these BBBY cash secured puts on a bounce. Bird's still holding up. Helbiz 14%. Evatol 11. Well done, Blue. Sorry, you want a GME resistance? Yeah, totally, like 24-ish. 24 would be the next level up I see on there. At the top of this range, this channel we built. After that, I'd say that the highs from that rally from earnings 26, 27 area. Then you're looking at 30, 35, 40. Birds has gone up quite a bit in the last few days, yes. Being such a cheap price though, it doesn't seem like much. Because it's in the pennies, but it actually, yes, it's large. So it's up 112% from 7 trading days ago. But it's not crazy. I mean, it did that same thing back here with, I don't think there was any catalyst for this. SPY new high there. That had a 115% rally, and I don't think there's any news. So this has some catalyst behind it. Insiders buying, zip trader pumping. It's reflecting the volume. So hopefully we get a bigger run on it this time. There's 400 on SPY. There it is. Okay, it might go breakout long. Let's see. A little scared. It's so early still. And the market's already up over 1%. Get some Yaz going. A little Yaz. A little Yazzy. Oh. Seems loud. Hold on. You guys can't hear it because it's too loud. You're lucky. Just sheltered your ears. Genesis halted? Oh, interesting. Good call, Ben. SPY's ripping up there. This looks like it's halted on news. So I actually just sold, unfortunately. This might be good news. Yeah, suspended, technically not halted. No idea what that is. If I can find something. No, not seeing anything. Not seeing any reason why it's halted. Or suspended, yeah, it's just no one knows yet. Very interesting though. BNS holders, you might be pretty stoked when it resumes. Bird's kind of giving it up some. Evatol 11, 8%. BBBY 1.7. Give me 1.3. SI moving up more here. SI holding up 4%. I'm impressed with how strong SI has held up. For a bankrupt bank, it's doing great. Looks like it wants to break out, but it's scared. Already up so much. It's a big level at 400. I mean, that's a huge move. GNS, I mean, Helbiz isn't up because of that. Helbiz is up because of their earnings. Helbiz has had a pump though when they said they were going to fight illegal naked shorting. I think that's what this one was from. So it's not the same though. GNS is like kind of the forefront of it. Helbiz more or less might just be kind of chasing the coattails and just doing it to pump the stock price and not actually going after their stock price manipulation. Next out, my name changes. Beyblade. Let it rip. 408. Yeah, 408's pretty far up there. That's true. That's true, Al. You've just been. I think it's gonna come down, down, down. I think it will. I think TA looks like it's still bullish though. For now. Just been kind of chopping around here, but also grinding up still. Yeah, could fill that gap 407 area. All the pre-market runners are kind of just holding up where they were. I guess Riot's been rallying since open. It's up 11. Mara also. Evatol has some. SI gave it back some. Only up 2% now. So BY's volume's pretty low. Yeah, it's about like yesterday. Look at that pump. I should have rolled there. I gotta remember to do stuff when we're getting action. Got positions to move around. Oh, do those fill? No. Spy just waking up here. Thanks for your likes, guys. I appreciate it. About 30 minutes in, you guys have gotten 17 of them out already. That's awesome. Right there. 25, here we come. Maybe it's a good short. That's a pretty big wick there on SPY. Inverted hammer. Not breaking that 400. Oh wait. That Bath holding 1.3%. EVTL 10.5. Birds and Help is kind of just trading together now. 16% on both of them. For Mullen to kind of reverse this trend, it would need probably a couple days, unless today's just huge on it. Coin's up 7%. Probably a nice short here, actually. That double top. Got red under the 9, bearish MACD. Might jump in some, might get a little coin to the downside. Hardly any buying power. Buying power in the trading account. Keeps sweeping over margin for the futures. GME gave it back quite a bit, up 0.78%. Bed Bath holding on. Elvis still 16. Birds came down a bit. It's at 10% now. Maybe some of these calls will get sold. Europe's stocks, STOXX 600 hits over 2-week high, up 1.3%. So maybe this is partially just from EU. We're rallying. See what happens at 11:30 when they close. Total 8%. SI still holding 2.3. That's true. BY is above support at 80 cent. Whoa, SPY popping up there. Data do we have today? Pending US home sales and then Fed bar both at 10 o'clock. Yeah, so far we've not been able to hold over that 80 cents though. This was the only day. Just been resistant, so yeah, that would be a nice little hold. Keep an eye on GNS. Let me know when it gets resumed. Oh, it's resumed. 14% on GNS. Settles litigation with Alto Opportunity Master Fund. Is that the news? The Entrepreneur EdTech. Is this what the news was? Company has opted to make the remainder of monthly payments it owes on the 18 million convertible note in cash over time to ensure no further dilution of shares. That's definitely bullish. As such, company will be subject to any future installment related accelerations at a variable price from the note, unless consented to by the company. So, paying off debt. Without dilution. The parties have canceled convertible notes conversion relating to 36 million of 49 million shares, included with the complaint. The parties will release the remaining 6.5 million of the note currently held in the deposit of the company. Seems pretty bullish. This is maybe what it was halted for. Whoa! 27%. How's it not halted again? Why is it not halted again? Did you see that rip? That's definitely a limit halt right there. Volatility halt. Glad I closed out of this one. It's way too volatile. Holy moly. GNS is ripping. Bought in. Did you sell it or did you just average in? I thought you already had it. Up 35%. I don't know why it's not halted. That doesn't make any sense. It's subjective. But if anything, I would think they would want to halt this one. Got a level there. What is that? 2.6 area. It's bouncing off this nice support level that did actually break, which is why I closed. Without that news, wasn't looking good. Good volume there, 1.7 million. That's a long article. I don't quite fully understand what happened, but looks to be bullish. Maybe Hellbase will get a little sympathy rally. Oh, Hellbase is actually selling off. SPY's moving up here. New high on the day there for SPY. Broke pre-market high. You do need to activate margin. It saved you though, because you probably got a bad fill. Oh. Yeah, maybe it just filled. Nat gas is having a little rally. Buys up 1.16. Take the long. Birds 11. That candle on GNS was crazy. I don't know how they let it keep trading. So many arcs being broken. Evatol looks like it wants to break 12.35%. Curious what happens back up here again, if it gets shut down or. Albiz moving down, filling the gap. Bird still holding up nice. Oh, SI gave it back. SI's down 2% now. Like to see this get moved. I mean, that level, but really higher than that would be. They want to break below this 170. And I might actually add to it, honestly, if it does start bouncing off this level down here. No, GNS could definitely have a continuation from this. I mean, it was literally right at that level too, like where it'd been holding support. Yesterday it just dropped below it, but could have been just a little false breakout. Now with this news. Buy, setting up an engulfing candle. If that finishes, I'm gonna go short. Much rather go short at 400 after it's gone up over 1% than chase the long. Don't have to do anything, but short seems like a better setup. Trailing stop loss. Look at you with all the technical stuff. Birds and Hellbiz down now. Bear trappy. Yeah, might be bear trappy. Oh, you sold both of them. GME and GNS. Did you accidentally sell GNS trying to sell GME?
Critical piece of the story. When you start talking about RH, you had mentioned before the break how the company's leadership had waved kind of an ominous flag in the early parts and middle parts of last year in one of their earnings releases, talking about some of the concerns they had.
All right, let's say it's giving us engulfing candle.
Talking about this particular space in home
improvement. Slowly scale into these.
That saw tremendous demand throughout the pandemic period, and it's not necessarily items that you're getting on a regular basis. So you update a room in your home, maybe that room will stay that way for a little bit of time. So they saw tremendous pull forward demand during that time frame, and we're watching that work its way through the home improvement sector, but so many other sectors as well. We've seen this in semiconductors. We've seen this in even places like Target that has struggled with inventory levels. And so essentially we saw tremendous demand and very limited production.
Scaling a little faster.
So supply was really low relative to demand. We then saw tremendous increases in supply as production came back online and things opened back up. But then the demand was gone. And so all of this takes some time to work its way out and normalize. As you can see some of those numbers up there for the estimates. It looks like we're expecting an EPS of $3.35 on revenue of just over $750 million. But this is a you know, super high-end retailer when it comes to home improvement. So
I accidentally went short on that gas. It's automatically doing it because that's the chart I'm looking at.
So we obviously have seen
Really
a
aggravating.
lot of struggles in companies like Wayfair. They're targeting completely different markets, Oliver. So if you're looking for one possible bright spot, is that the consumer that shops at a place like RH, it's a high-end consumer, typically a little bit more resilient, less you know, fluctuation with economic cycles because they're just
that gas is actually
so
bouncing.
affluent. You're talking about, you know, $12,000-$15,000 couches.
That's just
things
silly
upwards,
market
of
spy.
those kind of prices. So if you're in the market for that, probably a little bit more resilient to economic conditions.
What about us peons who just like to go and walk around the store, drink a glass of wine,
Peons.
and sit in the couches? They got the restaurant. I mean, that's part of the business here, right? I mean, they get a little bit from that, the experience of just going there.
Yeah, no doubt. I mean, that's obviously one of the selling points of this company is that they try to encourage and talk about that, how it is an experience. It's not just, you know,
GNS
a
up
place that
16,
you get your new
giving up some of
furniture
its
at,
rally.
but, that's a small part. Ultimately, they provide those type of services to get you in the door, so that
Total's still
ultimately you're
holding up
buying
11%.
the things that they're selling
Birds bouncing on
that
this
carry that
level
high
we have
price
drawn.
tag. When we're talking about this
2075.
particular company, though, Oliver, the company's just been so forthcoming during their press conferences with how they've said it. They haven't hid when they've seen things that are a little bit more ominous. They've been willing to say that. So that's one of the more fascinating things about this particular company. It's such on the tail end of earnings and sort of exists in a vacuum on its own. It does get a fair amount of coverage. It can have you know,
Bath is
market
holding up
impact
nice
as
over that
well, depending
80
on what the
cents.
message is. So the first thing that I'm going to be focused on
Silvergate
is,
with the
you know, what is
bounce
that
there.
message from the leadership, and are we seeing
Thank
some
you,
of those
Ace
concerns
Ventura.
that we saw
Appreciate your
developing
gifted
last year
sub,
start to
gifted
work
membership.
their way through and start to
Rally.
normalize here as that
Ben,
bullwhip effect works its way
You
through
guys are
different market
targeted.
sectors.
That's a targeted attack with a free
The,
membership.
slide in the last couple of weeks has
Accept
been
it
pretty
willingly
dramatic.
and
It's brought
gratefully.
along some price target cuts with it as analysts have reduced their
Click on the box.
expectations. I do
Receive
wonder
gift.
if that kind of lowers the
Don't.
bar maybe
Some
a
lurker
bit.
that's just listening's gonna come and
52-week
snatch it.
lows. To your point, the management's been pretty
Spy's coming
forthcoming
down a little
about
bit.
the weakness. I do wonder if there's surprising resilience in the consumer and housing, if maybe they've lowballed a little bit, and if it's time to start thinking about the bar being too low. Because if the bar's not
There you
low
go,
and
Rally.
not
Well
too
done.
low, then I mean,
done, sir.
they
If
could
you're on
be
our
breaking
Discord,
down
DM
to
me, I'll
new
give you the
lows,
happy crew
because there's
roll in
not
there
a
as
lot
well.
more room for them on the chart to go down.
I think this is an interesting point, and actually reminds me of something we talked about in the last week in a totally different company in a totally different fashion, and that was Wingstop. And with the analysts sort of shifting that there really wasn't
Ben.
much room for surprise
Settle down. You were
at
too
this point
slow.
to the upside, and that, you know, generally favors
People
you know,
want
risk
one of
reward
us.
to be lopsided to the downside. Maybe the exact
Thanks, Ace.
opposite's
Appreciate it, man.
developing in RH. Maybe you're at a
I'm moving
situation
down.
where because the stock's been beaten down so much and it's back near those
You
lows,
couldn't help yourself.
because
Couldn't help
the
yourself.
messaging has been
Thank
so
you, Ace.
negative
Ego
that
on
maybe
you.
just something slightly less negative can be perceived as
Another
a positive.
gifted membership.
Not sure if we're there yet. Again, we're talking
Another
about
gray
a product
turns
that's
green.
extremely expensive and isn't necessarily carrying
Much appreciated, man.
an upgrade cycle that is very short. So this could be one of those bullwhip effects that takes, you know, several years to
He's
work its way through, as
colorblind,
opposed
so
to
the
just
gray
6-7
for some reason
months.
really messes with
And
his
I think that's
brain
going to
and
be
he
a
hates it.
critical piece here.
Kinda makes him
But
short
certainly
circuit
no
a
doubt
little
about
bit.
it. The stock's
The ego
absolutely
on
not
you.
anywhere near highs. So I think the
All right,
logic's
Spy's
sound.
moving
It's
down
just
a
a
little
matter of
bit.
what we actually hear from the company.
Okay, thanks. Good
I got
stuff.
4 of the
Of course,
micro
as
ESs.
we got some trading to do.
Suppose I
in
could
the
add to 'em if we
stock.
start
Alex
to
Coffey,
break
host of
this
Next Gen
low,
Investing, Joe Teagay
which
standing
actually we
by.
kind of did
Portfolio
almost.
manager of the
new
Rational
low?
Equity Armor Fund. Home builder stocks doing great. Housing stuff looks real
Glad
solid.
I
but
actually
RH
scaled
down
in
near
pretty
the
quick
lows.
up here,
Joe, what
'cause-
kind of opportunity does that give us?
Yeah, sometimes it does this, sometimes it chops and even rallies before it actually makes its move.
I think there potentially is more downside to come. I don't like
But
the
who
next
knows
few
how long this will
quarters. I
last.
think,
It's still early.
I've still been
I still
saying
chop
this.
it
I think
around.
the home builders are ahead of themselves right now. They got sold
being
out
that it's up
really hard
1%,
last year. This
there's a
quarter
gap.
has been fantastic for them. And I think maybe in the broader picture, like,
I like
today's been a nice rally. This quarter in general has been good for all equities. Maybe it's just a little bit of a dead cat bounce. Maybe this week is a little bit of window dressing into the end of the quarter. and I'm still worried about the economy. Now, we saw the first shoe to drop, of
Birds,
course,
pretty
with
good
regional
bounce
banks.
there.
And then what will be the next
2075,
shoe?
there you
Maybe
go.
we'll get this regional bank things behind us. It looks promising.
So funny talking about birds so
But when the
much.
economy slows down with interest rates higher,
Like it's
things
actually
start to
one that's
break.
being
We
traded
don't
and
really
looked
know
at.
what else
How
might
strange.
break, and so I'm worried about the rest of the year, certainly.
Well,
and
you
certainly,
like GNS for like
this is
the
a
longer
stock
term,
that
right?
will
So
not do well if the economy slows down.
Okay. So the window dressing potential in a housing stock, I like that, Joe. Let's talk
Longer,
about
like,
how to fade
swing
it
trade.
here. I mean, look, looking for more downside.
gas
It could be a
up
real breakdown in this
1%.
company. So can you go
I
pretty far on
mean,
the money
I
and bet
wanted
for
the
like
money right
a
now,
drop? 'Cause
but
it seems like if it's going to drop, making new lows, I think it could really get smashed.
Yeah, you certainly could.
Keep it
I'm just
tall,
looking more
holding
closer
8.
to the at the money. I'm looking at 240, 225 put spread. The lows are all the way down at 207. So this is a spread I can put on for 515. I can triple my money in a month. I think that is a good risk reward for me to the downside. Again, it is kind of
This guy called
pricey.
from the
It's at
bathroom?
$5, so I like having my risk defined, of course. Shorting this name
They
here
put a
because
stop
we are
loss
at the
on
low
this.
end of the range. There certainly is potential pop
Oh,
to the
no.
upside, so
Just
don't want to get
on
out there
from
just
his
short the stock. I know my risk
chair.
here with buying
His
the put spread.
computer
Selling
pooper
the
chair.
225 put, of course, makes this whole trade a lot cheaper. Instead of $10 plus trade, it's a $5 trade. So picking a level 225, just happy.
So it is kind of
to
interesting
get
that
in and out
SPY
there,
actually
get a
bounced
3-to-1
on.
payout for a month.
Okay. So buying the put
Oh,
spread.
no, that is a new low
You've
there.
got your risk defined,
Okay.
but certainly looking for a slide here. And expiration, you're looking pretty short term here, Joe?
Yeah, just looking for April, the next month. I do think we'll get a lot of earnings momentum out of this next
That
month.
gas
and
is
I
moving
think,
up a bit.
There's lots more that could happen in just a month. I'm looking very short term.
I need more monitors. That's my
a little
problem.
cheaper, of course, to do that. The other thing, of course,
This guy's got like
looking
6
at the
monitors, but these are
implied
tiny.
volatility, typically on an earnings
Like a
event,
tablet.
this stock moves an average of 12%. Right now, a one-day move is implied at 8%. So
You're moving up a bit.
volatility when it's a little bit cheaper than it historically is. Of course, we also have the VIX under 20. That's another thing.
I haven't
that
put
I
a
like to
stop
look
loss on
at.
it yet.
When the VIX is cheaper, it's also good to buy equity volatility. So I'm looking to buy volatility when it's cheap and sell it when it's high.
Okay, understood. Buying some
Get
downside,
a laser
looking
projector.
for RH to take a hit. Simple enough, easy to follow. Thanks, Joe.
Thanks for having me.
Mr. T. Gabe, portfolio manager of the Rational Equity Armor Fund. All right,
Sure,
that's
it's
a
holding
lot
up
of
well.
earnings
There's
chat
GWAP.
on what's ahead.
SPY
and a lot of
rallying up here
housing
pretty
talk
good.
This morning. Let's take a look at a company
Another
that's been a
engulfing
big
candle to the
winner,
upside
not
would be
just
interesting.
this year, but over the last 3 years. A little bit of a pullback from the COVID highs in the logistics business Descartes, but an 8-month rally now gets us pretty close to those highs, and it's a pretty great looking 3-year pattern on the technicals. We've got the CEO joining us to discuss, dare I say, the philosophy of the supply chain.
Philosophy. This guy. Analysts expect U.S. home prices to decline by minus 4.5% this year and to fall 10% from their peak overall. That'd be crazy if that's all they fell. After 100% plus moves, only fall 10%. All right, nat gas is moving up. They waited long enough for us to sell. Given it did gap down, but I don't like it. Birds. Almost 20%. GNS 14. We should trade oil. Things had a crazy rally lately. Doesn't look like it's over. Oh, yes, home pending sales came out. That's right, 10 o'clock we got that data. So pending home sales was plus 0.8% in February. Home sales index was plus 0.8%. U.S. pending home sales for February was minus 21.1%. Index was up 0.8 and the sales were down. Confusing. Lenders advanced a record 862 billion to commercial real estate last year, a 15% increase from year prior. GME 1.5. Considering I'll keep my calls. Just in case this afternoon gets kind of cheeky on it. UNES giving up quite a bit of the rips, up 10% still. LBIZ holding around 10%. SI down 2.5. $10K did come out yesterday after hours. Not really anything necessarily significant about it. They kind of reworded their DRS numbers. There's lots of speculation, of course, as to why they did that. Now they're just saying how many are held by Seed & Co. and not giving specific numbers like they have been. So maybe they got in trouble with SAC for promoting specifically computer share or direct registering, so they had to be more generic. Of course, there's speculation on Superstock, all sorts of stuff that I don't think is very plausible. Birds back up to 2340, very strong. Evitol, let's go, buddy. Come on. Little bull flag here on the 5-minute. Looking good. Yeah, you go take a look. It's like 93 pages. I don't know why it was late. Maybe it was the auditing thing they were talking about. Took more time to audit it since it was a profitable quarter and it beat by so much, and NFT sales and et cetera, that kind of thing. Yeah. Buy moving down. G America announcement. It could be some kind of integration into Fortnite or some game. I wouldn't be too surprised on that, or just a new NFT. I guess best case would be some sort of integration to AAA game or something that would show a lot of value for it.
On the retailers,
that said, I don't think even if that is the announcement that it'll move the stock price.
That forced them to make big investments in the supply chain.
Maybe in the long term it will, but
the big benefit for us and all of that has been that when companies go to make
GME's holding up all right, 1.7. Doesn't really have support as SPY now. SPY's flushing down there.
Quick return on investment.
Kind of a little head and shoulders even here on the 5-minute.
Tailwind for us, and it
starting to fill that gap. I only got 4 micros.
Been around for some time, and it looks like it's
just
been
fine.
as far back as I can track the earnings.
I like that I got them at basically 400 on SPY, so if we don't break that, that's
the need for
potentially the top.
Product affected your own workforce. Have you expanded? Are you hiring?
I like
What's
when
the
I
growth
shorted
look like
418.
We've been hiring aggressively
14,
throughout the
460.
pandemic.
460?
Maybe now as the economy's
That's
starting to
418.
potentially slow down, we've maybe slowed down hiring a little bit, but still compared to most technology companies, we're still hiring. And
Spy's still up almost 1%. Had a big gap up.
We need more and more every day.
Being in the category as a software company in a tech business, I'm glad you bring that up, because as investors and traders, we oftentimes kind of think about
Doesn't
things in
have to fill the
groups, and
gap.
The group of technology companies.
I actually did see a DD
has
on that.
generally been
Jeez, that
struggling
gas is
the
going
past
still.
year and a half. Your stock
I couldn't
took a
hold those
bit of a
contracts
hit
because
off
they
the
expired
highs last
anyways,
year.
but
It's recovered pretty quickly. Trading now at $79.
I think it was like
compared to the
97% of the
high.
time on GME in the last
Where is
two.
the
I
potential
don't know what the data said. I think it was the last few
economic
years, but
slowdown
maybe it was
showing
all
up?
time.
Do you see any
Super high
type
percentage.
of
It fills the
pullback
gaps
in
to
your
the downside.
clientele? Do you
And then it was like
see
less than
pricing
half as it
issues
filled to
from
the
inflation
upside.
story? Because you're
So,
uniquely outperforming your sector right now.
See if I can find that maybe.
I think we hear from our customers about the slowdown. But
I think it
continue to
definitely
invest
could come
more
down
and more
here.
money in
Still,
supply chain and logistics. They may be
it's
slowing
possible it
down
rallies up to
projects,
35 or 40 before then, though.
But they seem to be
A
greenlighting
move down here
all
would
of ours.
probably be with a
we're
big market
about
downturn,
90% recurring
which I
revenue,
think we're still due. So
we have a lot of forward
market
predictability
crash
about
or
what's
just
gonna happen in the business, and
another
our
leg
customers
down
are
on
with
this
us,
bear
and
market
we
we've been
always
in,
like to say
something like
customers for
this
life
or this.
here at Descartes. And they keep processing transactions and buying more subscriptions, and that's been.
It's looking less and less like a bear market, though.
And it continues to this
Now
day.
we've had just
We'll have to see what happens in the
since
in the coming
October, we've
months
just
or years,
basically
but,
been
so
trending
far,
up.
So good.
What do you see in the e-commerce build out? That was a real integral part of the COVID dynamic. It's a huge sector for investors. And sometimes, when we talk with the actual e-commerce companies, it's always pretty rose-colored glasses. I'm curious from your perspective, is it growing at the same pace? I mean, eventually,
EBITDA
I would think the
11.5.
rails get built out
Elpis
fully to
bounced
some
back up
extent.
to WAP.
Where are we on that process?
Yeah, so in the beginning of the pandemic, when people were locked in their house buying products, our e-commerce business, which is a little
still
over
kind of coming
10%
back
of
down
our
from
business,
that
by the
rally.
way, our e-commerce business was
SI
booming
is selling
along with
off
every
now.
other e-commerce business.
4.5 dropped below the $2
40%
level.
growth. Prior to the pandemic, it was mid-teens grower.
Like to
and I
see
think we're
one of
seeing
these
that
supports
now,
from this bull flag
as well.
hold. Last one
come
being
out of, the last
like
couple of years
168.
and back to mid-teens growth, which is phenomenal for us. I mean, we love that business. We've made heavy investments in it in the past 10 years, and I think you'll continue to see us do that as the world continues to buy more and more product online.
The acquisitions that you've made, is that something you plan to continue to do? Are you mostly looking for smaller kind of pseudo competitors in a way?
I've been buying shares of you at all.
Sense for you to build out, or
I haven't messed with the options on it.
The product.
I just have a real small position so far.
Both. We're usually buying 3 to 6
some
companies
yesterday.
a year. We've done that.
Bought some more
for the
today.
last 20 years.
I like that it's
both buying up
trending up.
competitors.
We haven't seen this on the stock since really back here.
We're buying our next door
These have just been pumps without a real trend reversal. And it's supported with all this volume too, so I think we could get a big move. Might get something like this.
Add that to our network to make it more convenient for our customers to execute
makes me want to get options.
on our network.
Okay. The potential
had a
for
pretty
any
big move,
geopolitical
actually.
flare-ups, Ed, I'm sure it's something that you watch.
36%.
Given the potential for that to cause complications in the supply chain, is there anything that's particularly on your radar
Elbis
right
moving
now
up
as
through
kind of a
BWAP.
wild card in that regard?
Well, I mean, you read the newspaper, you hear about the conflict in Ukraine and potential for conflict over in the Asia-Pacific region. For us, that translates into more demand
nice for one day.
our customs and
BY was nice yesterday, sort of.
our tariff
That
and duty
pump
business
with
and our sanctioned party
AMC.
business. One of the
We had a pretty big
outcomes of
move
a lot
there.
of these conflicts is that
I
people raise
forgot to
tariffs or
roll
change
stuff
tariffs,
during that move.
for various
6%
countries around the
bottom
world.
to top.
People add parties to the sanctioned party list.
There is a flush on
People you're not allowed to
BBBY.
ship to. We
Still
sell
green,
our
but
customers
broke
those
below through
databases,
BWAP.
and the more
77,
the more
78
changes occur
range
to
has
those
still been our
databases every day, the
support.
more the demand there is for our products. So we're
Wanna
always
see that
watching out
hold.
for it. We're
kind of
usually
at the top of this range,
beneficiary of it in a somewhat odd way, and
No.
it's
Didn't
been
really make
going
the top of
that
the range
business,
yet, which
like
I'd
our
say is
e-commerce
like
business has been
84.
growing very rapidly over the past 4 or 5 years, as there's been a lot of this, nationalistic tendencies and geopolitical conflicts around the world. So we'll see what happens in the future. I don't pretend to know what the next conflict's going to be, but when they do, we'll database the information and make it available to our customers.
Okay. Ed, thanks a lot for the explanation here, and we'll certainly be keeping closer tabs on the company. Appreciate the explanation.
Thanks, Oliver.
Sure thing. Ed Ryan, CEO at Descartes DSGX, up more than 40% off the lows and at 52-week highs. Chartmaster coming up. We got a few analyst notes we're going to take a look at Intuit as we continue a little bit of a software discussion around tax season, but also Hershey as a consumer staple winner that continues to make new highs every week. Stock's amazing right now. And Deere.
What are these shares you speak of? Bird's holding up. Alba's still up above VWAP. BuzzFeed's kind of climbing up here, up 6%. That ain't bad.
Those results with an air of caution, saying they believe the next 20% accounting market share is still tied up in spreadsheets, and that plus the 50% consideration for some of these adjacent products in the payroll is well above the current levels of 20%.
I've got options on Birds.
Accounting and
I sold my shares
receiving number 1 and
months
number
ago.
2 rankings as the most insulated in terms of a downturn. So pretty optimistic. I'd say they do voice an air of caution, and also part of this key bank note today, they did raise their price target on Microsoft, which has also been a pretty resilient performer in the tech space, Oliver. But Intuit, I mean, I would say that things look positive on a year-to-date basis. They're up about 10%, but the 12-month chart, as I'm sure Rick will tell us, looks a whole lot different than the recent strength we've seen.
Okay, so 475 pretty good little price target here. I mean, it's Intuit, so like the bull case is a little bit boring. We're talking like spreadsheets and stuff, but okay, that's fine. There's money to be made. There's money to be made. Pretty bullish note. Yeah, it's an interesting chart, Rick. I mean, it seems like we're kind of trying to pick up the pace a little bit. 475 would certainly demand a pretty major breakout, it seems like.
A breakout from two
all the way back
separate
down, pretty
areas,
much.
I would say here, because on one hand, we have a longer term, almost taking up the entire past year, symmetrical triangle. We've got a trend line sloping down across the highs, a white trend line sloping up across the lows.
I mean, once it starts
but
going,
more recently, it's looking like a range to me here between
it's
about
seeming more that way. Yeah, it's
372
not
to the
going to
downside, this green
not going to
dash
climb up.
line,
It's just going
and
to rip
about 434
from news. So
to
it'll
the
probably be
upside,
after
this red
hours.
dash line. So we're kind of between these two
But
lines.
I could also see it
Interestingly
starting to
enough,
climb
those
from
line
technical
up
levels and just
almost
momentum.
exactly with the value area here, the area where 70% of the
I think it could
trades
go
have
either
taken
way.
place according to our volume profile study. So it's showing that this
And
is really the area to watch for a breakout.
if not before
from
news,
this range
it is
bound
in some
price
sort of
action here.
cyclical
So,
pattern.
looking at
So,
our moving averages, our two shorter term moving
I think we
averages are
still could
trending
get
up.
this
Our long term 252-day
after,
exponential moving average is
enough time. I think
sideways.
it's
So
like
in the shorter term, it looks like the
June
trend
maybe,
could be improving
or the
here.
next
But
pinch
RSI,
would line up.
not really showing us too much out of the ordinary here, kind of just following along with the price action. Bullish tilt to momentum, but no real surprises here. Really, the thing we've got to watch for would be a break above this level where we've had price stop out multiple times here.
Okay, well, like that.
And more
You'll have to talk to your
recently, once
internet
again,
service
there,
provider for
a
that
break
one.
above that level, that would be putting this target, this trend line in sight then. To the downside, the 252-day EMA near 424 will be an important level to hold heading into the close. We touched it today and we bounced off of it, so that's the point to watch for today.
Okay.
Up almost
I always like when
20%
there's like
still.
a clear level that's important, and you get kind of like these orphans, you know,
SI
they go
down
up here and then
4.3.
it comes right back down, which kind of seems to confirm that this is an important area.
Should have got more
The stock
covered
can't
calls,
leave it
man.
for
That
too
one day I
long.
just got a
We're
few.
basically there right now.
Scaled in way too
Shares,
slow.
I don't know, up 2% in an up market after a bullish note, a solid move.
Buy
It does
moving
seem like
down
it's
here,
gonna
filling
take
the gap.
something, dramatic to get us out of this high volume area between you know, $400 and 430. So pretty interesting chart.
GME down.
Symmetrical triangle.
Yeah, exactly. Kind of converging toward each other, suggesting
Birds moving-
you know,
moving up
some
here.
energy once we do get a breakout.
Broke
All right.
that little
you can kind of
resistance.
see this continuing to condense right into the volume range. Maybe we get to a point there around like 415. One to keep an eye on. Doesn't necessarily require a big move ASAP, but kind of running out of time the next couple months to pick a direction if the triangle keeps getting smaller. All right, still more positive tone out. Let's talk Deere, shifting over a little bit more industrial and analysts beginning coverage in the stock. Kind of positive, Jenny?
It is kind of positive, and I would say that was my read here because we did get a note out of Daiwa that did maintain or start actually coverage with an outperform rating and a $440 price target, which does imply about $40 of upside. So that is clearly optimistic. Although they do see a potential downside to $350
Birds moving
for the
up
stock.
24%.
In the event of a hard
Wow.
landing, they said the analysts find Deere uniquely positioned to benefit from this
I'm like not really
digitization
benefiting
of
from this because
agriculture.
the
But
options are
350
so
whole lot
illiquid.
different than 440, Oliver, which is why
Until they fill.
you know, have some caution here
Needed to move up
regarding
like
this note.
crazy
They did
to
add
get
that
these
Deere's
options probably.
precision technology stack, as well as their connectivity and
just
operations
random-
center infrastructure, are difficult
random
to
buyers, I
replicate.
don't know.
Being that Deere is now a key enabler
so
of
far out of the
making
money.
agriculture operations more efficient. I also find this name really interesting because it's actually the worst performing of this group on a year-to-date basis. It's down about 7% on the year, and that based on current crop prices, farmers are actually expected to have their third consecutive year of really strong income, which would then in turn benefit Deere. And Deere oftentimes seen as a, you know, a broader read of the
People
economy.
inflow.
It does ebb and flow with a lot of the GDP that we see because they do really correlate highly with
EBTL.
crop prices. So interesting that we've seen this underperformance
think it's
from Deere
gonna
this
break
year.
out to the upside here
Analyst
any-
does see
any
some
moment
upside
with
from
that
here,
nice little
Oliver,
bull
but I would
flag.
say then it seems like there's a range, and this analyst is almost like hedging their $440 price target.
All right, so pretty optimistic,
kinda
but
waking
it
up
has
there.
kind of slowed down here. The comment about there being a resilient, you know, business model if we hit a hard landing is kind of interesting. Digitization, they said, of their products, and if you recall, Deere is one of those companies that was in some of these like space ETFs and stuff. Interestingly enough, like Deere, Caterpillar oftentimes get lopped into that category. Even I think the ARC team, Kathy Wood, made the case that like this is almost like a space stock because they have so much data of like what's happening on the farms, and they use the data for GPS and space. I don't really get it, but I guess that's now becoming like consensus in the analyst community.
Because farming technology does have a lot to do with space and like you know meteorology. There, I understand that completely, but I feel like that's been the sentiment for now years. But we've yet to see it really benefit Deere's stock.
Okay, all right. Midwest expert on the crops here, Jenny Horn. I like it. All right, Rick, how come this thing's cooled off?
Well, it's kind of interesting because we've had far-ranging
yesterday
prices.
Had that
we're up about
crazy
40%
move with
from
volume.
the lows. We're down about
got
10%
shut down,
from the
so
yearly
that'd be
highs.
my next level. Just
but we haven't
see what
really
happens up
made
here at
hardly
2.3
any
again.
progress since the start of the
Five
year, or
moving
even
down.
since 1 year ago. We're only down about 6% year to date here. We had a long-term uptrend starting with these lows. This pale yellow dashed line here. Pretty
2.7 kind of support would be the next level I'd look at.
Here and here,
2.75.
we saw it start to falter. Then we had a large candle that took us far below the trend line, as well as our two shorter-term moving averages that we follow. Yellow 21-day, orange 63-day exponential moving averages here. The 403 level also looked important, because that was the site of the lows we
so
had
as you
from
see here, it even kind of has a vacuum up
the
till
252-day EMA looks like it maybe provided a bit of
311
support.
level.
It was kind of messy here.
So
we dipped below it.
In this
the
range.
381 level, this green dash line, was really the kind of low line in the sand. That was the low we had back from all the way over there. So RSI looked interesting to me as well today, because RSI is trending upward. We're getting a higher high in the RSI, very slightly here, but price is well below its most recent high close. So that could be a sign that perhaps some momentum building up here for the bulls, but it's not really being reflected in our moving
breaking
averages
out
yet.
new high, 25 cents it made.
Are trending down. Our long-term moving average is trending sideways. So some points to watch here. 389, our purple 252-day EMA could be some support. 401. Our yellow 21-day EMA to the upside here. So kind of sandwiched between these two moving averages, as well as some, price levels to be watching out for.
This is the megaphone. Right?
It is. Yeah, the broadening triangle, also called the megaphone, given its shape. Yeah, well, you shouldn't, because it's one of the hardest price patterns to trade, because your targets keep moving farther and farther away from each other.
So guessing.
Yeah, I mean, it all depends on your strategy.
He said, I love it. He said you shouldn't.
It can give you some interesting opportunities. If you're trying to follow a trend, probably pretty tough.
Okay, so it seems like Deere was ultimately rejected from the high.
30
even
cents.
Though it put in that
next price target here on birds.
Intraday 52-week high. This looks ultimately, now that we've had a few months for the price to cool off,
can
a
hold
rejection
above
of where we
this
were
breakout
a year ago.
Level.
And that kind of maybe speaks to some of the inflation trade that kind of died off
UI's
this
come
year.
down a little bit.
I mean, all of this to the
with
point
little
of the
green
analyst
bounce.
note about
Actually
obviously
kind of right on that
commodities,
level at
agricultural
398.91,
prices, and the inflation story. This
was
year,
from
that tone has
pre-market,
kind
I
of
think.
shifted. Deere sliding here, kind of
No,
falling
that's
out
from
of
back
favor,
here.
ultimately
It's the high from
intermediate term,
327.
kind of bearish chart.
Yeah, basically
market
they're
high
just
and then
looking
high on
for
that day.
move back up near those yearly highs, like you said, about 10% to the upside. But, kind of a mixed picture here, I would say. It could happen, but
might not be a crazy
overall
level, but
trend looks
let's
like
make
it's
it bounce around a
downward
little
to me,
bit.
based on this megaphone pattern.
Now we've got our bearish MACD. We've got our render to
Megaphone,
the
that's a tricky
9.
one. Let's end on a positive note here. Deere chart a little mixed. The Hershey chart, no question about it, is crushing it. We got a pretty sweet upgrade here, Jenny.
A pretty sweet upgrade, pretty sweet chart too, because we're pretty much at yearly highs right
Come
now.
on, Wizard. Come on, man. Thanks for your thumbs up, guys. Got 23 of them. Well done.
Equal weight from underweight with a price target of $255 a share. That was up from $230, but it is only about 60 cents above where we're currently trading. Although the analysts that cover this name have price targets ranging from 180 all the way to 280. So I guess it is at the higher end of the range, but still not really implying much upside from current levels here. But the Wells analysts did say the company's new pricing action changes things as it protects their earnings now well into 2024, creating a unique tailwind of EPS visibility. They also did note that Hershey's pricing tailwinds could last for the next several years, and the macro environment is volatile, which is likely to keep the stock's valuation in the historically high range for the foreseeable future here. So they do see this as a more, I'd say, resilient play when looking at this space, as I do think the consumer staples have been somewhat disappointing this year. Not Hershey, which is up 10% year to date, outperforming actually Mondelez as well as Nestle, only by about 5% on a year-to-date basis. But in this chocolate world, they're still definitely the strongest performer.
Yeah, thing is like going berserk right now. All right, so the note ultimately not super duper bullish, more kind of like a catch up to the price action already, where they have the 230, now they're seeing 255. I mean, it's like
Lulu's still holding
sprinting
up its
just
levels.
the past week. I don't know what's
All
going
days
on
right
here,
around
Rick.
VWAP.
It's been quite a move here. You know, we had this
Retail hasn't broken yet,
shorter-term
but
upward channel
it
here,
probably
just
will.
rocketing out of that area. And you
Try
can
to
see
try
that
to
it's
fill.
really been quite a move
There you go.
upward ever since this.
Yeah, I mean, the time frame on BBY, it's-
began off of these lows. We're up
we
about
don't know. It could go at any
19%
moment.
from that point.
From
We also
news.
had a notable breakout, this 241
Definitely
level,
other
this
ones that are
green
moving
dashed
right now.
line here. Price
Birds,
topped out here
Helvez,
and here and a few
Evitol.
times here. So it was already looking strong when we broke
SI
above that
even.
point. Then we had this huge breakout from the channel as well here. So we're pretty much at that price target. I think
Just have to have
we
a plan,
came,
stick to it.
15
So on
cents short
Evitol,
of hitting it today here. So when you have,
you know,
and it's at all-time highs, by the way, too. So when you have a
Could be
move like
quick.
this, where does it potentially stop?
Could last,
Standard
you know, could be a
deviation
sustained
channels can
rally
help
for
you
a couple
make
weeks
an
like this
educated
was.
guess here. I have, you know,
But,
the +2
we've seen
standard
a lot of
deviation
just little
channel in
pumps.
orange right there, coming in around 256. So between that price target and this
Doesn't look
study,
like it's doing that this
seeming
time,
like
but-
potentially there's not too much gas left in the
Well, it
tank for
could
this
turn
move.
around.
That could be a point where we
Like,
start
what
to
was
see
the
some
catalyst to
consolidation.
start all this even?
And anecdotally, just speaking from my own personal observation, having done this, you know, many years, stocks typically
that-
stay
that
within
was the
about
only thing I
+2,
saw is they were
-2
offering
standard
shares, which-
deviations from the linear regression line based on a
Guess they
year.
took that as
Is
bullish.
that a guarantee it's going to stay there? Of course not. It could keep moving beyond that point. But +2, -2 is usually a pretty good framework to start working with.
All right, well, it was enough for it to go up and kiss that analyst price target.
Back to hot
All right?
garbage.
Okay. Thanks, Rick.
Yeah,
Thanks,
gave up all
Jenny.
that pump.
That's the best I got for the
Buy,
Hershey's
fill in the
pumps.
gap.
Coming up, let's get an update on Lucid. Let's talk some cars.
GME
with
now
Caroline
red.
Before our meetup panel. Stock still holding on to gains.
Banks in France face collective fines of more than 1.1 billion as part of a probe into tax fraud and money laundering relating to dividend payments. Yellen says multilateral development banks need to prioritize limited funds for renewable energy projects. Real estate is the most shorted industry across global equities. Crazy. Yellen says President Biden's top priority is to reduce inflation, while he continues to pump stimulus and bail out banks. Warren Buffett's total compensation was $402,000 last year, a fraction of the $18 million average among S&P 500 CEOs in 2021. Hear that, guys? Warren Buffett, $402,000 last year. That's all he made. Very frugal, that guy. Drives like a 2010 Cadillac, I think. Lives in the same house he lived in like for 30 years or 100 years. I don't know. Long time. Just a little house. Modest suburban house. I'm the catalyst now. Morning, Emperor. Me flushing down. Kind of got to a sort of a top in the range here, this high over here. kind of what we're hitting this morning. So going back down maybe to 22 to see if we retest that for a bounce. Toll still hanging out there. When this thing moves though, it's so funny. It just gaps like crazy. There's no volume. Just boop, boop. Might close out of my shorts here. Next million drive an old Toyota. This is the way. A quick sale of shares there from there to 235. Yeah. Yeah, I think we could make a move back up there. These two candles? Oh, we're talking about 5-minute candles? Wash rollover? Weird. Birds rallying 34%. New high on it, 26 cents. I think it might make it to that 30 cents today. Some like construction going on outside. It's very annoying. It's not like hammering or anything, it's just like a constant grinding noise. That was my pool pump jacking up, but it's not. Like a motor humming. Gotta crank up the yes.
Kind of, limited in the positivity though. So, all right.
Keep in mind, we used to talk. Well, not you and I, but
sure.
Both of us in this business used to talk about Tesla when it was unprofitable.
There's a little pop on EVTL.
There was a lot of
12.5, just at the top of that range. Might be about to go.
And look at it now.
Very true.
Birds,
Okay.
32%.
Appreciate it. Thanks, Caroline. All right, we got our meetup panel standing by. George Tillis and Scott Durfee joining me here this morning to wrap up our program. We've got stocks still higher. Bonds have turned positive. We got a little bit of a bond rally here happening after yields were higher earlier this morning. And generally risk on. Scott, what do you think's happening here?
Oh, these three, maybe that one.
The market and investors and traders are maybe, hopefully, starting to catch a little wind. You know, we're as investors and traders in the market today, we're doing about anything we can to catch a bid on any good news, right? And so
there you go.
I think that's what we're seeing. We're seeing
the same amount of volume up and down.
That whole debacle kind of settled down a little bit. You know, we're expecting some economic data out this week that we don't expect will tip anything over too much. Of course, if we do get a hot PCE, that could throw a wrench in things in terms of the Fed speak, etc. But you know what, Oliver, I think that we're just getting to a place now where we're starting to, and we're far from it, from being there completely, from catching our rhythm, and the market's just continuing to behave like they should behave. We're still working through a lot of things, but as we work through them, I think that we'll be able to anticipate more days like this in the future.
George, I think we're taking a turn to the better here. Some stabilization in bonds, stocks trying to pick up some gains here. or are we still at levels? I mean, we're still ultimately at 4,000. It's not like we're making really any progress. We're kind of spinning our wheels a bit.
Guy likes horses, I think.
Yeah, we are spinning our wheels. I mean, if you just look at the chop that the market's been in, effectively
Double
we're in a
doji.
trading range, and
Might
that's
be
how
a
I'm going to
support
define
here.
it. It's between like 3,600 and let's say 4,150. So today's
The car's
high
just wick
actually
below that
pinned,
line I have.
was pinned below the 50-day moving average. So if we break above that, I think we're in probably the green.
The
to
kid's
go
voice
maybe
on here?
2 or 3% higher to the 4,150 area. So I think that's something to keep in mind. I think the balance sheet trends, OJ, I mean, I follow them. And if you look at November of 2021, when the Fed started to basically announce they're going to reduce the size of the balance sheet, the market started to peak out. And since, of course, the balance sheet has expanded in the last couple of weeks by about $400 billion, the market, albeit there's a lot of chop in it, seems to be supportive
Yeah,
at the
he's
very
pretty
least in the
nasally.
short term. So I think short term,
I think
2
the
to
other
3%
kid
to
actually,
the
I don't like.
upside.
I think his voice is more annoying to me.
We'll see what things pan out in
They both
terms
have
of
their-
earnings coming out starting next month, early
Their
April.
thing.
To see, of course, if earnings start to
Not
manifest
a breakout
in
yet on
positive
Evital.
expectations going forward, and then of course we have to consider labor market conditions. So labor market conditions are still tight. If we start to see some challenges in the labor market, I mean, the Fed is
Mine's
still
basically
expecting
just
about 4.6%
Had a
unemployment.
little break
by
of the
end
400,
year.
just false break, and
if those trends start
just sold
to
off
show
since
some
then.
weakness, that might manifest in a poorer earnings and maybe a market that starts to roll over. But I think in the short term,
Got a big gap,
there's
though.
obviously some positive momentum, probably around to the 4150 area.
Okay. The highlight this week is going to be inflation. I guess we might be in one of those periods where we're waiting, Scott, until we hear what happens on Friday.
Yeah, and that very well may be the case. That's some pretty important data coming out, especially in light of everything that's been talked about around interest rates, around the banks, around everything. I mean, there's just a high-pitched, fever pitch sort of, energy around what's going on there. And so that's going to be an extremely important number. You know, we're
SPY's bouncing a little bit
PCE
here.
and core PCE both elevated by over 0.5% in January. You know,
I'll
analysts
just hold my short.
they just expect a small dip in the pace.
Pretty small move so far.
PCE price going to about 0.5%. That's according
Consistent
to
call
trade
volume?
economics. Now we'll see.
Where? I'm not getting any of
year-over-year
it.
Core PCE's risen 4.7% so far in February, and that's unchanged from January's monthly growth. The Fed target obviously still 2%. But, that doesn't expect inflation to return until 2025. And so
Just that there's
we're
any
going to
call
be
volume,
ranging,
really? Because it's so far to the
somewhere
money.
in there between now and approximately 2025. And that PCE number coming out this week, may have
yeah.
some bearing, may bear some weight
Yeah, it was
on
rallying
some
up, and
decisions
then the
about
spike.
what will happen here. We'll have to see what happens, but
was quick.
a hot PCE number may
5
not
minutes.
be the best news.
Probably not.
Didn't halt, just
All right, we'll
got
get
shut
there when
down.
we get there. A couple days away still. Thanks, George
Yeah.
Scott, for the closing thoughts here. Appreciate it. Thank you for joining MTL. That's it. See you this afternoon.
Yeah, so there's any at all. I mean, half of that's probably me, so. There's a flush on SPY. I trade back and forth with myself between different brokerages, so looks like a lot of volume and open interest. It's great. Delta is moving down there. My new low on the day. Slowly edging down. Filling the gap. SI with a nice green candle. Got a minute, that'll be a nice golfing candle. Kind of at this support here too. Get some more likes. Thanks, Emperor. Best morning time YouTube channel. What about afternoon? Yeah, hopefully Evital doesn't repeat that though, where it shuts it down. But yeah, it is pretty illiquid. Hopefully that was a one-off thing. Morning, Joe. You have been somewhat wrong the last couple days, Al. Alright, man. Tell a friend to tell a friend to tell a friend to hit that thumbs up. I mean, this rally on birds is really impressive how well it's sustained. We can get a green candle to close. Might be an actual turning point in the stock. Wish they had further dated options. October is not that far away. SI made that engulfing candle. Next candle is green. That is neat. Oh, that's right. They're doing the road. Probably like grinding out old concrete or something. I don't know. Maybe it's a mixer. What is that sound? Still sitting on my elbows. Nice. Back in on birds. I didn't get back in with shares. I still have options on it though, which is kind of weird. But it's worked out for me actually. Even without this rally, just every now and then we'll get a little pump and I'll be able to get filled on sells or buys. So maybe it's kind of a ticking time bomb what I'm doing, but it's worked. If it gets too close to the expiration, I just try and get out of it, break even, which I'm still kind of in for now for April's. But I mean, if this thing starts to go crazy, it would be crazy, but if it gets up into $1 or more, these options will start to actually have value. Is a new high on EBTL? No, it's just, oh, there it is. There's a new high on EBTL. We just had to look at it. Breaking out of that bull flag. Yahtzee! Too choppy of a history. Yes. Great time to be alive. Being up the sidewalk, yeah, it's, I don't know what's going on. Constant. I know they're working on the road over there though. Forgot, but that's probably what that is. That's nice. That road was rough. Nice smooth road. Easy to skate on. Getting engulfing down here, I'll probably close my shorts. Getting back in on birds. This is about where the price where you got out of it. Yeah, I mean it's holding up really well. It's still not like overbought in the daily, which is crazy. I'd be curious what happens at that 30-cent level. If it rejects or not. But I mean, insider buying is that's a great sign. And this volume is it actually might be a great setup. making me talk myself out of selling these calls on it. Alright, I'm gonna start selling some of these shorts. Just one at a time. Nice and easy. Easy does it. Panic, sell the rest, hurry. Okay. Not a huge move, but did make a little something on that drop. Might look to reload it. I don't know. 399, 400 if it gets back up there. Birds, 40% almost. The borrow fee on here. Oh, iBorrow's still down. Interesting. How do we do it on our stock bot again? Oh, SH borrowed. Borrowed birds. You guys aren't on our Discord. Get on and get awesome data like this. Birds, the fee is jumped up. Some shares available, but the fee is now 22%. Okay, yeah, this is in the past. Yeah. The fee has climbed up from 5% up to now 22%.
Pretty much a risk-on trade at the moment.
At this moment, you're absolutely right. So
You ready
what do you
for
think,
MOS?
the Fed
Okay.
may or may not do when it comes to the next meeting in May?
Yeah, I mean, that's going to be the huge question. I think the last meeting, I think they took kind of the only path that was truly available to them, which was the 25 basis point hike. You know, I think, you know, there were some people that said maybe zero. I think that could have been problematic if they had gone to zero. I think, first of all, that would have put them in a position where they would have been playing, I think, off their back heel in terms of continuing the inflationary fight. If they did go to zero, I think that also could have introduced maybe excess concern by market participants that there's more to the banking crisis than they were letting on, and that's why they were, you know, had they gone to zero, I think that was the risk there. And, you know, 50 basis points was definitely on the table earlier in the month with the
broke out of that bull flag.
hot and inflation
Been
numbers
it pretty
coming in
mellow,
when they came
still
in.
under
But,
$2.
you know, given the banking crisis, I think they couldn't go
way up.
50. And I think, you know, Chair Powell laid
We're
it out pretty
down
clearly
4.3.
that they're relying on
Thought about
credit
going long
restriction
here
from banks and credit availability to
Sure, I want to.
do some of that extra heavy lifting, and that's why they didn't have to go to 50. So where do we go now? I don't know. We have PCE coming out on Friday. I think that'll be an interesting number. We have the jobs report coming out the week after that, which is interesting because it falls on Good Friday, which the markets are closed. So we'll have a big data point coming out with no market activity.
That's a good point. I didn't think about
See how
that.
that plays out. And then, of course, we have earnings coming from there. So I think it's kind of hard to see where the Fed goes from here. I don't think it's out of the realm of possibility that they could go to zero if PCE comes in very light. But they're going to be, I think, still data dependent. A lot will depend upon, you know, what's happening in the state of the economy with the banks as well.
Right, understood. So having to watch all these data points, I mean, they have some time to think about it, what they'll do next. I mean, we're under the impression that they're likely to do this 25 basis points in May. I mean, that seems to be what consensus was. I didn't check today, but that seems to be what people are taking it at, but with a grain of salt. I mean, there are even people who are thinking cuts. But we're back to the talk about cuts by the end of the year, only because inflation is, in fact, coming down. We've seen that, and maybe the market, you know, some of the chatter today was that maybe the market moving higher, the 2-year bond yield, really all telling us now that inflation's coming down.
Yeah, I think that's what the bond market is indicating. I think what's really interesting about the bond market right now is if you look at the yield curve, it had been kind of as maximally inverted as we've seen in probably 30 years at kind of a minus 90 basis point spread. That's gotten cut in half over the last month, and that's really been, as you alluded to, the drive of the 2-year moving down pretty dramatically, and shorter term as well. I mean, the 6-month had been over 5%. It's now, probably more in the 4.5 to 4.6% range. So we've seen a dramatic move down on the short end of the curve. And I think that is indicating that maybe the market's thinking it's not out of the realm of possibility by the end of the year. But again, I think, they're going to take their time and be very careful not to stoke inflationary fears. So I think we're going to have to see some real concerted data to support of that. And to your point on consensus, I mean, consensus can change overnight. There wasn't much more than a day or two before the banking
14%.
crisis that it was kind of 50 basis points was baked in, and then we
Making
saw
its way up a little bit
Silicon
here.
Valley Bank and First Republic and others, and all of a sudden it became 25, maybe 0. So there is a long way to go between now and May,
GNS now
as you
negative
point out.
1%.
But I think that's what they're going to be
But
looking
they
at.
got spiky, man.
So I know gold has run up. We saw gold run over 2,000. We hadn't seen that in some time, and so that often is a safe haven. But you said in periods
it's
of
kind of
stress,
flushing
look to
now, down
alternatives.
2.5.
What kind of alternatives are you suggesting folks look at? What do you tell investors here?
So we're telling investors alternatives should be a meaningful part of the portfolio, and I think they should be
That's
kind of
a
a
big
constant part
reversal.
of the portfolio. I think, two of the risks that we talk about
Dang,
to
dude, down
investors we think that they're
4%.
making is, one, not having enough alts, and two, concentrating what they do have in one or two. When really you want to diversify that exposure a little, because we're looking at different alts do different things at different points in time. So last year, managed futures had a fantastic year. They were able to pick up on the downtrend in the equity markets and where rates were going, energy prices, and they were positioned very well. And alternatives, in terms of managed futures, had a really strong year last year. This year, it's been very choppy, so managed futures have not been able to keep up quite as well. This year, a multi-strat strategy has actually done much better and captured much more of the upside in the equity market. And
you chase a little bit, but it's hard to know if it's going to keep going.
In the equity markets, multi-strat or merger arbitrage, for that matter.
Fine, when it's exciting like that, that's always a huge risk.
And so we looked at it in different stress periods, and it really varies. If you're looking at an equity market sell-off, managed futures have done well. If you're looking at
still,
credit
there's a new high on it,
and
14.7%.
Credit spreads widening out, merger arb has actually done pretty well during that time period.
Sold off there.
And so if you look at it over the long run, one of the best ways to do it without even getting very complicated is just select 3 or 4 different strategies, whether it be merger arb, managed futures, multi-strat, market neutral, and kind of just average them. And kind of rebalance back to average. I think that gives you kind of almost maximum protection, but also gives you some equity market participation in case we're in a rising period for equity markets.
Right. Sal, great to chat with you. Thank you for all of that. Sal Bruno, Index IQ. Thanks.
Thanks.
Plenty more to come right here on Trading 360. Our 360 Spotlight looks at Trex. The company's CEO will join us with their very latest outlook. And our disruptor is Rivian.
Trex, they're publicly traded.
EV maker on the move this morning.
Like
360 round, we'll look at all things housing. And up next, it's the big
Oh,
three.
yeah, I didn't know they were public.
3 charts, 3 trades.
Crazy.
Lichtenstein goes to the technicals. John Kaufman will take us through the trades for the Russell 2000 ETF, as well as silver and the triple Qs coming up.
Triple Q. Bed Bath kind of bounced from that flush it had. Just wanted to make sure it was under that 80 cents. Can't be holding up there too long. Looking too bullish. Silvergate down 6 1/4. On the first level support, it might hold. I think the second would be on this one, $1.80, and then $1.85, $1.80, and then $1.68. Hey, I'm green on Evatol. Yeah, stop losses are good if you can't watch it, and they're good to take your emotion out of it and just let it go. Might jump back into some shorts here. Might be doing a little A, B, C, D pattern. So oh wait, I'm gonna force it. Spy doing the A, B, C, D? Maybe. Maybe. GME is down 1%. Bird's holding up very, very well. Is your shark, man?
Yeah, no, I was looking at almost the exact same thing, and it is the key level. We break through it, and this 166, 156 spread is
Yeah,
right where you want to be.
15% now, almost
Ultimately, in the
16.
near term here, I have to still be bearish. Pressure's on right now inside of regional banks and, of course, the energy sector.
All right, thank you for that. Okay, so as we've seen, gold
FRC's
moving
up
higher,
4.5%.
that's been somewhat of a safety play. People sometimes use these things as inflation heads or fears. You're a little bit bullish here when it comes to silver. Tell us about that one.
So the silver trade is kind of like the right here and now, and that is, it's not too often I talk about being on trend, but in this case, I'm absolutely going to be on trend. First of all, a little bit of sell side activity specific to the U.S. dollar. Silver has had a number of up days. I'm going to hop right on the bandwagon with that one and just trade silver like in the next week for a continuation, if you will, to the upside. So inside of SLV, again, SLV, just going to use an April 6th expiration. It's really short duration,
1
right?
week, huh?
So next week you've got a marketplace that's closed for Good Friday. All I'm going to do is just jump in with the current momentum to the upside in silver and ride it. I'm going to buy a 21 call, right? So it's the April 6th expiration, buying a 21 call. It's for right around 60 cents. The call is very slightly in the money. So there's little what we term extrinsic, which is time value associated with the trade. I think it's a nice, again, defined risk shot to just jump along with what has been an incredibly bullish trend in metals lately.
Right. Tell me your thoughts here, Ben, as you see what's going on.
Well, I'm looking at silver, SLV, and Nicole, I've got a very well-defined trend to the upside. You can see that. We're talking 18 up to 2162, and I just went ahead and identified some areas of consolidation so you could see them as we go. Pretty well defined, 1850, 1890. This 20 level, again, you can see significant because we came back down and tested it for the most part 2060, and you've got 2120. Don's talking about 23 or up through these levels here. I think until we get up to 23, we're still kind of in a bit of a
real
contained
small
area.
position.
23 is significant. Let me show
Normal
you exactly
sizing
why
I've been
when I
doing
look
for
at that,
shares.
Daily time frame. You can see here. Let me
That's
point
okay.
out here that we had a
We'll
nice
spend it on
run up,
GME
and then
calls.
we've kind of been consolidating. Let me show you. 23 is for the most
Make
part
up my
the
offering to the
middle
market
of this
maker.
range that we've been in.
Buy, rip in
Again,
there.
you can see kind of hovering around it just below. So I like to think if we get above that middle of the range, we could open up a door for a retest of the upper extreme. Real quick though, I did want to show you what's going on in terms of the weekly time frame, because this is sort of supportive of Don's narrative in terms of a little bit of a reversal of trend. We had been breaking down. We took out 20, working our way up. The next big key level is going to be this 30 area here, but you can see how we've moved off this low from 2020, the pandemic low, and are balancing again around this 23 level. So reversing some of this longer trend, similar
almost a
situation
new high there, almost
in terms of what we just looked
16%.
at as far as IWM.
It goes
that
slow
longer
until
trend
it goes
getting,
fast.
reversed with the movement
It's
of
going
value
pretty good. Nice little
against
trend
it.
up.
So keeping an eye on the weekly and
Yesterday
some of
was
these
kinda
more
wild on it.
granular time frames, but I can see what Don's talking about here, especially if we get up through 23.
Yeah, and what about quickly, Ben, the U.S.
Check the
dollar
borrow
and
fee
the
under the toll.
relationship to commodities like this?
Yeah, well, we've been talking a lot about the dollar breaking down recently through the 104 handle back down to the 102 area. It's been supportive of what we've seen in terms of crude oil.
The borrow fee on
We're
this one,
talking
I feel like,
about
is
gold,
always
how
really
it's been
high.
really strong for the most part, holding again just below
19%.
2,000. But when you look at the bigger picture, not far from that longer term all-time high up around 2,100. Here you can see the dollar, though, as I'm looking at it. This is a market, much like many other, Nicole, that's waiting for more information. In the middle of the range that we established last year, we had a low around 94 up to 114, and here we are comfortable, well, just below 104 right now, 102.33. But yeah, also a bit of a disconnect between the dollar and rates recently. I think the dollar seems to be driven by some of the foreign currencies more so over the last couple weeks.
All right, thank you for that. Last but not least, we talk about the triple Qs, and we know that a lot of people were running to some of the mega cap tech names as a safe haven, particularly during the concerns what we saw about banks. Now what on the triple Qs, Don?
Does that make anybody feel warm and fuzzy that that traders are literally running to the safety of Meta? They're running to the safety of Microsoft. Look, I think a lot of what we're seeing specific to the NASDAQ, even today, is what we term window dressing. This is end of the quarter, ultimately dressing the portfolios for success. It's a lot of stocks, you know, your Microsofts and so forth, you know, your Teslas, NVIDIA. I think NVIDIA is up almost 90% year-to-date basis. I mean, this has been wildly overbought at this point. We're going to go into earnings season in the next few weeks. I think it's going to be a very tough in like earnings series, you know, season. The rest of the year is going to be tough to endure in terms of some of those numbers. Look, this is going to be a big time contrarian position specific to the QQQ. This is the one that, you know, when Ben looks at the chart, he is not going to like it by any stretch of the imagination.
Bull flag on GME is still looking nice in the daily there.
So I'm going to go out to the Qs.
It's with a gap, but
into
still.
the June 16th expiration. Again, when I want to step in and be a big time contrarian, I give myself some duration, time to be right, time to be wrong.
See if they're on the 4-hour with extended.
Buying the 298 puts, selling the 288 puts. It's done for a $2.45 debit. And again, it's the ultimate contrarian position where you're saying, hey, look, maybe not tomorrow, maybe not even next week, but we feel that the NASDAQ is going to turn around significantly to the downside. It has been the leader of the pack right now. And look, I think it's still actually going to lead the pack, unfortunately, to the downside. And you look at financials, they haven't really moved off.
You just got one yesterday.
You know, energy hasn't really moved
kind of
off
a daily
the bottom.
pump.
It's
daily
been
pump
all
kind of guy.
About the NASDAQ. And the
had like an 8% move yesterday.
If it starts to see some sell side activity, that is what would spark
Pretty
the next leg lower to the S&P 500. Watch the NASDAQ carefully in the weeks to come.
Yeah, and you know, this I love how you phrase that, you know, people are running to the safety. And it's very interesting, Ben, because people do love names like Meta and Amazon and all that. They did so well for so long and then really petered out last year. Now, what do you think here, Ben, when you take a look at the triple Qs?
Well, Don, you kind of painted me in a corner on this one. I'm not as against this position as you might think. I think the NASDAQ ran it up a little bit more aggressively than the broader market, recently taking out the February highs, while you're talking the S&Ps, the NASDAQ, or I'm sorry, the Dow, the Russell, still struggling relative to. But in this instance, you can see a very well-defined trend higher. We've got a strong trade here from 284 up to 315. We've got areas of consolidation that have formed at higher and higher levels. So at this point, no indication here that we're losing this momentum. And I just drew this as one big move up as a sideways consolidation area. But if you look at the left side of the screen, you're going to see this pattern repeat itself multiple times over and over and over again here. So again, currently consolidating around 308 right now. This is a pivotal area in terms of determining upside or downside momentum. And, you know, it could go either way, but we are seeing some bullish sentiment here into this intraday time frame.
Green candle, like, that might be good to have.
This is where that longer term trend
one of these
to
candles
the downside comes into play. And we've been, well, on the daily, you can see teetering around the 300 level. Now, this is an area, again, kind of working our way to the upper extreme of it, where if the bears, as they have been, are still in charge, you're going to see them step up at some point soon. But until we break down below 300, this still favors this upside, a retest potentially of 340, in my opinion. That's the only kind of pushback I'll have on this one. But much like IWM, you can see, again, a very similar pattern here where we saw a high conviction trade. Now we're going as far back here, only back to 2017 in this instance, but pandemic lows, spike up to 408. And then look what started to happen, though, off those highs. And again, Don, this is why I kind of like this, is you can see every $50 we've stacked up areas of value at lower and lower levels. So this longer term trend has been invalidated, and now we're starting to work our way lower. And again, I think there could be some room to the upside here at 340 before the bears really have to flex. But hey, break down below 300, and that opens up the door for a retest of these lower extremes around 260.
Uh-oh. You know what, Don? I mean, he half agreed with you, is what I'm thinking. Yeah, and we're watching these rates so carefully, too, because that's such a big part of it. Don, final thoughts?
Yeah, I'm almost disappointed that Ben is actually on the same page as me. But look, we come from a similar background. You know, final thoughts on here is again, the marketplace is kind of stagnated. There's not a lot of reasons to go higher right now. Sure, we can have like a short-term spike, if you will, to the upside. But I think at this point, you still have to be able to fade this marketplace, which is be bearish for the near term.
All right, thank you both. Good to see you both, Don and Ben. Thank you. Don Kaufman, co-founder of Theo Trade, and our own Ben Lichtenstein on those charts
Lichtenstein.
today. Thank you for the big three. Coming up next, we're going to see Trex outdoor decking. Shares are up around 10% for this year. The CEO is standing by, company giving its outlook, TREX.
South Korean authorities will consider lifting a short selling ban as early as this year if conditions are met. Lifting the ban. Is that the same ban they had since COVID? I didn't know there was still a ban on it. The dollar yen at fresh 1 week high, last up 1.25%. U.S. consumer inflation expectations continue to fall. 1 year ahead is now at 4.2%, lowest since May 2021, and down from a peak of 6.8% in June 2022. 3 year ahead is now at 2.7%, lowest since June 2020, and down from peak of 4.2% in October 2021. That's very hard to understand with words. So here's a chart. It's consumer inflation expectations. Blue line's 3 year, the dark blue's 3 year, the light blue's 1 year. Intel customers are testing Granite Rapids chips today, and delivery will follow Sierra Forest. Their 5th generation Xeon chip, Emerald Rapids, on schedule to deliver end.
Over at Gordon Haskett did downgrade the company. This is just in addition to the news that of the CEO transition from accumulate to hold with the price target of 18. And some of the reasons that this analyst provides for this downgrade actually have some positive things to say as well, which is one of which is that they commend the company's management team for delivering on many of the company's specific initiatives and doing an excellent job controlling inventory levels. But they talk about the company like many companies are just not immune to macro concerns and macro pressures that are starting to manifest. And they see trends in its data work that give it pause in the short to medium term despite a favorable view for the company on the long term. And they talk about foot traffic trends starting to show moderation across not only Macy's but all department stores in recent months, as well as moderating visits to their e-commerce platforms as well. So not all bad, just talking about some of the pressures that may be facing the economy and how that may spill over to a company like Macy's.
Right, understood. And at this point now with Bloomingdale's is really a different consumer too, a little bit more high end, and so he'll step into that role. Thank you for that report on Macy's. Appreciate it. Alex Coffey, it's great to see you. I don't get to see you enough. Thank you so much.
Thanks,
Alex.
Nicole.
It's time for our spotlight. All about your backyard, Trex, right? Everybody loves to be outside, and who better to speak with about this? Brian Fairbanks is with us, CEO of Trex, just releasing their outlook, outdoor living. It is spring season. People are probably thinking a lot about the company. So I'll just start with this. Zillow said that one of the things people request always or most often is outdoor space. That's you.
Absolutely.
How's it going?
Great, thanks. Great. Yeah, we are definitely seeing a move towards the outdoors, and we refer to it often as the inside coming out. You're starting to see more of those inside sort of amenities like your kitchens, TVs, couches coming to that outdoor environment.
Yeah.
And all it takes is a couple nice sunny days, which we've seen. People get out in their old wood deck, and they start thinking about how can I upgrade my outdoor spaces.
Yeah, and people just put on a little rooftop outside, and you can sit outside all year round pretty much. To your point, as you mentioned, some of the things that there's a lot of innovation that's happening. Trex is something that I've heard about for so many years. I mean, it was basically the alternative to wood decking where you got all splinters in your feet, right, when you were a kid. This is different now. You're moving this to a higher level. I mean, if someone's not familiar with Trex, tell us a little bit about the decking.
Yeah, we try to make sure that we've got products in line for any of the customers that we have in the marketplace. Anywhere from our enhanced product line, which starts about 2 times the price of wood, and then we move up to our Transcend and some recent newer products at the high end of the marketplace with our new Transcend Lineage and our Signature product line. And that Signature product line is really designed to mimic the look of real hardwood, but all of the benefits of Trex decking products.
It's amazing, and you have 4 different colors, all different hues, and the thing that people love about it is no scratching, no fading, no mold, no splinters, and that's what people think about. At this point now, and having to move into what people want and trying to keep getting orders, right? You said you're working with outdoor furniture, lighting. I saw spiral staircases. There's drainage. So you're working with other, I guess, ways to do this. It's not just laying down the deck.
Right. It's important that whenever a customer is looking to build a deck, we are sold where they're looking. So that means making sure that we have an online presence when they start doing the research, and when they're looking to actually buy the deck board itself, that we have presence. We have over 6,700 locations in the U.S. as well as around the world where a Trex product can be purchased.
And also, at this point now, I think about ESG, sustainability, and a lot of these materials are, in fact, recycled materials. Do you find that people, are you doing that just to do the right thing, or do you find that's what customers truly want? Are they asking for it more than ever?
What's unique about Trex is for over 30 years, we've been using recycled content. And today, it's more important than ever.
Right.
All of our deck boards use 95% plus recycled content, and it's something that customers are asking for. And as we look towards the future,
I don't know how to identify the ABCD.
That's really important to them, that like not only does a company say they're green, but they prove it with the materials they're using.
It retraces a certain amount and sits there, so that should be C, but then rips through it, so I guess that means it's failed.
Understanding what people want, when they want it, so that you can keep that balance sheet right where you want it.
Yeah, last year was a real challenge. We needed to work through a sizable amount of market inventory in the back half of the year, and that was due to there being shortages in the market. Marketplace overbought, we needed to correct it. As we move into this year, we are in a seasonal industry. I expect the curve of the season to be steeper as the channel wants to be more conservative on the inventory it's holding. With the capacity that we have, we've got the ability to serve whatever needs are out there, and it's okay to be a little more conservative in the first quarter.
Are you finding consumers are a little more conservative? I spoke with a CEO, retail CEO, who said that there is some attrition as to what they're ordering. Still ordering, but some attrition, and also that they're using credit cards more than ever. Are you finding some consumer behavior trends?
We're not really seeing a shift towards more credit. The high-end consumer is holding up extremely well. In discussions with our contractors, their backlogs are in good shape going into the season. The phones are ringing, and our website traffic has been quite positive.
What are you hoping to continue to do here? Because I can't think of anything else. I mean, you even have cornhole listed as something that you help people to put in their backyard. I mean, that sounds like a lot of fun. But really, you have the outdoor decking, the draining, the no scratch, everything. Is there anything more that you're saying people are asking for? I mean, I saw they want canopies and pergolas and things like that.
Sure, we can be helpful in providing all of those things for the outdoor living environment, but the largest growth driver for Trex over the long term is that conversion against wood opportunity. Today, about 25% of the market is composites. We see the opportunity to increase that upwards of 45 to 50%.
It's amazing. I love that you're here in person to tell us all about it. It's a company, you've been a friend of our network. We've had you on many times. Great to have you here at the New York Stock Exchange. And look, people are loving Trex. We know that for a fact. Year-to-date stock is up almost 10%. Nice to see you.
Thanks.
Thank you so much, Brian Fairbanks, CEO of Trex. Coming up next, we'll be talking about Rivian. Needham's analysts will talk about their recent sales data. All the details. George Sillis has that.
Apply enhanced prudential standards to banks not above
I forgot they were talking to the
billion,
House today.
above $100 billion in assets on a one-off basis.
Yes, the legislation provided the Federal Reserve with ample discretion. The way that discretion was implemented in 2019 was with a rule, and that rule provided.
But in order, but by order, and reclaiming my time, Vice Chair, by order, the Fed could have applied enhanced prudential standards before the bank reached the size it did by February of 2023. My point is, it doesn't seem appropriate to change the tailoring rules for all banks to account for a lapse in supervision by the Fed and the inability of the Fed to deploy enhanced prudential standards to firms when it's currently able to do so under existing law. And Mr. Barr, as you and I have discussed, and as we agree, we need to preserve the diversity of the financial ecosystem here. The Fed had all the existing tools it needed to supervise this bank and apply those enhanced prudential standards. I think pushing a one-size-fits-all or reimposing a one-size-fits-all regulatory regime on community and regional banks, especially regional banks under distress right now, would result in fewer of those institutions, more consolidation, and less competition for too-big-to-fail banks.
Davis on the move up.
Mr. Director Gruenberg, the vast majority of community banks in my district are well-managed.
Chart
They
looks pretty
actually
nice.
understand
Our side divergence there. Got a daily MACD crossover. Green over the 9.
And since the failure of Silicon Valley Bank, those Kentucky banks and their customers have been asking me why they should have to pay an assessment for your rescue of Silicon Valley Bank with a 100% guarantee of deposits of largely wealthy, sophisticated depositors at Silicon Valley Bank, some of whom apparently cared more about the bank's commitment to environmental sustainability
GME kind of flushing
than their
down
capability to be
1.5.
good stewards of their deposits. I think this is a legitimate question. And I also think it's a good question whether invoking the systemic risk exception to the least cost resolution mandate under the Act was in fact the least cost solution. After all, your decision to cover all of the uninsured deposits cost the Deposit Insurance Fund an estimated $20 billion.
Yeah, Nicole, I mean, if you look at Rivian, it's got a nice price movement today based on the back of an analyst. Needham actually reiterates a buy rating and increases their price target to $26. And there's some indication for Rivian, which is down about 70% over the last year, because the company's still struggling from a profitability standpoint. But there's a lot of indications that effectively the delivery outlook for Q1 looks like it's coming in ahead of expectations. And this is based upon vehicle registrations. There were over 8,100 units that were registered, and that's about 1,000 units more than the 7,100 estimates that analysts had predicted at the very least for Q1. Now, if you look at the total deliveries for the entire year of 2023, the company is expecting quite a robust delivery number of 50,000 units and all the way to 400,000 units in 2025. But if you look at Rivian and, of course, other companies like Lucid, they have been underperforming some of the more profitable EV manufacturers. I'm going to put Tesla in that camp. The reason being is if you look at Rivian's top-line sales over the last 12 months or 4 quarters, $1.6 billion in sales. Now, that was a significant increase, hundreds of % increase over the $55 million that the company generated in 2021. So the company is growing exponentially in sales, but the challenge the company's really faced, Nicole, and I think this is one of the reasons why the stock is under a lot of pressure in the last year, is that they have negative gross margins. In order to generate that $1.6 billion in sales, the company basically spent about $4.7 billion to produce those cars. So they have a negative net $1.1 billion
giving you guys a poll,
in
which one
gross
to watch.
margins. And effectively, their operating income is a negative $3.1 billion for the last year. So the company's still struggling from a profitability standpoint. They certainly need to increase prices alongside volume to achieve scalability. But nonetheless, the stock is certainly, as I mentioned, under pressure in the last year, considering that the company still expected to lose about $3.44
if it's both,
per
just
share in the next 4 quarters.
I could cycle back and forth.
Right, all right. And as you noted, up
kind of
8.5%
moving up
today
here a little bit.
with this news. So,
Yeah, wedge for you,
you know, when you get some positive comments from the analysts, so how would you go about trading it?
Yeah, so look at these price targets, Nicole. I mean, if you look at Needham, if the company does meet those delivery numbers, they could actually hit that price target of $26. It's extremely difficult to value the company, especially with the negative operating losses over $3 billion.
Yes.
But the company does have about $11.5 billion in cash, so they have a pretty
crazy.
good runway to prevent dilution of shares on a forward basis. And I think this is one of the reasons why the analysts are still relatively bullish with Needham having a $26 price target, or about 100% off of the current price. But in the near term, you know, we could actually see the stock either continue to the upside or even pull back. So one of the things we can do is place a stock substitution trade, or in this case, sell a cash secured put, because the premiums are rather rich. And we're actually going to go out into a narrow time frame with 23 days to expiration by selling the April $13 cash secured puts, again with 23 days to expiration. And you can actually harvest about 65 cents a share, or $65 a contract. Now, if you take that premium relative to the strike price, it's basically a 5% yield to strike in 23 days. So ideally speaking, we'd like to see the stock stay above $13 between now in 23 days.
Cast your
But
votes.
if the stock falls below 13, you'd be assigned shares. So you have to be willing to buy shares at the very least 100 shares or per contract that you sell at $13. But your cost basis is effectively $12.35. So ideally speaking, we'd like to see the stock just remain above 13 in the next 23 days. And the value of that premium that you sell up front would erode to zero.
Eva told might make a new high here.
All right, thank you for all of that. George Sillis, a great look. I know these EVs are the hot topic. Appreciate it. George Sillis with a good look there at Rivian.
They were like a year ago.
Right. Thank you, George.
2 years ago.
Coming up next, our panel will take a look at the very latest in the housing market data that we've been seeing and what we're waiting for as well, what home buyers can expect for this spring and summer. Next, here on Trading 360.
And incentives that are much stronger, faster in the supervisory process. That's one of the things that we'll be looking at in the review. But I do think that in instances like this, where it is such a fundamental issue, we need to have risk mitigants in place that are ordered by the supervisors quickly.
So I'm just going to make this observation as I run out of time. As we all saw, one of the problems here, and one of the new things here,
China completes
were the
first
chat
yuan
rooms
settled
and the
LNG
speed
trade.
by which deposits could be withdrawn. And billions of dollars went out the door because of these devices. So I'm not convinced that giving humans who operate in human time additional authority is going to do the trick here. I think we need to think about automatic mechanisms, and that may require statutory change, automatic mechanisms that when a finding of deficiency or other adverse observations have been made, kick in automatically, perhaps after some cure period, but this was a meltdown that happened at the speed of light, and humans with discretion is not going to solve it in the future.
Gentleman's time has expired. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I'm going to repeat myself a little bit, what you've heard today, but when I talk to community banks in my district, and in full disclosure, I'm a car dealer, and I talk to them a lot, and I owe them a lot of money. One of their top worries right now is being left to foot the bill for the failures of Silicon Valley Bank and Signature Bank. Community banks, which most of us live by, should not be liable to pay for the rescue of larger banks that gambled and made a risky bet. So community banks are relied upon Main Street, America, to be a lifeline and provide crucial banking services to small businesses. So these smaller banks, which we all need to have, are some of the most trusted institutions in the financial industry. So Mr. Grunberg, you talked about it before, but could you elaborate if smaller community banks in Texas, where I'm from, will be left responsible for bailing out the failed banks in California and New York, which we don't even know where they are?
Thank you, Congressman. I'm keenly sensitive to the concern. Let me just say, under the law, the FDIC is required to impose a special assessment on the banking industry to recover any cost
I gotta
of
match
the
their
deposit
mics, man.
insurance fund from covering these uninsured deposits.
Mixing this audio.
And we have to do that by a notice and comment public rulemaking, which we're going to do in May. Just to be clear, the law gives the FDIC authority to consider the types of entities that benefit from any action taken or assistance provided. So
Well,
that the FDIC
options
does have
definitely don't seem like they
discretion.
play on birds.
And let me just say,
This
without
rally.
forecasting what our board is going to vote, we're going to be keenly sensitive to the impact on community banks.
Take a look at it, because we all know that what they'll do is pass the cost on to someone like me. The Federal Reserve was supposed to be the primary supervisor over Silicon Valley Bank, but from all we've seen and heard today, they failed to do their job, and it's been reported that Silicon Valley's bank risk practices were on the Federal Reserve's radar. We've talked about that for over a year. In 2022 alone, Fed supervisors issued 3 findings on SFB's ineffective board oversight, weakness in their risk management, and flaws with the bank's internal audit function. So it should raise major concerns that the Federal Reserve, who is tasked with regulating and overseeing banks, knew about Silicon Valley's risky practices far more than a year and failed to take any corrective action. Now, Mr. Barr, what actions, if any, did the Federal Reserve take, and you talked a little bit about this, after issuing those risk findings, and how did the Fed Reserve become so complacent on its supervisory role and miss these warning signs? And I think that's what people across America really want to know.
Thank you very much for the question. My understanding is that the supervisors identified the issues, they brought them to management's attention. The response clearly was not an effective response. Bank managers failed to manage the firm in an appropriate way. They didn't manage their interest rate risk and their liquidity risk well, even though it was pointed out by the regulators. And I do think it calls for a heightened need for more aggressive supervisory action to take care of these problems.
But you all missed it too.
I'm sorry?
You missed it too.
The supervisor staff were aware of the underlying issues. I think all of us were caught incredibly off guard by the massive bank run that occurred when it did on March 9th and 10th. The scale and speed of that, $42 billion going out the door Thursday afternoon.
SPY moving
It
up
was
here.
expected by the bank that $100 billion more would go out the next day. That's just an extraordinary scale and speed of a run that not anything I had ever seen before.
Okay, out of all the banking supervisors, I would expect the Federal Reserve, and most of us would, to be the most aware of the impacts increased with rate hikes would have on the value of securities for banks. However, the Fed has stress tests, which we've talked about, which are conducted to determine how large domestic banks would perform under hypothetical and stable economic scenarios, currently does not test for the problems that caused Silicon Valley Bank to fail. SFB failed because of inflation, rapid increases in interest rates, and loss in value of government bonds. So even if SFB had been subject to testing, it would not have led to the changes that could have prevented their failure, because the Federal Reserve is asking the wrong questions and not running scenarios that ultimately led to SFB's downfall. So we'll correct, Mr. Barr, how can the American people trust the Federal Reserve if you are not testing for all scenarios? How was the Federal Reserve so far off? That is a question that everyone asks again.
I think that the Federal Reserve should use multiple scenarios. That's one of the reasons why I proposed that for this year's test. It includes a rising interest rate environment for the trading book. I think multiple scenarios makes a ton of sense and should be done.
You know, that saying, they can get it right 100 times. You got to get it right once. So you got one crack at it. So thank you very much.
Gentleman's time has expired. We now recognize the
long
ranking
there
member of the Digital
would
Asset
end up being
Subcommittee,
good.
Mr. Foster, Illinois, for 5 minutes.
It's all right.
Thank you. As you know,
I like the
12
support. It
years
kind of
ago
broke through
during
this one,
Dodd-Frank,
but
a number of us put a lot of effort into specifically authorizing U.S. bank regulators to put contingent capital requirements into the capital stack of large banks. These can sort of be thought of as a sort of privately funded insurance policies that large banks are forced to carry that pays out if a bank gets into trouble.
Edging back
It
up,
automatically
almost to
injects
that 400
capital
level.
into a struggling but not yet failed
399.
Now, for the last 12 years, U.S. bank regulators have completely ignored this authorization from Congress, which I have complained about in numerous hearings. But in the last 12 years, European bank regulators and others
kind of made a new high
have
there,
used
1980, almost
contingent
$2
capital successfully. And so now I believe that we have a lot to learn about two side-by-side bank failures. First, Silicon Valley Bank, a large bank by some measure, but with total assets less than 1% of U.S. GDP, and Credit Suisse, with total assets greater than 100% of Swiss GDP, too big to fail by any metric. Now, when a couple of weekends back, the U.S. banking regulators tried to find someone to buy SVB, they failed. The result was potential systemic risk and emergency intervention that has, by regulators, that's risked abandonment of a lot of market discipline and market chaos. And the Deposit Insurance Fund and eventually banks and their customers must take the hit. But when Swiss regulators tried to find a partner to buy out Credit Suisse, they succeeded. And at this point, it looks likely that the Swiss taxpayer and their DIF will be off the hook for this giant bank's failure. And the difference was contingent capital. Because when Credit Suisse got into serious trouble, their contingent capital triggered and injected $17 billion of equity into Credit Suisse. This was absolutely essential to finding a buyer for Credit Suisse, since, as you know, Credit Suisse was bought for about $3 billion, but only after the $17 billion of capital injection by their contingent capital instruments. So the Swiss contingent capital succeeded at its two design objectives. First, to prevent contagion, and secondly, to keep the Swiss taxpayer off the hook for the failure of a truly giant bank.
With a little red
Now,
candle here.
if Silicon Valley
Protecting the
Bank had
400
been
so
forced
far.
to carry an appropriate amount of contingent
Evital looks like it's on a more
then
sustained
capital
rally,
would have been
so
automatically injected sometime probably Friday at the latest.
breeze.
And it was very likely that a buyer could have been
Yeah, that's kind of
found
the next
over
level up on
weekend
it.
as well. And we would not
After
be
you break
having
this
this
little
hearing
pump
today.
from yesterday.
In fact, it's possible that they would not
3.5.
have gotten in trouble in the first place.
2.3, yeah, next
since,
level is 3.
Silicon Valley Bank would have had to answer
guess
not only to
2.7,
regulators,
and
but
3.
to the bond markets for their risky practices. When they went through their gigantic growth spurt, they would have had to issue a lot of contingent capital instruments, and I'm pretty confident that one of the wizards in the bond market would have said, this is interesting. This bank is, has very flighty deposits and essentially no risk management in place. Maybe we should charge a pretty big risk premium, and the markets might have detected that. So my question is this, Vice Chair Barr, as part of your holistic review of bank capital requirements, will you commit to finally seriously considering contingent capital requirements in the capital stacks of large banks?
Thank you very much for your question, and I very much appreciated our conversations over the years on this very question of contingent capital instruments. Both the FDIC and we have issued an advance notice of proposed rulemaking of a different type of contingent instrument, a gone concern capital instrument that would be required for large banks. But I think it does make sense to consider alternative options, and I'd be happy to continue the conversations with you about that.
Okay, and I would specifically appreciate it if your analysis included a counterfactual analysis of how much better off we would have been if regulators had listened to Congress and included contingent capital requirements into the capital stacks of these banks. Because I think there's a lot to be learned from just the counterfactual analysis. I'd like to just close out by finishing up a little bit with questions about the non-responsiveness of SVB management to the early warnings they got. Is there leverage that we can provide you An obvious one is to say all of these matters requiring immediate attention and so on are private.
Oh,
And
$2
what,
is
for example,
kind of
if
where
they had to become
Evital
public
got
after
crazy yesterday.
60 days, if they were not presented, would that have lit a fire under the chair
Spies moving up here more.
of the management? Are there other things? For example, you could say any management that had an ongoing, a pending MR, matters requiring immediate attention, we would simply put all the bonuses in escrow. That would, I'm almost certainly get their attention. So are there, if you could
Gentleman's
include
time's
these sort of
expired.
ideas, I'd appreciate it.
If you'd submit for the record, Mr. Grunberg, Mr. Barr. Now recognize Mr. Emmer of Minnesota for 5 minutes.
Thank you, Chairman McHenry. Thanks for holding this important hearing today. The collapse of 3 regional banks over the course of 2 weeks is directly related to failed Democrat policies. Record inflation as a result of reckless government spending led to historic interest rates that banks were not ready to manage. It appears financial regulators were not appropriately communicating financial risks of the high-rate economy with banks in their supervisory capacity, and this administration's political attack, quite frankly, from the highest levels of our government on the digital asset industry, which, by the way, had nothing to do with causing the runs,
Birds looks like it's
sparked
about to
fear,
break
leading
out.
to bank runs at Silvergate, Silicon Valley Bank, and apparently Signature, bringing these core issues plaguing our economy and the broader banking sector to the surface. Let's not be fooled. Providing financial services to legal businesses in the U.S. should not be risky. But this past month has proven that the mismanagement of our monetary policy has apparently made it risky to put dollars in a bank. Mr. Grunberg, will the FDIC sell off Signature's deposits from digital asset businesses? Yes or no?
We're returning those deposits to the depositors, Congressman.
So, okay. Does the FDIC plan to sell the intellectual property for Signet?
I believe that's already been sold out of the Bridge Institution, Congressman.
All right, we would like to see that information. Will you commit that a bank that buys Signet will be able to use it to facilitate 24/7 access to the banking system for digital asset companies?
I'm happy to look into that. I don't know who the buyer was, but be glad to look into it and follow up with you in regard.
You're not going to block the buyer from doing 24/7 banking for digital asset companies, is that correct?
If that's the nature of the acquisition, yes.
And will you commit that a bank that buys Signet, or the bank that did, will be able to onboard new digital asset customers?
Again, I'd like to look into the transaction, but I'd be glad to follow up with you in regard to it.
When the FDIC sold off Silicon Valley Bank's deposits to First Citizens, did that include deposits from any digital asset firms or VCs in the digital asset space?
I believe all of the deposits from the failed Silicon Valley Bank were transferred to First Citizens in
Including the digital?
All of them, yes.
Were all of SVB's deposits from digital asset businesses, again, transferred to Citizens? That's what you're saying?
My understanding, First Citizens assumed all the deposits of the failed.
Has the FDIC ever communicated implicitly or explicitly, sir, to any banks that their supervision will be more onerous in any way if they take on new or maintain existing digital asset clients?
No.
Thank you. The FDIC estimates that resolving Signature Bank is going to lead
40%.
to a $2.5 billion loss to the Deposit Insurance Fund, and resolving Silicon Valley will lead to a $20 billion loss to the Deposit Insurance Fund. When the FDIC sold Signature, it had the effect of closing Signet, which is an innovative payment system that facilitated 24/7 access to banking services. Frankly, a private sector innovation that apparently will be rivaled by FedNow. Signet is intellectual property that has significant value, so I do want to see that sale. Chairman Grunberg, when managing the resolution of any failed bank, the FDIC is statutorily required to do so using the least costly resolution option, thereby minimizing losses to the Deposit Insurance Fund, which is replenished by the banks through fees that are indirectly passed on to everyday Americans with bank accounts. I'm concerned that the FDIC has deviated from its statutory requirement to minimize costs here and instead opted to pursue a lazy and destructive regulatory campaign to in fact oust digital asset opportunities from the United States. No bank is designed to survive manufactured bank runs, and in analyzing what caused this fiasco in the first place, many signs point right back to you and the FDIC, this administration, and certain reckless Democrat senators. I want to thank you again for coming today, and I appreciate a response to my March 15th letter, because to me it's still clear that we have a lot of questions that need answers. And with that, Mr. Chair, I yield back.
Gentleman yields back.
Birds to the moon.
The ranking member of the National Security Subcommittee, Mrs. Beatty, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Ranking Chair. Mr. Grunberg, we know that both SVB and Signature had very high proportions of uninsured deposits, somewhere between 90–95%. Can you share with us or explain to us what the typical ratio is for your average bank and
back
how
up to the resistance.
This factor played into the bank run
Setting up
that
an engulfing candle
witnessed
again.
on March 9th?
Thank you, Congressman.
400.
It's an important
Ping-ponging
question.
to it.
I think fair to say these two institutions were outliers in terms of their exceptional concentration of uninsured deposits, both around 90%. In the regional bank space, between 100 and 500 or 600 billion, I think it's generally in the 40% category. So these two institutions were outliers, and it was a significant part of the liquidity risk on their balance sheets.
And would you say that this high proportion of uninsured deposits left the bank more susceptible to this run?
Yes, it was, I think.
Let me also have a follow-up question to you. We've heard many ideas proposed
big red
about
candle on SPY there.
modifying the $250,000, and we know in, I think it was 2008 with the Emergency
EBTL hit
Economic
the $2.
Stabilization Act, we went from 100,000 to 250,000. So, for example, what about temporarily insuring all deposits, increasing a limit to 500,000 or $1 million, ensuring all deposits for small and mid-sized firms, or limiting it for the largest financial institutions? What are your thoughts on some of these proposals?
Well, as you understand, Congresswoman, the coverage for deposit insurance is statutorily set at $250,000 per account. So to adjust it would require legislative change. And as I indicated earlier, the FDIC is undertaking a comprehensive review of our deposit insurance system, and we'll come back with a report that we'll release publicly outlining policy considerations for.
So is this one of them? And you can weigh in also, Mr. Barr or Ms. Lane,
Ryan.
on, I mean, you're
Good
expert,
day, man.
you're testifying here on your opinion. I understand that
to
it's
you.
statutory and requires it to come back here. And certainly, as you know, we've changed many things
Thanks for your
over
thumbs
the
up.
years in rooms like this. So to the public, I don't want you to think that this may be as far-fetched. We
33.
had large banks.
No, you're
we
dropping
had,
to give 'em, so I appreciate
too big
it.
to fail. And we're certainly more than $50 billion now as we had legislative ways to change it. So what are your thoughts on increasing? That's one of the number one things I'm getting
I
from
kind of
constituents.
saw that.
You know, it was just in 2008, it was 100,000.
I
We
don't
made
really
the
care about the DRS
change
numbers.
then through an emergency act.
Not devastated.
What now?
It is interesting how they changed the wording on it, though. Kind of curious.
Congresswoman, I look forward. The
Boy.
FDIC, as Chairman Gruenberg mentioned,
He's
is
a
doing
funny
a
guy.
review of the deposit.
Would you
insurance
support
fund.
an increase?
I would support a study and proposals for reform if needed. Why is this
Favorite
increasing?
numbers.
It has been increasing.
Panel up 30%.
Okay, only because my time is
Saying
running out,
IPO.
Mr. Bryan. The next question is going to be for you. So.
We'd
Yeah.
be happy to work with you on thinking through that.
Oh,
I
another
think
Chinese
taking a step
IPO,
back,
huh?
The important thing is that our
Hong
banking
Kong?
system is sound and resilient. The actions the regulators took demonstrate
10x
that
since IPO?
deposits are
No.
safe.
2x?
And we'd love to continue the conversation with you.
Okay, I'm
Especially
glad you
jumping on
said
some Chinese
sounded
IPOs.
resilient.
There are some coming
in your
up.
opening testimony, you said the same thing, that you thought banking was
Shang
sound.
Feng Development Limited.
You also used words like strengthening the public confidence,
Hongling
or
Group, probably.
paraphrasing it. I'm from Ohio, and the public pension fund nationwide, as you know, lost millions of
Chinese
dollars
IPOs
that were
back on the menu?
invested in SVB and Signature. In my home state of Ohio, the state teachers' retirement system took the biggest hit, with some $27 million that was invested in SVP. Representing, I know, maybe only 3 or 4% of the fund's total portfolio, but I'm concerned about reports that the CEO of SVB unloaded millions of stock in the days and weeks leading to the collapse. I know that we're expecting a report on the Fed's investigation of SVB in May, but is there anything you can share today regarding the bank's executive management? Okay, thank you, and thank you, Mr. Chairman.
If the panel would respond in writing to Mrs. Beatty. We'll now recognize the gentleman from Oklahoma, Mr. Lucas, for 5 minutes.
Thank you, Mr. Chairman,
SVB.
for holding this important hearing. And Chairman Grunberg,
Initial ASIMs?
I'd like to discuss, and I know my colleague, Congressman Williams, Chairman of the Small Business
Takes over,
Committee,
makes all the
is
money.
focused
I
on
come
this
back
role,
and
but
lose it
I'd
for
like
him.
to discuss the special assessment fee that will be used to cover the losses from the uninsured deposits. You've explained the proposed rulemaking for the special assessment will occur in May of this year. And while you're thinking about that, be thinking about a discussion of the flexibility the FDIC has during the rulemaking to ensure that our small
Initialisms.
community banks don't disproportionately carry the burden.
Birds.
Being one of the
28
older
cents,
members
up
of this
44%.
committee, I've been around long enough to
See what we get
have
at 30
observed
cents.
firsthand several banking
Eva
crises.
Toll.
1982,
Getting kind of spiky again here, over
getting ready for
$2.
my final semester at Oklahoma State, when a little
Have to watch this
institution in
one.
Oklahoma City called Penn Square went down, and took First Continental Illinois of Chicago down with it, a bank from the 1840s or 50s. Took First Seattle down with them too. Now, FDIC and the regulators responded in the appropriate fashion and addressed that. But it was a combination of collapse in the oil and gas industry and in production agriculture. And the chain reaction in my great state was the slaughter of
Acronyms where you
community
don't
banks.
say like a word.
The slaughter. There was no quarter given to those folks.
Initialism.
They were locked up, chopped up, sold
Never
out.
heard of that word.
The legislature met in the middle of the night to authorize not just one town, one physical location, one charter banking, but we went to branch banking because it was all falling
Birds
down on
breaking
us.
out a bit.
The people who I represent were brand new young banking men and women 40 years ago when they saw how community banks were handled in my state. They weren't Penn Square, they weren't First Continental, they weren't Seafirst. They're now my most senior bankers 40 years later. And they're looking at this situation and they're
Eva
saying
Toll.
to me,
Parabolic over $2. Where's the S3
we've
guy?
been
You
the
can
least problematic
Get on the news.
of any sector in the financial services industry for decades to the regulators and the FDIC. But yet, in every crisis since then, we've
Yours
been
is up
kind of the orphans.
44%.
And this time they're
Crazy.
saying, we were wiped out as an industry 40 years ago, but now we're going to get a special assessment to pay to fund for the mistakes of the most sophisticated institutions, the biggest institutions. Can you tell me how it's possible when this special assessment fee process is completed,
Silvergate down 7.2.
my community bankers aren't going to wind up disproportionately paying
Give me 1 1/4.
the mistakes and the falderall of the biggest institutions in the country? Or are they just be prepared to be the goat one more time?
Critically important question, Congressman, keenly sensitive to it. We have discretion under the law. We have to act pursuant to a notice and comment rulemaking. Anything we put out will be subject to public comment. But we have discretion, as I indicated earlier, and will repeat.
Spy
we'll be
moving up
keenly
here.
sensitive to the impact on community. I don't want to front run my board. We're going to have to do a notice and comment rulemaking, but I hear you and keenly sensitive to the point you raised.
I would just offer once again the observation. The perspective of my community bankers is, if you're big enough, we've now given you an emphatic protection. It appears with what we've done in the last few months, if you're in that intermediate range, we're going to protect you. But if you're the little bankers, the little guys and ladies out there meeting the day-to-day capital needs, you're going to be the one to pick up the bill. And I kind of appreciate their point, having lived through 40 years of these experiences in my great state. Shifting to another question. As has been discussed today, Treasury approved the systematic risk designation on March 12th. Upon the recommendation of the Federal
29
Reserve
cents,
and
almost
FDIC.
30. That's a big
I want to
level.
discuss for a little bit the process leading up to this.
Probably a
I
good
think
take
it's
profit
important
level.
that we have a clear picture of how the regulators made this designation, and not just in theory, but in practice. So,
I don't have shares, so
Vice Chair Barr, could you provide insight into which regulator acted first in proposing that uninsured deposits be protected?
Shares
These are the
would've
kind of
made
questions
sense.
I'm getting back home.
I was hoping there'd be more
And were
liquidity on
there-
these options with this
While you're
pump.
thinking about that, were there discussions between the FDIC and Fed prior to the respective board meetings?
I see my time has expired, but I'm happy to follow up with you.
Well, you can go ahead and answer it. I'm
bet
kind of-
somebody
I'm
will
really
give you
heightened
time.
right now and interested. Plus, we're close to getting a little break here, so.
I'm happy to. So
Please, thank you.
We were in conversations, all three agencies, over the course of that weekend, trying to think through what the potential ramifications might be in the financial system. It was a very difficult judgment to make. It involves, of course, information we're getting from around the system, from hearing from community
If
bankers.
the gentleman will give a timeline of those conversations between the two agencies and the two principals of the FDIC and the Fed for a written statement. Gentleman's time has expired. We'll now go to Mr. Vargas of California for
Chairman.
5 minutes.
Thank you very much, Mr. Chairman, the ranking member. I guess I'm looking at this a little bit differently, and that is, we could have been here today looking at the collapse of hundreds of banks. We could have been here today trying to figure out how to stop the contagion. But instead,
that volume,
we're here looking at significant banks with significant
volume
problems.
and EBTL.
I think that that's important.
Pushing it down
But
below
I think
2,
what's
man.
more important is that everyone work together. We certainly have our
Make it wild.
ideological differences, and they're significant. I mean, I heard right away it was Biden's fault, from some members, and I could easily say it was, hell no, it was Trump's fault. But the truth of the matter is that, we're out of our ideological silos and trying to figure out practical solutions. I want to thank the chair. I think the chair worked very, very hard on this, and I think that he probably was a little uncomfortable.
I jump out of my
with his,
shorts.
Ideologues on his side, maybe, but I think he did a fabulous job, and I want to thank him publicly.
We'll see.
I think the ranking member did the same. I think they worked very, very closely together to try to figure
29,
out,
you might be in front run on that 30-cent
as a legislature
sell.
to make sure that there's not contagion. I want to thank all of you. I think all of you acted very honorably, nobly as you should have, to try to figure out what's the solution here. And again, I appreciate that deeply. Again, we could be here talking about a disaster, an unmitigated disaster. I was worried about that.
Yeah, you can email them, try.
I worry about these things, and we're not. Instead, we're looking at these important issues. So now that we are, and I got that off my chest, I do want to ask you, Mr. Barr.
We were assuming for
quoted
quarters after quarters
quite extensively
on DRS, just
saying-
based on the bot. So
Get it correctly here. I don't want to put words in your mouth. To begin, SVB's failure is a textbook case of mismanagement. Was that a correct quote?
Yes.
Well, then why, the natural question is,
that gas is moving.
why wasn't there a textbook case of enforcement?
I think that's a good question, one we're exploring very much. The supervisors looking at the bank identified the problems with the bank. And the question is, did they identify them with enough level of urgency? Did they escalate appropriately? And And I think that's what is an incredibly fair question we're looking at carefully. I expect that we're going to find that we need to have more of an emphasis on supervisors using the tools they have more promptly and putting in mitigants in place more promptly when they see problems at banks that they're supervising.
Yeah, in fact, they had a number of MRAs, MRIAs, I guess, and it didn't seem like you did anything other than write a letter. I mean, it didn't seem like there was any enforcement. I mean, where was the stick?
Yes, I think that's exactly the right question. Normally, in the supervisory process, when a supervisor issues an MRA or an MRIA, the bank promptly takes care of those matters. In this case, obviously, it didn't take care of them in such a way that it prevented its
It seems like they blew you off. I mean, it seems like they blew you guys off and you didn't do anything. I mean, that's what it seems like for reading all this information. I can tell you, maybe I'm wrong, but that's what it sounds like.
Yeah, I think that, again, we're looking at the whole supervisory record. I share your concern very much. I think it's something we're going to have to explore both in terms of the way the bank responded and the bank's responsibility for its failure, but also should regulators have used tools to escalate more promptly and quickly? I think that's a completely fair question.
Okay. Chairman Bloomberg, in your hearing before the Senate Banking Committee, you testified that the collapse of SVB and Signature Bank demonstrate the implications that banks with assets over $100 billion can have financial stability issues. I think that's what you were quoted. Additionally, you stated that the prudential regulation of these institutions merits serious attention, particularly for capital liquidity and interest rates hike. Can you please elaborate more about what prudential regulations need to be reviewed? What steps can we take to mitigate the potential for similar bank failures?
Thank you, Congressman. Look, I think we should start with supervision and how
maybe
we
a divergence
supervise
here on the
liquidity
SPY.
risk. And two big things
how today
in
and
this
tomorrow
episode
close.
was liquidity risk from concentration of uninsured deposits and the
We need
accumulation
to
of
rip
unrealized
up above
losses
402 for this
on
to
the balance sheets
go
of our
away, probably.
institutions, both of which go to fundamental management of interest rate risk, which is
Right, but the size, I'm talking about the size of the bank. I think that's significant.
And I think it applies to all institutions. I think in the past, we've looked at these regional banks and smaller regional banks, and in terms of their prudential regulation, have treated them somewhat more lightly than the larger institutions.
My time is
in light of this episode, we need to take a close look at that.
Thank you.
That was the point I was trying to make.
Well, with the wind-up that Mr. Vargas gave, I just want to give him like 10 more minutes, so thank you. With that, we'll now recognize Mr. Loudermilk of Georgia for 5 minutes.
Well, thank you, Mr. Chairman. Thank you all for being here. I know you've been spending a good bit of time on Capitol Hill, but we appreciate you being here. One of the concerns that I've received from a lot of my smaller institutions, smaller banks, is with the extension of insuring deposits across the board, they felt vulnerable in that larger institutions may decide to pull deposits that they have in the smaller institutions because then they would be covered. Under Secretary Lang, I wanted to get a little clarity on what seems like is conflicting accounts from Secretary Yellen regarding deposit insurance. Now, on Tuesday, March 21st, the Secretary suggested deposits would be insured. She said, quote, if smaller institutions suffer deposit runs that pose the risk of contagion, then that was the end quote, then during her testimony to the Senate Finance Committee the very next day, the Secretary said she was not considering, quote, blanket insurance or guarantees of deposits. But then a day later, she said that Treasury, quote, would be prepared to take additional actions to protect depositors if warranted. Could you clarify the Department of Treasury's position regarding deposit insurance?
Yes, thank you, Congressman. As Secretary Yellen has said, we have used tools to prevent contagion in the banking system and have reflected a commitment to ensure that all deposits are safe. And that means we would use the tools again, if needed, to ensure that Americans' deposits are safe.
So your answer is yes, you would include smaller institutions, smaller banks, community banks, or, I mean, I'm a little confused.
If conditions warranted, deposits that smaller institutions could pose a risk of contagion to the broader system, we would absolutely use the tools.
So I guess the question would be then, what is that condition? If it starts with one community bank, then that would be a trigger, or do you have more definition of what would be the condition?
I don't
I think
think
it's
the
very
HKD.
difficult to just make decisions on the hypothetical.
Well, it is blowing up though.
In this environment, that we
13%
make
HKD.
systemic risk determinations based on unanimous approvals
Hit
from
all the way
the
to 6.7.
FDIC and the Fed. We determined that the risk of contagion in the banking system was very high.
So
I don't think
with
that's
that,
necessarily
and
showing a front
the
run
action
on
of extending it to larger
anything else running.
institutions, regional banks, and then smaller institutions.
18%.
Do you have
Explodes so
concerns
fast.
that regulators may be creating moral hazard across the
20%.
entire banking system?
I think we are concerned with addressing the current situation that we are facing. We think the system has stabilized. We have information and evidence that deposits have stabilized. We will need to address reforms going
25%.
forward to address concerns about moral hazard.
Okay. And I agree with you. I think that we're stable at this point, but as we've seen already, things can turn around in a 24-hour period, right? And I am one of those
we'll
that,
see.
you know, from raising 3 young children and now with 5 grandchildren, consequences matter in future behavior, and we can't ignore that going forward. Last question. Why did the Secretary's position
The average brought down to 49 million?
appear to change regarding the extending insurance to
Gap's still 1.5
various,
billion on this
to smaller institutions? Why did she change her position between the 21st and 23rd? Were there internal discussions going on between the Secretary and the President or other prudential regulators that caused the shift?
I'm not aware of any conversations.
Football going.
Well, I appreciate that.
That's exciting. Maybe it will.
Mr. Chair, no further questions at this time, and I yield back.
Eva told just over $2.
Mr. Casson of Illinois is recognized for 5 minutes, and after this end
Volume
of
average
the
brought down to
series,
49 million.
sorry, let me restate this. After these 5 minutes, we'll give the panel a little 5-minute break, stretch your legs, then we'll come back in and we'll finish with questioning. My expectation is that then we'll be able to get through this final segment, but I do think it's humane to actually give a panel this bit of break, and frankly, I need one as well. So, Mr. Caston, 5 minutes.
I'd like to thank the chairman for putting me on the inhumane end of that transaction. Vice Chair Barr, I'm trying to understand the calendar, and I've got just 4 or 5 questions for you, and I want to walk through the calendar as I understand it. If you disagree with anything I've got in the calendar, let me know. But otherwise, I'll just try to run through quickly to get to the questions. January 2019, SVB is notified by the Fed of deficient risk management. A year later, they're notified that their risk management is not up to large bank standards. About 2 years after that, April 22 to 23, SVB no longer has a risk officer, but in their 2023 proxy statements, they say that they have doubled the number of risk meetings from 9 to 18. Given the prior concerns from the Fed, did the Fed participate in or otherwise have visibility into any of those risk meetings at SVB in that window?
The calendar you described, the dates didn't, they are some of them in the future. I think that we might need to look at the calendar reconciliation together, or maybe I misheard.
No, I'm just going up to January of this year was the last date. From April of 22 to January of 23, there was no risk officer, but a doubled frequency. Did the Fed participate in any of those risk meetings within SVB during that 9-month period?
I don't have yet the full supervisory record, so I'm not able to answer the question, but we will have that information in the May 1st.
Okay. Do you know if they were at any time cited for violating Section 165 of Dodd-Frank that requires banks over $50 billion to have a risk officer for the 9-month period when they did not?
The deficiency downgrade that occurred in the summer of 2022 focused on a wide range of risk management practices at the firm and found them to be deficient.
Okay. Moving back to the calendar, Q3 of 2022, their 10Q showed that their held-to-security bonds were $15.9 billion undervalued relative to mark-to-market, and they had $15.8 billion in equity at the time. 3 months later, their 10K for the year showed a slight improvement. They only had a $15.1 billion overvaluation of their bonds and $16.3 billion in equity. Was it perceived by the Fed or by management that they were in an improved risk situation at the end of 2023 than they were 3 months earlier?
I don't know the answer to the question with respect to how the management of the firm were viewing the situation. The supervisors were telling the firm at that time that basically their risk models were divorced from reality, that the models suggested they'd earn more money when they were losing more money.
Okay, I'm glad to hear that, because now I want to move to 2023 and sort of what happened up to March 8th. January 26, 2023, about 3 weeks after they finally got a risk officer back, CEO Becker announced that he was going to execute $3.6 million in stock sales. February 22nd, he executed those sales. March 8th of 2023, he announced a sale of all of their available to sell equity portfolio to Goldman. The same day was disclosed the $1.8 billion loss of a security sale, apparently also to Goldman. Heads, Goldman wins. Tails, Goldman wins. And of course, the next day, a $42 billion withdrawal. Do you have any visibility? When was the security sale and or the equity sale to Goldman process initiated?
Yeah,
In other words, when was it announced?
I know I've heard it before.
When
Charts I've seen have
internally
been
was the company initiating the process to secure
not too impressed with.
additional cash from those two Goldman processes?
I do not know the answer to that question.
I imagine you probably also don't know whether the January 26th sale was cleared with their risk officer, who had been on board for 3 weeks when the January 26th announcement was.
I don't yet have full visibility into that transaction. I hope that we'll be able to get as much detail as we can as part of our review.
Okay. Do you know, if I'm Becker, I'm obviously in a lot of trouble. You've got a deposit base that is extremely well-heeled and very sophisticated. Was there any outreach to the depositors during this period to ask them either to provide equity infusions to the bank or other forms of capital prior to the run of the bank?
I do not know.
Last question, in the exchange with Mr. Scott, you had indicated that and I think I got this right, that the Board of Governors' concerns about SVB were really heightened in mid-February?
What I said is that the staff presented to the Federal Reserve Board of Governors in mid-February on interest rate risk generally, and one of the firms they highlighted as having interest rate risk was Silicon Valley Bank. And the staff indicated that they were doing a further horizontal review and would come back with further results of that review.
Okay, so is it your position that the trigger for the heightened security was simply interest rate movement, or was it anything else about this calendar that triggered that heightened concern?
It drives me.
I didn't describe it as heightened concern.
Yeah, you're watching it right here.
The staff were presenting on interest rate broadly, and the firm they singled out as having interest rate risk was Silicon Valley Bank, and they discussed the horizontal review they were doing and the fact they'd come back with further information after that horizontal review.
Okay, thank you. I yield back.
Is he supervision? Okay. We'll now stand in recess. Committee stands in recess for 5 minutes.
Yeah, they had a nice run
Restoration
there in
Hardware, that's
2020, 2021.
super
but
profitable
the
company.
data's been sort of sideways or moving down a little bit. The stock has finally, I guess, caught up to that. It's down around 240 now. It's been in this sort of 240 to 340 channel for about a year, and it's at the bottom of that. So, value plays may think about getting in here. But based on the data that we're seeing from all of this, I would say maybe lean away from it. Not hardcore. I mean, we've got an earnings score of -5 going into their earnings, so we're not hardcore bearish. I think longer term the trends are going to hurt them more than anything. So I'm not a buyer here at 240, even though it's low. PE ratio is only 9. I mean, if you look at their last earnings report, revenue is down like 14%. Their income was down 46%, and I think a lot of that had to do with their margins coming down from 18 to 11. That's a big hit, and a lot of it has to do with just the cost of goods sold and labor. So they're in a tough spot right now. And I don't love them
you're talking
moving
about
forward.
HKD
I mean,
or what?
I hear the argument that they're at the bottom of this, price channel, but and a low
you
PE
make
ratio
to the
if you want to go
bathroom?
value play. But I'd wait until the earnings report is out because I don't see them surprising to the upside.
Landon, Alex Coffey has called me a serial optimist, and I'm going to prove him right with this statement right now. Your consumer purchase intent mentions. You're right. That chart looks ugly, but the last bit of that chart is heading higher, Landon. So it looks like it may have bottomed here and starting higher. And you've got a stock with very little float that has come down from $744 to in the 240s. So I get that there's a lot of problems, but this is not, you can't think of this of RH as a furniture store anymore. It's a lifestyle. It's luxury lifestyle. They sell, yacht rentals and guest houses and fine dining. The restaurants and their places
Yacht
now.
rentals?
They're changing themselves. And here's the reason that our viewers should watch this.
Yeah, a little drop
Here's
in
the
Evital.
stat that really jumps out at me. The 5-year
See if it
average
bounced
for
on
PE
VWAP.
is a 40. The 3-year average for PE is a 30. It's currently trading a 9 PE. And
it's the
Tom,
same. It's under
they've
indicators.
got one of the lowest floats.
It's not here.
Of
You
any
just clicked
stock
on
we have.
indicators.
22 million shares
Scroll
only.
down to it.
Landon, your thoughts?
Yeah, I mean, I get it. It's very cheap right now. When I look at the data, I'm thinking about this earnings report. Are they going to come out and blow out the numbers? And then it doesn't take much, right? You're talking about low flow. It doesn't take much institutional interest to make this thing really go, but it needs a spark. And just from the data that we're looking at, I don't see a spark.
Wow,
Even
this
when we
thing's
look
really
at
come down a lot.
the website visits, those are down about 14% on a year-over-year basis. So just going to rh.com, we've got that data, and it's not great. So I think it really comes down to what's priced in, what do investors already know, and if it's, if they come out with a report as I would
HKD's
expect,
holding up
that
really well above VWAP.
things are off a little bit. But
Evital
we're
with a
not
little
getting
bounce there to
killed.
$2
We might have the bottom
$2.
soon, and there's a little bit of optimism, based on the end of that purchase intent chart, just like you talked about. Then
BBBY
maybe you could
still
get
under
something.
VWAP.
I don't see them coming out and saying,
down 1.5.
surprise, we crushed it. Everything's amazing. And the stock
SI
rallies,
down 10 now.
30, 40, 50%. I don't see that happening. But for the long-term investor,
This kind of
I think
next support level is
they do
180
need the
area.
spark. But you make a great point, Kevin, that when it does happen, if institutional investors start coming in and they have a
Head and
lot of
shoulder?
money, and a lot of money affects a small float very drastically. So when that
What are you
happens,
talking about, head
it
and
could
shoulder
really run. I
on
just
Evital?
don't see the evidence that it's going to happen on this earnings report.
Now, I'll switch it back to, I'll go along with Kevin here. I kind of like this.
Whoa.
Because we saw it at Lululemon already after their earnings. The affluent consumer doesn't care about, spending at this point.
RSI
And
makes
that's
you upset?
Basically, you can say RH, there's probably 5-10% of the population that can afford this stuff. It's ridiculous. But your happiness levels are really elevated on this. So it only takes that affluent consumer, right, Landon, that still has a job, that's still out there spending, supporting the economy, that could turn this, right?
Yeah, I think you're right. I mean, if there's one group that's not affected as much by the economy and the interest rates, it is the affluent consumer, just like I talked about. I mean, they're still the ones that might buy a $2 or $3 million home with cash and they don't care about
moving
the
up a
interest
little
rates.
bit.
And then they're gonna fill
have
it with
it.
restoration hardware furniture.
Ow.
So
Blue Owl Capital.
I
Is this
agree
you?
that they've got
This is your
the
capital
consumer
company,
base
isn't it?
that may be the most resilient.
This is your company,
through
your
all
asset
of this, and
management
they're
firm.
not getting hit nearly as
This is
hard
yours
as a
at Blue
lot
Owl.
of other people.
Definitely not gonna
So
invest with you.
I get
Your
that
SPY
argument.
picks have been awful.
The data doesn't bear it out yet, but the data
that why you
definitely
picked the
doesn't
Blue
say
Owl?
that this company is headed down and it's going to be
It's now
crash and
reddish.
burn. I mean, there's nothing really strongly negative about it. That's why it's coming in at -5.
You say that? You
It's-
never
it's
looked for
just
Blue
a
Owl?
pretty neutral
Please.
earnings score. So You know, if you're
Please.
thinking about getting long, one strategy I might consider is selling puts. I
right,
don't
good-
see them selling
good
off
hanging out,
big here. I
Ace.
don't see them running up big here. I'm not sure what the premium looks like if there's a lot of juice in there to take advantage of. But that's one thing I may consider. But I'll leave that up to you guys to analyze this trade. But I don't think they're going to surprise in either direction on this report. And long term, I do think they're cheap. I'm just waiting for that spark, and the data doesn't say it's here just yet.
Got it. Great data. As always, Landon, we really appreciate your thoughts here on these companies that you guys cover. Much appreciated. Have a good day.
Thank you, you too.
All right, that's Landon Swan, co-founder of LikeFolio.com.
Stop looking
giving
at me,
us
Swan.
basically a neutral stance on this stock, Kevin. But we all know, that 22 million share float
Birds
can
45,
influence.
HKD
And
still up
remember,
above
it's still a
VWAP.
$243 stock at this point.
It's all holding
And
too.
as I mentioned, leading into this, if you look at the chart of this, it's down
we've got
19%
GME
for the
announcement,
month.
20 minutes, guys.
Year-to-date change down 9%, down 37% from year-ago levels. So
The
it's
apes
already
going
seen a
crazy.
big downturn. How do you want to look at this from an example trade?
So, yes, I think that the way to play this is something we've done in the past. This is an example trade using paper money. But what I did here, Tom, was look at something a little more complex than, if you watch the show, it's not more complex than we do. So what I did, Tom, I did the 1 week, $260 call calendar, which is right in line with the expected move. And then I used that, I financed that by selling the March 31st, 220, 215 put vertical. And so this was trading about even money a short time ago. It's up to about 40 cents now, debit, but a very low net debit on this trade. Why? Because you've got the $500 margin is the width of the put vertical. That's the margin on the trade. You can see the net debit is less than $0.50. It's somewhere between even and $0.50,
right,
Tom. But this is a trade that gives you a chance that if you're wrong and nothing happens, right, you still do okay, but you're looking for an upside move here, Tom.
Right.
Jimmy has their
let's break this trade
NFT
down. 4
announcement.
legs on it.
Something
Buying a
new in
1
their
week
NFT
wide call
space
calendar on the upside,
at
the
1 o'clock.
260 strike, buying the April 6 weekly options that expire in 8 days. Remember, we're closed on the 7th, Friday, right?
It's a less. There's only 8 days till the next expiration. 2 days from this one, you would think it's 9. It's only 8.
Yep. Selling the March 31st, same strike, the 260 call, and then against that to help finance the purchase of that call calendar. You sell the March 31st weekly 220, 215 put vertical. So you collect a credit on that, which reduces it. Now, we've got it in here at 0 debit,
Right.
so basically
It's
even
moved
money.
up a little since then.
Yeah, moved up, 20, 30 cents here. That takes your risk down to $500, and that's below the 215 strike, Kev. Everything on the upside, if you pay even money, is profitable. You won't make any money if it spikes up to 300, right? Because you'll lose a little bit on it. You've got some assignment risk on your short 220 put and your short 260 call that expire in just 2 days, so you have to keep that in mind. But this takes advantage of grind higher, and with the stock basically trading about 243 at this point now, even if it does nothing and stays right here, Kevin, you have that potential to remain profitable because it's above your short put vertical, and you might have that ability to close that call calendar if the market's open, liquidity is provided for a little bit more than what the spreads are worth at this point. But a good look at taking 2 different strategies,
I'm not talking about
combining
XRP,
them
no.
into one theme here. If your
it is.
assumption is that stock's going to maybe grind higher or at least remain where it is into expiration. That
HKD
break-even
drop
point's
down.
about just below 220 also, where you start
Setting
losing
up an
on this
engulfing
type of
candle
position.
here.
So keep that in mind. All right, great look at that example trade based on some of the data here from LikeFolio. But coming up after the break, we're going to take a look at another retailer, and that's Home Depot, which has slid about 10% so far this year,
There's a
despite
red candle
improving
on
housing data.
HKD.
Fast Market's coming right back.
Home of the pot. Put it all into Blue Owl Capital after I buy Lovesac. You've got it figured out, man. Certainly do. These guys have been gone more than 5 minutes. You probably should give up on your tinfoil theory. Before end of, I mean, now you're giving yourself like 2 extra days. I mean, yeah. And what's a move up entail? GME kind of flushing down with little spy. Alright, got the engulfing candle there. Try this again. And baby squeezes love sex all around. Where to Google love sex? You probably shouldn't Google that. Moves in sympathy. Hey, I say moves in sympathy. There you go. See, another one. Another one that believes the HKD theory. Might I interest you in some HKD? Yeah, both Ryans with these ridiculous thoughts about HKD. And its sympathy. Evital flush. Down to VWAP. Below VWAP. Good volume though. I mean, it's sell volume, but volume staying elevated. Probably a good sign. Yeah, today's volume's good. So I'm in it for a longer sustained rally.
The committee will come to order. The chair now
13%,
recognizes Mr. Rose for 5 minutes.
Thank you. Before I get into my questions, Chair Grunberg, I'd like to say that as you consider any new special assessment on banks to replenish the deposit insurance fund, that you use your special exemptive authority in implementing that assessment to ensure that Tennessee bankers, and frankly bankers in a number of other states across the country, are not paying
I don't think the
for
stock
the
will
mistakes
react at all.
of California and New York bankers, serving
Unless if it's some
wealthy
crazy bullish
real
news.
estate moguls and tech-related venture capitalists.
I don't
Tennessee
think it'll
bankers
drop from it.
understand how to manage
It's just
risks and
ridiculous.
should not be punished for the mistakes of those in our coastal banks. Now I'd like to jump right into my questions as time is limited. Chair Grunberg, the value of First Citizens Bank is up over 50% over just the last 5 days, and
I don't even
is
know.
still
Do I look
rising.
on their Twitter to
Shareholders have
get the
benefited
announcement?
by $3 billion by last calculation. Chair Grunberg, why did the FDIC cap its potential gain on First Citizens stock at $500 million?
I think it was a negotiation, Congressman, and that's what we were
So
able
I entered
to,
some shorts up here on this engulfing candle.
And so why not allow the federal government to recoup more of its losses? Why not and share in this outsized gain at First Citizens?
I wouldn't argue with that, but we had a negotiation with the acquiring institution, and that's what we came out.
Okay. You think you had good negotiators at the table?
Maybe we could have been better. I don't know.
Okay. And Chair Grunberg, did you receive any pressure from the White House or other elected officials not to allow for consolidation of large or mid-sized banks with Silicon Valley Bank as part of the review process of potential bidders?
No, Congressman.
Okay. Vice Chair Barr, as you know, as committee members, we have been undergoing a series of briefings with regulators, both at the state and federal level, on these bank failures. Earlier this week, I learned that the California banking regulators were conducting their
Just on their
examinations
Twitter. I don't know. Are they
of
gonna tweet it?
SVB
It's gonna be on-
remotely. Vice Chair Barr, can you tell us whether or not the
Marketplace?
Fed was also conducting its examinations remotely or on-site and in person?
My understanding is that
Keep the
there's a
website
mix
open, I
of
guess,
activities. I don't know how
nft.gamestop.com.
much was on site. A lot of activity occurs remotely, doing analytical work and so on, but I don't have a precise answer to that question.
I hope you will provide that answer to us. As a former bank board member, I know there's nothing that strikes fear in the hearts of a banker more than an on-site review, and maybe for good reason and perhaps more effective. So we would like to know, I'd like to personally know the answer
There's
to
a
that
few
question
games on
as you
here now with
conduct
the
your review.
Cureverse,
You said
zombie
earlier,
one.
and I think reaffirmed your quote, that this was a textbook case of mismanagement. I hope that you will conduct the thorough review to decide whether the oversight by the Fed examiners was being done in the way that it should, and that the escalation of that up to the through your process was appropriate, and that you will take appropriate actions. It seems to me, and I'll just say that again, based on my personal firsthand experience, that you have the tools you need, and the question is, were they being used effectively? And I hope that in the days ahead, weeks ahead, we get to the answer for that question. Under Secretary Liang, earlier my colleague, Mr. Loudermilk, was questioning you about some of the comments of Secretary Yellen. And I guess I'm still a little bit confused
SLGG
because
moving
I
up
think
20%.
what I'm hearing both from the Secretary and maybe
bouncing on
from
VWAP.
you is that if it's a
little bounce.
systemically important bank that's failing, that there's going to be perhaps a more strident effort to make sure that no one loses. But if it's a less significant bank, like maybe the one that I was director at, that perhaps
Silvergate with the bounce.
the concern won't be as high. And can you clear that up for me, and am I mishearing what you and the Secretary are saying?
Yes, Congressman. The point that we've been making is that we would use the systemic risk exception or our and tools to prevent contagion in the broader system if a bank were to fail. And that could be a bank of different sizes, and it would be designed to keep all American depositors.
Little bear trap here, false breakout
You
to downside.
understand, no doubt, the
I don't
confusion
know.
that these
GME
statements
is
leave
pricing
some of
in
us with. And so I just
this
wonder, do you have
announcement
confidence
already
in
to the
Secretary
downside.
Yellen at this stage?
Absolutely.
And so, as
Where are
I
we supposed
think
to be looking
about
for it?
what I've heard today earlier,
Website?
Al Green, I know it's not a quote of my mother, but it's a quote
Twitter?
I heard often, is that it doesn't just have to be right, it has to look right. And so as I leave you, gentlemen and ladies, this afternoon, I would just say the American people are watching, and I think right now we have grave concerns about whether the regulatory process looks right. And so I hope
The
you
zombie
take
game
that
looks
to
kinda
heart
fun,
as
Undead
you
Blocks.
conduct the review of what you're doing. I don't think, my personal conviction is that you don't need new tools, that you need better craftsmen using those
Cureverse
tools
isn't
to accomplish the
PvP
purposes
though, is
that
it? It's
you
all
have.
just
And so I commend that to you.
first person,
Again,
or-
as a former bank board member,
Yeah.
I feel like if Silicon Valley Bank had the supervision that I feel like our bank got, that we wouldn't be here today talking about this. Thank you, and I yield back.
The gentleman yields. The gentleman from New
Jimmy
Jersey,
on
Mr.
Twitter,
Gottheimer,
yeah.
is recognized.
Right on the
Mr.
website,
Chairman
too.
and Ranking Member Waters. The conditions at Silicon Valley Bank in the months leading up to its failure set the stage for a classic run on the bank. What was not typical of the situation, though, was the speed and intensity of the run, as we've talked about. Depositors driven by panic on social media platforms and armed with online banking tools capable of rapidly moving
Hey, I
large
care,
sums of
Ryan.
money.
I
Withdrew
care.
nearly $42 billion in deposits within 24
calls
hours
for it.
on the 9th of March. Under Secretary Lang, do you think social media and online banking tools have the potential to increase the intensity of future runs? And if so, what do you think the appropriate response from Treasury, Congress, and regulators should be?
Congressman, I do agree that the runs
Her
that
voice
occurred
sounds
at
so much
Silicon
younger than she
Valley
looks.
were unprecedented in speed and size, aided by social media technology. Those are new risks that challenge the banking system and the financial system, and are those that we'll definitely need to be considering and working with Congress on those issues.
So you're working on that?
We, yes, there is.
Yeah, it might be an
we've been
energy drop.
working
I'm kidding.
How to think about the payment system, how to think about fintech and digital assets, and this has now also become apparent. in
Thanks.
the
I'd like to
banking
work with you on that, if that's okay. I'll follow up. Thank you. Some members of Congress are using the failures of Silicon Valley's bank management
Did they
and
ever
bank
get their chess
supervisors to
pieces
criticize the bipartisan
in the actual
2018
Immortal
amendment
game?
to Dodd-Frank that ended the one-size-fits-all approach
I played the
to
chess,
bank regulation.
and it just showed
before Dodd-Frank, we had a system
standard
too
chess
big to
piece. It wasn't
fail. We
the-
don't want a system, in my opinion,
wasn't
where
the
banks are
NFTs.
too small to succeed. Those that
No
say
graphics.
Congress eliminated
Like what?
annual stress tests and other prudential safeguards need to read the bill again. The bill tasked the Federal Reserve with crafting rules for banks like SVB with more than $100 billion in assets. And Section 104 of the 2018 amendment to Dodd-Frank says clearly, quote, the Board of Governors may, by order or rule, apply any prudential standard established under
Afternoon,
this
big
section
hugs.
to any bank holding company with assets equal to or greater than $100 billion. If
add
the
to
Board
my
of
short
Governors
here.
determines the prudential standards is appropriate to mitigate risks in the banking system and promote safety and soundness. End quote. The Federal Reserve could and should have applied annual stress tests to banks like SVB, but it chose not to. While stress tests are an important component, it's clear that the existing Fed supervisory tools are equally, if not more important. During a Senate Finance Committee hearing earlier this month, Treasury Secretary Yellen was asked about supervisory stress tests, and her response was, quote, supervisory stress tests focus on capital and not on liquidity. In these bank failures, liquidity played an important role. When Secretary Yellen was asked whether stress tests would expose management failures at banks, she replied that, quote, that's the purpose of supervision, concluding that supervision is critical. Vice Chair Barr, do you agree with comments made by Secretary Yellen that supervision is critical to identifying the failures of bank management? And there was clearly there was a huge hole in Fed supervision of SVB. Can you talk about that a little bit, please?
I think supervision and regulation both play an important role in overseeing bank management. And obviously, in the first instance and in the last instance, it's bank management that's responsible for running the bank. And in this case, it did it in a way that caused its failure. We are taking a careful look
the customer's
at
always
role of
fitting the bill for their
supervision and
wages, right?
regulation and not forcing managers to do a better job in running their own bank.
So they're paying the company for the
Digging in
service.
a little bit more, the Wall Street Journal reported that the Fed had concerns about the risk management
tipping.
practices at SVB as early as 2019.
But yeah,
You admitted in your
I can see why
testimony
it'd be
that the Fed
unusual
knew
since
that there were
it's not
issues
really
at
done in
SVB
Europe.
for years and only started a more in-depth review in February 2023, which I worry was too little too late. When exactly
I mean,
does
it's
the Fed
consistent
give
enough here to where
supervisory
you do
reviews
get an
more
average on
muscle
how much you
to
make.
step in to prevent disaster? And can you talk a little bit more about what happened here and what you're trying to learn? Thanks.
Thank you. A great series of questions. You know, the Federal Reserve's system of supervision and regulation is based on a tailored approach where firms between 50 and 100 billion are really part of the regional banking organization group. Firms 100 billion and above are in the large and foreign banking organization and group. And even within that, there are distinctions between firms at 100 to 250 and 250
4 minutes,
above.
GME.
And I think part of the problem is that that framework, which really focuses on asset size, is not sensitive to the kinds of problems we saw here with respect to rapid growth and a concentrated business model. That's one of the reasons why, you know, earlier this year I announced that we were going to have a novel supervision group that really focuses on these kinds of issues.
So to that point, do you think, you said yesterday before the Senate that the Federal Reserve has broad authority to apply additional prudential standards to banks with more than 100 billion in assets like Silicon Valley Bank. Is this a situation where the Fed needs different authorities, or has the Fed simply chosen not to use the authorities given by Congress? Like where should you be jumping in?
We're going to look at our own framework, our own supervision, our own regulation. I think that self-assessment is really a critical part of risk management. As I mentioned earlier, we have a team of staff working on it who are not responsible for
That's a good point, Dick.
supervising SVB. We're going to
Your
look at our
work.
own structure and
directly
suggest
get paid.
reforms.
Thank you. I yield back.
In relation to how
Gentleman yields. The
good your
gentleman from
service
South
is.
Carolina, Mr. Norman's recognized.
Well, thank each of you for testifying today. Let me ask a very simple question. You know, we had a $209 billion bank in assets.
You're bad at being
Have
a waiter.
total meltdown
tip as
from
much.
March 8th through March 26th. 18 days, you had a bank basically, from all outward appearances, was strong to the taxpayer, to the investor. And over those 18 days, it was a meltdown. Now, the warning signs that have been mentioned at this hearing, like the 6 citations, like the absence of a chief risk officer for 8 months, like the deficient
Talking about a
government
virtual
control,
mall.
the signals
I
were
don't
there
think
for
that
a
would be
bank
very
that's in
good
trouble.
news.
I didn't, when the
Might be
chairman
kinda
started
cool,
it
but it's
off,
just gonna be such
I
a
didn't
novelty.
see a sense of urgency from
Big
you
hugs. Thank you for your donation.
on things to do.
No, you're number
other than
one.
We contacted staff or we contacted the immediate supervisors.
Thank you, Big
When I
Hugs.
was a
Appreciate it,
director on the
man.
bank, if one of these citations had been issued,
Getting hyped for this GME
somebody's
news.
head
Look,
would roll.
Spies already selling
We'd be
off
having
for
a
it.
conference call.
Spies
give me some assurance that I'm wrong, or I guess give me some assurance what specific actions you would take if this is duplicated. Because you had $20 million lost in the insurance fund, which the calls I'm fielding in my office are from the smaller
All right,
banks.
1 minute, no, 30 seconds.
You know, a lot of people denying the taxpayers are going to take the hit. The taxpayers are going to take the hit.
Twitter up and
at the end of the day, because they're the ones that make the profit for the banks to pay the fees to the FDIC. Give me some, what does it take to get y'all's attention and to put a sense of urgency to situations like this?
Shots fired, Norman.
I think it's an incredibly urgent situation. When we learned of the immediate distress of the firm, we stepped in and took decisive action to make sure every American's deposits are safe, and we put in place a liquidity measure to make sure that banks all across the country would have the liquidity they need
Watching the
in
stock.
case any institution were
You're talking about over the weekend when you found out on a Thursday. You're talking about over the weekend.
And
we
there's
took
1
these
o'clock.
steps. I'm talking about.
I see nothing.
Did you not get these warning signals?
Stock's
ahead of
not
time?
doing anything.
Sir, the bank supervisory staff certainly issued those warnings to the bank. The question we're looking at
Not
the
seeing
review
anything
is
on
why
their
those were not
website.
escalated in a more rapid way. I agree with you. You know, we want banks to be paying attention to supervisors, and almost every bank in the country, as you just described, if you get a letter like this, you get a series of problems like this. They had
Maybe I'll get
many,
into the
many
end of the
problems. I'm
minute.
focusing on liquidity and management and interest rate risk.
somewhere I'm not
But they had
seeing?
many other problems too.
No,
you
it's
have
not
a
gonna
bank
rocket.
like that not responding, that's a real problem.
In your role as regulators, what would you do differently for each of you?
I think I'd start with making sure that we
No, I
escalate
think it's
things
cool. I just think it's a
faster
novelty. I don't
and
think it'll
intervene more promptly
take
with
over.
respect to mitigation. But as I said, we've just started this review. I'm going to get a staff review back, and I want to really hear their expert
With
judgment.
some pictures? Where are you seeing it?
Without any preconception about what they're going to come up with.
Did they jump to conclusions on having this as a
It says
systemic
Eastern
risk?
Standard.
Pardon me?
Was it the right decision for the president to issue this, or I guess the board that voted on it,
still not
to
seeing
issue
anything.
this as a, or to deem this a systemic risk?
Oh, here we
I
go.
think it was
Here
the
it
correct
is.
judgment, sir. It was a very
California
difficult
cruise, and
judgment.
it looks like. This it? Pack your bags and get ready to explore more of G America. New locations, new adventures. Hold on, what is this? Dude. It is more pictures. That's hilarious. Wow. Yeah, they just added to their pictures. I'm assuming these are what's new. These new ones not for sale, maybe? I don't know. Are these already on there? The link just linked me to here. Yeah, it's just it's that's funny. I mean, that's what you would expect. It's on there, on the GameStop NFT Twitter page.
Guarantee the deposits of these two institutions really raises
Why would you
that
expect more
question
than that, I
up.
guess?
As I indicated in my testimony, the FDIC is
No
going to
reaction.
take a comprehensive review of our deposit
Just some more
insurance
pictures.
system. Certainly, one of the things we'll look at and identify different options for consideration is the scope of coverage and whether we should increase coverage overall or. for particular
I would like to
types of
see, I'm
accounts.
running out of time.
No.
I'd like to see those reports, if you could furnish that,
We-
as well as if
AMC's
if
going
a
down.
rerun of what happened to these two banks happens
You're talking
again,
about-
what decisive role y'all
You
would
want a halt
take
with this price
that
action?
you may have not taken earlier. I
Doesn't
yield
work
back.
like that. It has to
The
go fast.
reportedly op I made, Congressman, the reportedly op I
It has to
made.
do with velocity, not just
The
price.
gentleman yields. The gentleman from Massachusetts, Ms. Presley, is recognized.
Thank you, Chair McHenry, Ranking Member Waters, and all of our witnesses for joining us for this critical hearing. I know it's been a long morning, but that being said, I truly hope that this is the first and not the last hearing that we're going to have on these
GME moving
recent
down.
bank failures.
22
Now, when SVB collapsed in my
thereabouts
office,
would be a good bounce.
received urgent phone calls,
Buy bouncing a bit
texts, and
here.
letters from throughout our
Still
district
liking this
from our
kind of double top
constituents
area.
who were genuinely shocked
Can hold on to my
and
shorts.
afraid for their future. Affordable housing residents unsure about the status of mortgages, tech companies not able to pay
don't
their
have time to look in
employees,
the tinfoil
small
for
businesses
those new
worried that they
pictures.
had lost most of their money. Now, while I'm glad we did avoid the worst possible scenario, Congress should consider SVB collapse a wake-up call and take action. After the 2008 financial crisis, Congress stepped up to enact Dodd-Frank, a comprehensive package of regulations in order to prevent bank failures and systemic risks that hurt the economy. However, in 2018,
Bring
the
it to me, yes,
Republican
please.
majority in Congress passed a deregulation bill that stripped away crucial requirements and got rid of enhanced prudential standards. Donald Trump and Republicans, including some of my colleagues sitting in this very room, celebrated
feed me all the
signing
tin.
this dangerous piece of legislation. The 2018 deregulation law specifically made it easy for SVB and Signature Bank to engage in risky management practices with little to no oversight, and we must rightfully assign some of the responsibility for this bank turmoil to deregulation efforts. Vice Chair Barr, when Congress passed the deregulation bill in 2018, which was lobbied for by banks like SVB, is it fair to say that it reduced supervision requirements by the Fed for small and medium-sized
Yeah,
banks?
the tweet on
The overall effect of the law was for
From
the
Fortnite
the smallest banks.
did give me
to
some
reduce regulatory burden for banks within
some
50 to
hope
100
for
billion in
something cool.
range to
But
limit the Federal Reserve's discretion
no.
with respect to those institutions. But for institutions over 100 billion, the Federal Reserve retained discretion to do something different. It chose in 2019 to put in place a set of rules that I think had the effect overall of reducing supervision and regulation of such firms.
EBTL.
Right. So it definitely
went
did.
back up to the $2.
Deregulation bill relaxed requirements for stress tests and resolution plans. The dangerous and irresponsible nature of this deregulation bill was completely predictable. In no way was this turmoil inevitable. The then Federal Reserve Governor Brainard opposed it, as well as both of you, Vice Chair Barr and Chair Gruenberg.
How is there
And yet
224
here we
volume
are.
on
In the aftermath of the collapse
the
of SVB
contracts?
and
I didn't get
Signature
any
Bank,
fills.
it's clear that the Republican deregulation bill shares the blame alongside Treasury, the Federal Reserve, and the FDIC due to the lapses in supervision and
Too
oversight.
far down the queue?
Chairman Gruenberg, for folks who are concerned about the future of small and medium-sized banks in this country, what assurances can you give them?
Well, Congresswoman, as a general matter, our small and medium-sized banks remain in good condition.
Birds, new high there.
Including their liquidity.
High is moving up.
And I think the actions we took did help to stabilize the system. And I think
5 new NFTs.
as I indicated, any
Probably go up
any
in value the
expense
next few
by the
days.
Deposit Insurance Fund to cover uninsured depositors will be imposed through a special assessment on the industry, and we have discretion to tailor that assessment to the institutions that most directly benefit.
Maybe since
So
I
we're gonna
canceled
try to
these
be
orders
thoughtful
and
in
then
this
redid
process.
them,
Thank you, and
lost
I'm
my place.
requesting that each of your agencies provide
Queue.
my office and this committee by May 1st a list of recommended
moving up.
regulations that need to be enacted to strengthen the banking
Yeah,
industry and to
51% on
prevent
birds.
future
Almost
failures.
at that 30 cents.
The story of SVB's collapse is the story of a Republican administration in cahoots with the banking industry to weaken our financial regulations, but it is
Business, move
also
on
a
the
story
spot.
of regulators' failure to
Go
do
back
their
down
number one
home
job,
where you live.
regulate banks.
Back where you belong.
And since I'm accused of this often, I think I will close with a wokeism. The American public are tired of the
GME
super
kinda
wealthy
flushing.
pocketing bonuses and leaving working class folks
3.5%.
hiding the bag for their fiscal mismanagement. They're even more tired of Congress allowing them to do it. It is time to regulate. Thank you, and I yield.
The gentleman
Oh,
yields back. The
spy.
gentleman from Ohio, Mr. Davidson, is recognized.
Thank the chairman, thank our witnesses, appreciate your endurance
This is not a
here,
reaction from that
today and
tweet, trust me.
yesterday. And as I listened to my colleague ask questions, I know my constituents
your
are
tool's holding
tired of seeing Washington, D.C., Congress in particular, socialize risk
ripping
and watch
here.
profits be privatized. But they're also tired of people that don't listen. So I think one of the things that, Mr. Barr, when I was
Look at that
listening to what
candle.
you said
Jeez, I'm out.
yesterday and today, S2155 isn't the reason that these banks failed. These banks were over $100 billion in assets, and therefore it's just a red herring. Isn't that accurate?
What I would say is that the Federal Reserve's rules
GME is
issued in the wake of
relatively strong to the
2019,
downside here.
In the wake of the legislation that were issued in 2019, they did have the effect of lowering
22,
supervisory
28.
and regulatory standards for firms, but
Close to the
the
support
Federal Reserve
level.
retains the discretion to have different rules. And one of the things that I think
getting
would
real
be
close to that
my
30
job going
cents.
forward is to put in place rules that are appropriate for that size
You're told
institution. We have the
$2.
discretion to do that.
Yeah, thank you. And so obviously, it wasn't the regulation per se that failed, it was the regulator that failed. And I want to understand the context in which that occurred. So over the past year and a half, we've seen a substantial increase in the federal funds rate. And during that span, are you aware if the
There's
Fed or
30
other
cents
prudential
on
regulators
birds.
had conversations, not specific to
Hit it.
Silicon Valley Bank, about the inevitable interest rate risk that presents?
Yes, that is a core topic in supervision. Supervisors were very focused on interest rate risk. It was an important part of what we highlighted in our fall supervision report. Examiners were given beginning this year extra training, beginning last year, extra training on interest rate risk. So it is just a bread and butter supervisory issue. It's not some esoteric problem.
So in that sense, did Silicon Valley Bank's failure surprise you?
Its failure did surprise me. Its risk-taking was excessive, but even then, I did not anticipate, I don't think anybody anticipated
I saw it coming.
that they'd have a
Blame me.
devastating bank run that
my
basically
fault.
wiped out
New high on SPY,
$42 billion
400.
on Thursday afternoon, another $100 billion expected the
430.
next day. That would be 85% of its deposit base
for the hills.
in a 24-hour
Hey,
period.
Julian.
That was shocking.
Yeah, so we're anxious to understand all the factors that drove that run on that particular bank. But we're also curious when you stated yesterday to Senator Kennedy that stress testing does not examine institutional risks precipitating from interest rate risk. And when we were on the conference call with Treasury, with Fed, with FDIC, with House and Senate Republicans and Democrats, I asked the question, and there's some complex model that the stress test involves, and said, well, if macroeconomic conditions and whatever kick in, well, I submit that the hold to maturity spread has to be considered, not just the available for sale risk because of the need for liquidity. Is that something that you're
$2
focused on as you conduct your review?
Yes, I think you're absolutely right that we need to look at both sides of the balance sheet. We need to look at the liability structure and the asset structure, and the whole point is to assess whether under certain conditions you can have more stress on the liability side that forces you to sell on the asset side. Those are interrelated.
Mr. Grunberg, do you share that concern about how we're looking at systemic risk?
Yes, I do, Congressman.
I would love to go into everything that I could on this, but Mr. Barr, on March 9th, you gave a speech that touched on stablecoins and brought up specific risks associated with stablecoins. In that speech, you stated, quote, this mismatch in value and liquidity is the recipe for a classic bank run. Stablecoin issuers are not supervised by the Fed and lack capital and liquidity as a backstop. The banks we regulate, in contrast, are well protected from bank runs through a robust array of supervisory requirements. Would you revise those comments if you could?
Yes, I think that, it demonstrates the need for humility in thinking about how financial risk happens in the system. That's been a theme of basically all of my academic work on systemic risk is we need humility, and that's why you need really strict capital and liquidity rules because of exactly the kind of circumstance we just saw.
Yeah, thank you for that. And note, obviously, stablecoins are backed by assets and are properly regulated in many states, including the state of New York. Last thing I'd say is we have this pressure to socialize more of the market. There are credit unions that are completely privately insured, many in my district and in others, and I think we should look to that market for private credit risk insurance. I yield.
The gentleman yields. The gentlewoman from Michigan, Ms. Tlaib, is now recognized.
Thank you so much, and thank you all for being
Birds.
here. Vice Chair Barr, Silicon Valley Bank, which I feel like no one's focusing more on them as the bad actor here, in the mismanagement and the inappropriate actions. You kept saying over and over again that they weren't responding. If you had, we should have done something when we knew they weren't responding. I mean, what could have been done?
Amy
It's
did.
an
There's your green
excellent point.
candle.
I mean, I agree with you. You start with the basic
Oh, I might
problem
pick up another leap.
the bank managers mismanaged the bank.
Did they hide something from us? What did they hid all this from us? Do you believe they hid this intentionally from the feds?
I don't have access yet to the full supervisory record.
Will
to
you
be
let
able
us
to
know?
answer
Because
your
I really
question.
do think they misled and probably lied and made some inappropriate and fraudulent probably actions that I hope that we'll hold them accountable to.
Oh, pretty big
we will
bounce on
definitely be
GME.
looking into that, and we retain enforcement
that level.
authority to go after
Good signs of
people who
support.
at the bank who violated the law or who breached their fiduciary duty or who engaged in unsafe and unsound practices, and we will hold them accountable
Yeah, and
to
Chairman
the fullest
Krueger, let's
extent.
not negotiate with bad actors like that. We think this
22,
is the time to
22.
really
Yeah,
hold
it's
them
kind of,
accountable, honestly.
that's actually to
This
the
is how we
decimal
set
point
a
that we hit
precedent.
back here.
But going back to you,
But yeah,
Vice
anywhere in this
Chair
range,
Barr, bonuses were paid out
22
when?
up to 20.
When was the last
2.5.
bonus paid out
So,
before they?
and
As I
showing
said,
good support there.
I'm still getting access to the
We know it
supervisory
was a
record.
couple
Trying to-
hours
trying to get this
before,
filled.
correct?
I've heard news reports about that, but I want to make
So
sure
you don't
that
even
I
know
get
when the
full-
bonuses were paid out? You don't have that information from this committee right now?
I do not have
Excuse
that
me.
information
Was
right
it the
now.
day of?
There we go, I got filled.
I would like to respond to you fully and accurately, and I want to be careful to do that properly. I've heard news reports about the timing, but I don't
How
have
come
the
the
full-
news knows, but we don't?
Pardon?
How come the media and the news know, but we don't? How do you not know this before our financial service? Because this is important.
I agree with, I share your outrage about it. I just want to make sure we get to the facts.
Do you even know how much the bonuses were?
As I said, I think you're hitting at exactly the right issues. We're going to use our enforcement authority to the fullest extent possible.
Well, now, everyone's saying, oh, we're going to go ahead and introduce some clawback legislation to see. But, Chairman Krueger, I asked the Fed Chair Powell about this. Section 956, it's been, 12, 13 years? When are we going to have a rulemaking on that? This is about excessive pay. This is about, this is something that Congress already considered. So how come it's over a decade that we don't have anything rulemaking? In 2016, there was a proposal. It wasn't great, but it was a really great start. It would have been instrumental here.
Yeah, no, I'm familiar
Just
with the
looped you back to the
rulemaking,
beginning.
Congresswoman. I was strongly supportive of it. We didn't complete it in time.
Eva Toll.
Why?
Back up
Well,
over
I
$2.
think there was a change of administrations, and that may have had something to do with it. Every reason to come back to it now and complete that rulemaking, and I
If you
think
had it today, what could you have done
Well,
in this instance?
it would have
Because
given us-
I'm tired of being asked to pass things when I feel like we already did, but
would
it's
have
over
given-
12 years that we don't actually have something again that we could have used as a tool.
it just answered, it would have given us explicit clawback authority on compensation. As I pointed out earlier, we do have, in fact, a legal obligation, the FDIC, to investigate the board and management of failed institutions and hold them accountable for any misconduct that might have occurred.
Yeah, public advocates really believe this could have maybe prevented this.
And so we'll,
Primarily because, as you guys know, that there's some inappropriate decisions made up so they can do the bonuses
and that's
and the payouts.
and that's what we're
It
going
is
to.
clear as day, and I don't know why my colleagues are not even talking about that.
That'd be neat.
They're talking about you all not getting things that, well, they didn't respond. How come
Eye of
nobody's
the day
mad
on
at the bank for
spy.
not responding?
All I can tell you, we've initiated the investigation.
We can 8T+2 action on GME. That's kind of interesting.
Chairman-
Assuming the facts.
Or maybe it was
support
just
it.
with
Chairman
that
Gruber,
pump with
please, for the American
AMC.
people, we need
Very
a
minor.
rulemaking decision on Section 956. You know how critically important this is. This is what I think it was, I read somewhere, this is the 563rd bank to fail since 2001. There are going to be more. And I know you guys don't want to talk about it, but there will be, because they'll mislead us, they'll lie, they'll do anything for the buyouts. I mean, even the risk, what's that risk manager person? What did she give herself? What was it? This is a crazy amount of money she walked out with. I mean, it's crazy. And then Gary Becker, the CEO, sold February 27th, $3 million worth of stock, netting $2.2 million. And he knew this was going to be where we land. And we're not angry about that. We're angry because you guys didn't notice. Well, what about the fact they don't respond? They don't respond to inquiries and things. I mean,
The
that to
gentleman's
me
time has
is-
expired. The gentleman from Pennsylvania, Mr. Muser, is now recognized.
Thank you, Mr. Chairman. We know that the receivership for SVB occurred on Friday, March 9th. Sunday morning, Secretary Yellen stated that the American banking system on national television was really safe and well capitalized. On Sunday night, Secretary Yellen approved the FDIC to protect all depositors at SVB, and certainly implied all bank deposits beyond the $250K would also be secured. So my first question to Vice Chair Barr, what data over that time period drove you to go beyond the SVB and Signature, which was made aware, I guess, on Sunday? And did you think that if you were to protect an idiosyncratic bank such as SVB, you would need to protect all? What data
I might be
drove you to
rejecting this 400 again.
imply that all bank deposits would be secured?
The decisions that we made that weekend were obviously in a very compressed period of time. They involved not only gathering information about what's going on in the economy, but also the exercise of judgment. It was our judgment collectively on the Federal Reserve Board, unanimous decision of the FDIC and the Treasury Secretary, that we needed to do that to protect contagion from infecting healthy banks in the system. Community banks, regional banks around the country. It is a judgment call. It was based on the information we had at the time. I think it was the correct decision.
I want to prolong it, but so there was actual data from other banks that they could be in jeopardy from
we were
a systematic
learning,
problem.
I'm sorry, I didn't mean to
it being a
cut you off.
systematic problem as opposed to a unique problem.
As I said, it's a human judgment, but the information we were getting from other regional banks suggested pressure that was building.
It may have been the right call. I'm just wondering what data drove Secretary Yellen to go from, hey, everything's okay, to 8 hours later, no, we're going to protect all deposits. I'm going to move on. Chair Grunberg, it was stated that as well as all bank deposits being secured, no cost to taxpayers. I understand the FDIC fund is understood to pay for it, as you stated, per law. But will FDIC rates go up on community and regional banks? And aren't banks taxpayers too?
Oh, they certainly are, Congressman. As I've explained previously, just to be clear, the action covered uninsured depositors at those two institutions. And the FDIC is required by law that any loss to the deposit insurance fund
rejecting
as a
that
result
30
of
cents.
those uninsured deposits
Profit taking
has to
time.
be paid for by a special assessment on the banking industry. And we have authority under the law to consider the types of entities that benefit from any action taken or assistance. So we have discretion in designing the implementation of the assessment.
Okay.
And as I indicated previously, we're keenly sensitive to the potential impact on community banks.
Well, good, because they are very concerned, as you know, community and regional banks, that they will pay for the bad actions of a few. And I'm glad you're very much aware of that. So, Vice Chair Barr, excessive spending by Congress, QE, the Fed doubling its balance sheet from $4 trillion to $9 trillion, no surprise to you, followed by the quantitative tightening. Many banks holding excessive treasuries were highly devalued and devastated in the case of SVB. So the November 21st, there are reports that the Fed, on November 21st of 2022, there's a report that the Fed was aware of the balance sheet issues of SVB. Were you, I mean, this is the 16th largest bank in the country, 57% of its portfolio was in treasuries being devalued. Why wasn't there more enforcement taking place?
I think it's an excellent question. We were aware and focused at the supervisory level of interest rate risk in the firm and liquidity risk of the firm. I don't think the supervisors expected, I don't think anybody expected a devastating bank run of the kind I described before, with 85% of deposits fleeing or expected to flee
Yeah, that's true. Kind of holding
in a
up here.
24-hour period.
16th largest bank. You can see why people find that
Yesterday might have been some kind of
unacceptable from
rollover,
an
like Don
enforcement
was saying. I'm not
standpoint.
sure.
Lastly, I only have 10 seconds. There's a high concentration of commercial
it's a
real
nice
estate
uptrend.
loans out there,
Gotta be
owned by
patient.
small banks. Potentially, as loans
$2
will
is
be
definitely the first.
I'll
significant
follow up with you
resistance
on that
to
one in
break.
writing. I yield back, Mr.
The
Chair.
gentleman yields. The
After
gentleman
that,
from
we got
New York, Mr. Torres, is
3.75.
recognized.
Thank you. When interest rates
Three.
rise, long-term securities become less valuable, but deposits become more valuable. If you have a stable deposit base, the gains from the deposits can offset the losses from long-term securities. But if you have an unstable deposit base, like Silicon Valley Bank, there's no built-in offset. Silicon Valley Bank had a uniquely uninsured, unstable deposit base that made it singularly susceptible to a bank run in the age of social media. So, Vice Chair Barr, should a bank with an unstable, uninsured deposit base like SVB be subject to a higher standard of regulation than a bank with a stable, insured deposit base?
Representative Torres, I couldn't have said it better myself. I think you described the situation exactly correctly. And the unique...
Flattery will win you no points, but...
It's just the truth. I wish I had said it that way. But no, I think there are unique risks to this kind of heavy uninsured deposit base. And for most banks in the country, as you described, they handle their interest rate risk properly. They have stable deposits. You know, I know all of you, and when you talk to your banks and you go back home across the country, they're doing okay.
But you agree that the rigor of regulation should depend not only on size, but on deposit stability, yes?
I do.
Regarding commercial real estate, the rapid rise of work from home during COVID has driven down office property values, and the rapid rise of interest rates have driven up financing costs, creating a perfect storm. Office buildings with declining property values are set to be refinanced at far higher interest rates. There's reportedly $2.5 trillion in commercial real estate debt coming due over the next 5 years, a substantial share of which is office debt. Chair Gruenberg, to what extent do you worry about the office loan portfolio representing a ticking time bomb in the banking system?
It presents a risk. It's one the FDIC has talked about and identified publicly.
And Signature was the largest commercial real estate lender in New York City. How much of Signature's commercial real estate portfolio consists of office real estate?
That's a good question. Let me get you the exact note. It's a substantial portion.
Can you get me back the answer in writing?
Not Signature.
More important to me locally, residential real estate. Signature Bridge Bank has a housing portfolio of 3,000 properties consisting of 80,000 units in New York City. The portfolio includes 479 properties consisting of 19,000 units in the Bronx, where I serve as a congressman. I have two questions for the FDIC. As you go through the process of seeking a buyer for Signature's residential real estate debt, to what extent will you seek the input of New York State and New York City housing officials who have an obvious stake in preserving the affordability of these properties and units? And to what extent will you prioritize affordable housing preservation in your selection of a purchaser?
Thank you, Congressman. Just to be
doing
clear,
a bull flag up here at the
we
high.
have sold Signature
go along,
to
looks like it wants to
New
go.
York Community Bank.
You sold everything but the real estate portfolio, as I understand. That's been publicly reported.
I take your point. No, we'll be glad to work with you and other local officials in New York in regard to the disposition.
I appreciate that commitment.
Sure.
I'm not advocating the following course of action, but I want to provide you with a hypothetical. The banking system is reportedly sitting on more than $600 billion in unrealized losses from securities, and those losses will only rise with rising interest rates. Since the problem with these assets is one of asset duration rather than asset quality, should the Federal Reserve consider purchasing these securities? Unlike a bank, which needs liquidity to honor obligations to depositors, the Federal Reserve has the ability to hold these assets to a maturity without realizing those unrealized losses. Wouldn't that solve the problem?
You raise an excellent point. Under existing law, we cannot do asset purchases. But what we do is provide ample liquidity to the financial system on the basis of those
But the
assets.
losses remain, even with the emergency liquidity, the losses remain on the balance sheet. Those losses are arguably undercutting public confidence in the banking system. And as you know, banking is as much about psychology as it is about finance. Why not just remove the losses?
I'd go back to the first point you made.
It's
in
fine,
your
I did actually go
question,
along
which is
just before that pop.
For most banks, they're managing this well. They're doing fine. They have stable deposits, and they don't need to sell the assets they have on their balance sheet. Those assets can stay there and be held to maturity. If institutions need liquidity, they can get access to that from the discount window, and from the program we established, the Bank Term Funding Program gives longer-term stability at par for those very assets.
I want to squeeze in one more question. Did the bank supervisor at the San Francisco Fed have the supervisory authority to prevent Silicon Valley Bank from investing in unhedged long-term securities? Did you have that authority? Like, is the problem a lack of authority or a failure to exercise the authority you had?
The bank examiners cited them for not behaving properly with respect.
But did they have the authority to prevent it?
The gentleman's time has expired. The gentleman can answer on the record. The gentleman from South Carolina, Mr. Timmons, is
Oh, they got
recognized for
another
5
guy
minutes.
in here.
Thank you, Mr. Chairman. It seems that
Sneezy Man had
Washington
to take a
continues
longer
to
break.
create crisis after crisis and then come in to bail out the crisis. You
22?
go back to 2008.
Pull the trigger on
It was the
GME?
policies coming
Oh,
out
you're
of
gonna close?
Washington that everyone was entitled
At
to
the lows?
own. And it didn't matter what their credit score was, whether they were able to
Your
pay
call,
it
man.
back.
Yeah, if you want
It
the
was a
capital
human
back.
right. And fast forward a few years, the compounding impact of that resulted in the 2008 financial
I
crisis.
just bought
So
calls on it here.
what did we
Just
learn
for
from
reference.
that? I would argue nothing. The government came in, bailed everybody out.
That bounce in the support
Bailed out the
is
big
very
banks,
bullish to me.
caused chaos in the smaller banks.
And we're still in
and
this
picked
bull
winners
flag
and
from
losers.
earnings.
And that's a theme I'm going to be hitting on, picking
So
winners
I'm-
and
I'm
losers.
bullish for the
because
next
the free
couple
market
weeks at least.
capitalism is supposed to have consequences. And when the
Spy to
government
me is still
continues to
bullish.
bail out bad
I've been
decisions
saying
and
it,
pick winners
through all
and
this
losers,
chop, we're still in an uptrend.
it severely impacts the free market, and it undermines our ability to compete in the global economy.
You're okay
So
with it now, but if it's at 30,
2008,
you're gonna be
we
pissed.
understand the policies coming out of Washington caused a crisis. We had 2 votes.
I'm just saying, no,
First
that's-
vote failed on TARP.
do what you
second
gotta do,
vote
man.
passed. It was very painful. I was not here.
I'm just
But at
giving
the
you
end of
reference
the
on
day,
why I
it,
bought.
solved the short-term problem,
can
but
get
we didn't
20
learn
tomorrow.
anything. We did learn one thing, actually. It was that the
If it
TARP vote
breaks
wasn't
these
fun.
levels, then yeah,
So in
I'm
2008,
not as
we
bullish.
gave
Breaks out of
extraordinary
this flag.
power to the executive branch to avoid a future TARP vote. And this is the first time that y'all used that authority. So let's fast forward to
But yeah, I mean, I'm
2023.
an advocate for sure.
A number
Cleanse.
of policies coming out of Washington,
Do the
particularly
cleansing.
the emphasis on ESG and on DEI, and that compounded with the spending of trillions and trillions of dollars
Discord,
that
get off
caused
the Discord,
inflation,
Jen.
which resulted in higher interest rates, destabilized SVB and Signature.
Yeah, you could tell cover calls
So
for sure. IV
We
is still
didn't
pretty
really
low
learn
though.
anything in 08 because
Pumped up after
we
earnings for like a
used
day
the
or two, and
2010
now it's back
authorities.
to 80 something
The
percent.
executive branch
It's
used the
crazy.
2010 authorities to,
It's part of
again,
it being fixed, I think.
pick winners and losers. So there's no consequences for risk taking. There's no consequences for poor decisions. And
When you do
know,
sell
keep
calls,
talking
it's
about
usually
what
the best to
caused
sell it
this.
in the
Really,
morning.
it's 3 things. The San Francisco
When
Fed's
the
misplaced
volatility's higher.
priorities.
This is
Last
probably the
fall,
worst time to
when
sell
every
calls,
other
I'd
Fed
say.
was sending
Today,
out
at least.
notifications regarding interest rates and inflation and the impact on
That's why I
future
closed my shares. IV was so low, I'm like, I'll
stressors of
just
the banking
start buying
system.
calls with it.
They were still sending out DEI and ESG updates. So that combined with the SVB and Signature mismanagement and the inflation we
wanna
created
trade 'cause
caused
you're
this
bored.
problem, and we have, again, not learned anything, bailed out, poor decision making. I guess I want to start with Undersecretary Liang. Is this a problem? I mean, we invoke the systemic
Yes,
risk exception and cover both insured and uninsured depositors. Is it not creating more systemic risk in the overall
I mean,
system
you could keep
because
scaling, you know,
capitalism
like
is no
you've been
longer a
doing.
thing? The
You've
government's
done one sell,
backstopping
you could
everything?
do,
Is that
you know,
a
move it out
concern?
across 5, and you could do one more now, or
Congressman,
do 10 and do one
understand
now.
your question.
And if
and
it
your
goes up to
concern.
27 or 30 in the
this
next
case,
few weeks,
the systemic risk exception was taken. Depositors, all
Slowly
depositors were
unwind.
covered. Shareholders and debt holders.
But yeah, if it breaks this level, then
they
that's
lost
when I'm
their
gonna close out of
investment.
these calls,
Those
these
who
long
took the
calls.
risk Lost their investments in this case.
Starts
I
breaking
do
down out of
think
this bull flag.
this situation, the actions were taken to prevent contagion to spreading to other banks. It was to help
Okay.
save banks, small and other regionals, who were losing their deposits to either the largest banks or to outside the banking system. I do think this requires that we will need to be assessing. and
I looked like it wanted the
But the
rip.
lack
We'll
of
see.
consequences,
Maybe got
the government continuing to pick winners and losers.
taken.
And I mean, my
Bull
biggest thing
flag
is the
with a breakout new
justification.
high.
Treasury and the White House both said that
Peak right
there's
now,
no
though.
taxpayer dollars, and that what about the people that are going to miss payroll? Neither one of those were necessarily true, because it is taxpayer dollars, because the increased premiums from FDIC is going to be passed down to Americans all over the country. And so they are taxpayers, so that is their dollars. It's not coming out of the general fund, but it's semantics. And as it relates to payroll, I mean, only $22+ billion is going to be
at issue, so there were opportunities to make them whole.
There you go,
I just
MK.
really
Thank
think
you,
that,
Ace. Appreciate
one,
the membership.
delegating
Gifting.
the ability to bail out banks to the
False
executive
breakout to the
branch
upside,
is
maybe.
dangerous. And two,
Click the
bailing
box.
out these
MK,
banks
accept
in
the
this
free
manner
gift.
has caused more
It is your
problems
destiny.
than was possibly worth it. And with that, Mr. Chairman, I yield back.
Bird's holding up well,
The
but
gentleman
still
yields.
rejecting
The
that 30
gentlewoman
cents.
from Texas, Ms. Garcia, is recognized.
He's always false breaks,
Thank you,
man.
Mr. Chairman, and thank you and to the ranking member for bringing us together for this really important hearing. And I just first wanted to start with just a quick question to the three of you,
Doing
because
spy.
I've been troubled by the word of the use crisis.
break
I know
this
I
way,
shared that
false
with the
break
ranking
that way.
member the other day, that, you know, I never saw this as a
big
crisis.
red candle.
Perhaps it was a boo-boo, maybe a major boo-boo, but not a crisis. I don't think that
Can't see what I'm doing?
personally that
Oh, you're
two
just listening.
bank failures equals a crisis.
Yeah, GME is
So I just
basically
want
at
to
the
quickly
low.
ask each one of you just
The
a
low
yes
that
or
it
no.
made
Do you think this is a
yesterday
crisis,
bounced off
Mr.
it
Barr?
twice.
As I said at the outset, I think our system is
23rd, it
sound
bounced
and
off it.
resilient.
Is it a crisis or a yes or
There you
no?
go, MK. Well done.
I think that it was appropriate
So
use of the
this is the
systemic
low
risk
that's bounced
exception to
off
prevent a crisis.
Is it a crisis,
four
yes or
times
no?
since our earnings.
As I said, I think that where
Gap
we are
up.
now, the
So,
banking system is sound and resilient. There was risk that if
This
we
is
did not
basically-
invoke the systemic
But would
risk
you have
That's why
used
we're
the word
long here.
crisis is the
Because
question.
it did.
I have not
It got
used
to the
it.
level and it showed
Okay.
that it bounced.
Chairman Greenberg?
I think we were at risk of crisis, and I think the actions that we took have stabilized the system.
Ms. Yang?
Dude, I'm out. Dang
I
it.
agree with that. The actions we took stabilized the system.
Well, I think you're right, and I think that's what we should focus on.
Whoa,
the
a huge
swift action
flush.
over a weekend, no less.
Yeah, it was a false
and how we
breakout.
were able to avert a crisis and how we were able to prevent
What a choppy
contagion,
mess. And
how
this
we
range was so
were
small.
Able to frankly just
A
save
long
those
actually would've been
banks,
even
but
better.
potentially other banks. And I know that recently, as a ranking member mentioned, there's been some notion that it's the woke policies that have done this. And I know that some extreme MAGA Republicans like Florida Governor Ron DeSantis have even suggested that it was the ESG policies, and frankly, with zero
Bounced close to here
evidence.
several times. Yeah.
But
Yep,
yet
right
they
here, right
continue
here.
with some of this
Right here,
rhetoric.
right here. We're right
Vice
there.
Chair Bart,
Now, if
yes
it
or no
comes
again?
below here,
Do you believe that
that's
ESG
maybe when I would
investing played
close
any
longs.
role in the failure of Silicon Valley Bank?
So that's just what you'd have to, the risk you have to take
Mr.
is
Greenberg.
getting a worse exit if it goes lower.
Ms.
But
Lang.
so
I
far,
do
it's
not
respecting
have the
this level
information that
area.
the supervisors have, but I would.
So move
my
back up,
my,
top of the
strong
range.
preference would
It
be
didn't
no.
fully make it to the
Right.
top of the
Well,
range
Nick,
this time. It kind of
you
made
know,
it to
as I
this
said,
resistance up
There's been no
here,
evidence, and thank you for reaffirming that.
which is
As
fine.
you
It's still showing a
will
channel.
recall that the claim that
This is
ESG
in a
investing
bigger bull
was
flag.
caused by the failure of Silicon Valley Bank is really strongly reminiscent of the claim back in 2008.
So I'm still thinking new highs
that the
before gap
financial
fill.
crisis then was because of the Community Reinvestment Act obligations. So very similar. The financial
the SPY is
crisis
supporting
in
that too.
part
It's
commission examined
choppy
this
and
claim
weird, but it is on an
rejected it,
uptrend.
as did researchers within the Federal Reserve. Vice Chair Barr, would you remind us what researchers at the Fed have concluded about attempts to blame the housing and foreclosure crisis on historically disadvantaged communities of color?
The research showed that there is no basis for the conclusion that
It's true,
low-income,
1940 is a
moderate-income
big,
consumers, households
big level.
were responsible for causing.
But if it gets down there,
Okay.
I'm saying you could close before it gets down there.
Communities of color, the
Starts filling this
disadvantaged
gap
communities,
more.
and particularly
You can
people in
close
my
even
district,
21 and a half or 21.75.
Latino,
Um,
should be concerned that.
You have to wait till
that
1940.
this,
1940 it could bounce, but
bank failures and some of the remedies that are being put in place may cause
gotta get them out of your head.
a lack of capital, the lack of
Maybe on
opportunities
SPY.
to be able to.
I know what you mean.
to
Longer
buy
term, it
homes.
is bearish, but
Will it impact
like
mortgage
longer
rates?
term
I
trend.
think the steps that we took together to stabilize the
On the data
economy and
candles,
provide
there's inverted head and shoulders right
public
here.
confidence in the banking system are of
line?
assistance to low and
Shoulder,
moderate
shoulder,
income households
head.
and to all Americans around the country.
We've got bullish
But do you think
MACD,
it still
green
will be
candles over the
some
9 moving
negative
average.
impact on
It's been
interest
choppy in
rates
the
and
last
the ability
6-7
to
days,
borrow,
but
to buy
we've been
and
on an
purchase
uptrend.
homes?
My
And today we're testing
estimate
400.
is that the bank's reaction to
Yeah, today's daily candle could be the top.
current
Absolutely,
economic
it's 400.
circumstances
400 was my
are
first price
likely
target.
to
when we
lead
were
to
hanging out around
a
here.
reduction
If
in
it doesn't
credit
break that,
availability overall.
then yeah,
That's
it's
something that
probably
we're
top.
watching very carefully at the Federal Reserve.
Right. And Ms. Ling, I had a question for you about crypto, and I know that there's an additional bank that is going through some process of voluntary liquidation. What role did crypto play in all this?
I don't believe crypto played a direct role in either of the failures.
What?
So that, yeah.
Was there an indirect role?
I know that
She doesn't know.
Signature had activities involved in digital assets, but I don't believe that is the main.
The gentlewoman's time has expired. The
Mr.
witness.
Chairman, I will follow up with the three panel members on this issue. Thank you. I yield back.
The gentleman from New York, Mr. Garbarino, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman Grunberg, I want to talk a little bit about Signature Bank. Can you describe the condition of Signature Bank at the time of its receivership and what evidence you had that showed Signature
about how
was
strong
also facing
Silvergate
a
is.
liquidity crunch on March 10th?
You got hyped for
And
today?
What was
No, man.
Signature's available funding at the time?
Based on
New
what?
York State
10K
DFS
came out last night.
closed
There's
the
nothing
bank
in
and
it.
placed at FDIC.
Only other thing was there.
Congressman, we can get
We-
you the specific data, but the fact is that on Friday night, that bank had real difficulty meeting its obligations at the end of the day and barely met them by the 5:30 closing time. And I think both New York State and the FDIC, who jointly had responsibility, did not think that the bank could open and make it through the day on Monday. I think that was the determination. And that's why the New York State on Sunday decided to close the institution.
All right, and you can get me the specific numbers.
Yes, we can.
Thank you very much. And now I want to focus, I want to follow up on something that my colleague Tom Emmer asked before. When New York Community Bank Corp. assumed its Signature's deposits in some of its loans, it refrained from including roughly $4 billion of deposits related to Signature's digital assets banking business. As a result, Signature's real-time payments network remained under FDIC Commission's receivership. It was reported early yesterday evening that the FDIC sent a notice to depositors whose deposits were not included in NYCB's bid, informing them that any accounts not closed by April 5th will be automatically shut and depositors will receive a check in the mail. Can you walk me through FDIC's reasoning for this decision?
Yes, Congressman. So the winning bid for Signature by New York Community Bank's subsidiary, Flagstar, was for all the deposits except the winning bid chose not to bid on the digital assets. And there were about $4 billion of those. And we provided those depositors a couple of weeks to determine what they might want to do. And we sent them a notice that we'll return their deposits to them by early next week, I believe.
So in your response to Tom Emmer, you mentioned that Signet was included in the sale of Signature Bank, while the deposits were not. It is my understanding that you still currently are looking for, so you're still currently looking for a buyer.
So just so I'm clear, the digital deposits are being returned to their deposit holders. It's my understanding that Signet was not acquired and remained in the receivership and is in the process now of being marketed.
So Signet is still under FDIC
Yes,
receivership?
it's in the process.
Thank you very much. Chairman Grunberg, I also want to bring this up. In the Senate banking hearing yesterday, there was an exchange between Senator Van Hollen and Vice Chair Barr on the guidance on guidance issued in 2018 and codified in 2021 when Randy Quarles was Vice Chair of the Supervision of the Federal Reserve Board of Governors. This has become a target of some, even though this initiative doesn't limit any action an agency can take. It simply clarifies which actions will be accomplished through regulatory measures and which through supervisory measures. You stayed silent during the entire exchange, but I recently read an op-ed in the Wall Street Journal written by Randy Quarles, which has said that both you and Lael Brainerd voted for this guidance. Is that true? Did you vote for this guidance?
Yes, we did, Congressman.
Thank you very much. And one more question, sorry. Vice Chairman Barr, as we look back at the events over the past couple of weeks, there have been a number of similarities identified between Silicon Valley Bank and Signature Bank. The first of which is being the high concentration of deposits well above the FDIC insurance limit, with reports showing that 90% for Signature Bank and 87% for SVB. And the second being the lack of diversity in both banks' deposits. The news has discussed the potential impacts of these similarities ad nauseum. However, I would like to explore how the Federal Reserve and the FDIC view deposit diversification as it pertains to determining the soundness of financial institutions.
Sorry, I couldn't hear the last four words.
I think IMX was supposed to drop something.
I would like to, I'm out of time, so I'll submit this
Fortnite, I
question
think
for you to respond.
we had maintenance and stuff.
Thank you so much.
The gentleman yields. The gentlewoman from Georgia, Ms. Williams.
Regarding GME, I think.
Thank you, Mr.
We've
Chairman.
seen everything.
I want to start by making it clear that the failures of the Silicon Valley Bank and Signature Bank were not just about wealthy people, as some of the narrative that we've heard in conversation. There is a significant chance of a disastrous impact on hardworking people who are trying to make payroll, and it's important that this detail doesn't get lost in the shuffle. The weekend that SVB failed, I woke up to text messages from constituents asking what the government was going to do, what kind of intervention there would be, because they had money in this bank. Atlanta is this booming area for tech startups, and so the impact was felt very real by my constituents. They wanted to know if they would be able to access their funds on Monday morning. Black-owned businesses were worried about paying their employees. Entrepreneurs who are creating wealth in marginalized communities were concerned about covering basic business expenses. These businesses are closing the racial wealth gap, which unfortunately my home district of Atlanta leads the nation, and the banking system has to work for them. Chair Gruenberg, in the aftermath of SVB's failure, there has been substantial debate about raising the $250,000 deposit insurance cap to minimize any potential payroll disruptions and economic pain that may follow when the next bank fails, which my constituents were so concerned about. There is reportedly bipartisan legislation in the works to temporarily raise the cap. If the cap is raised or eliminated to help protect depositors, we'll need to take measures to reduce the risk of moral hazard. One proposed measure is the continuance of risk-priced deposit insurance premiums. Chair Gruenberg, as we consider different deposit insurance reforms, should we seek to maintain risk-priced deposit insurance?
Birds edging up
I
here.
think we do want to maintain risk-price deposit insurance.
Evital
but I
hanging out
do
around
think,
$2.
You know, you change one part of the system, it impacts another part of the system. So, as I indicated earlier, the FDIC is undertaking a comprehensive review of the deposit insurance system
Waiting
in
on
light of this
PCE
episode.
in a week.
And we'll release a report by May 1, also laying out policy considerations for changes to the system that we hope will inform the discussion around this.
So beyond the report, moving forward, what steps can the FDIC take when making decisions about deposit insurance assessments to make banks think twice about various financial stability threats that disproportionately impact marginalized communities?
Well, we have authority now to do risk-based pricing, and I think it's fair to say that in light of this experience, we need to think hard about liquidity risk and concentrations of uninsured deposits and how that's evaluated in terms of deposit insurance assessments. But I also think it's an appropriate moment to take a look at how our system works in light of of this episode and consider what other changes might be prudent.
Thank you. And we all know that part of maintaining a healthy banking system is confidence, specifically consumer confidence, that their money is safe in the banks that they've chosen. People of color have a harder time getting affordable loans from the largest banks and thus turn to the community banks, minority depository institutions, and the like. And when there is fear in the financial sector or an economic downturn, minority-owned banks and community financial institutions are hit hard as customers transfer their funds to what they think are safer and larger banks. Vice Chair Barr, what can Congress do to strengthen and support community and minority-owned banks in situations like we just experienced?
Again.
Thank you very much, Representative Williams. I agree with you that having a wide diversity of kinds of institutions in our country is really critical, including community banks and regional banks, minority depository institutions, and community development banks.
BBBY
All
waking
of
up
these
here.
institutions, I think, are really important for economic vibrancy
My VWAP.
and inclusion in our society. We'd be happy to work with you on ways that we can continue to support those institutions going forward.
Happy to work with you, and we will definitely follow up.
That is
And
neat.
Chair Gruenberg, I would love to hear from you what kind of deposit insurance reforms would help support minority depository institutions and other community banks.
For holding HPD.
It's an interesting question. You know, we
You kind of had an exit
we're
today if you wanted to get back
in the
out.
process of finalizing
At 8:48.
major revision
We're
to the
close.
Community Reinvestment Act. And in the proposed rulemaking, there were specific provisions to encourage banks to work with and support minority depository
dividend?
institutions and community development financial institutions. So I think that's actually an important vehicle and opportunity to strengthen our MDIs and CDFIs, which serve LMI communities. And it's an interesting, we should give some thought in our review whether how deposit insurance, may play into this as well.
And I have many more questions, but we're going to work together on this, and my time has expired. Thank you, Mr. Chairman. I yield back.
The gentlewoman yields. The chair now recognizes himself for 5 minutes. Vice Chair Barr, did you originally believe that inflation was temporary and transitory? Yes or no?
About inflation.
I was not on the Federal Reserve Board at that time.
Did you believe it was temporary and transitory, or you had no opinion?
I would say at that time I did not have an informed opinion.
You did not have an informed opinion if it was temporary and transitory. The Federal Reserve continued to call inflation temporary and transitory until Q4 of 2021. The Biden administration continued to call inflation temporary and transitory. I apologize, the Federal Reserve Q4 of 2021. Biden administration Q1 of 2022, following the Russian invasion of Ukraine. That's when they stopped calling it temporary and transitory. Would the challenges that we saw with SVB have taken place if inflation truly was temporary and transitory? Yes or no?
The problems that came about from SVB are from classic interest rate risk management.
So if inflation was temporary and transitory, then I will make the assumption on your behalf for myself that interest rates would not have gone up. If interest rates didn't go up in the manner and hold in the way that they are, SVB would not have occurred. The breakdown of the bank.
Sir, banks have an obligation to manage interest rates, whether they're going up or going down. It's just classic good banking, and it wasn't done here.
Okay, so let me dive in then. Yesterday, in response to a question from Senator Rounds
weird you can't buy that
following
NFT.
The matter requiring immediate attention, the
Probably user error.
MRIA, you noted that there was a challenge in the model that it was, quote, was not at all aligned with reality, end quote. Was that a challenge in modeling in particular interest rates? Or what part of reality was it not connected with?
Let me also say, as I mentioned earlier today, I called that an MRIA yesterday, but I meant an MRIA. It was just a staff note
Understood.
mistake. So it's an MRA on interest rate risk. And basically what I meant is that their model showed that they'd earn more money as rates were going up and they were losing more money.
So interest rates was at the core of how it was disconnected from reality?
Yes, it was about interest rates.
That's fair. So here's my challenge. So as I look at the ability to prevent all of this, the Federal Reserve would have had to admit that they were wrong, that inflation was temporary and transitory. I think that's at the core of our conversation here in Congress. I think continues to do an abysmal job with the administration to bring inflation under control. Let me switch gears if I can, pretty substantively here, Vice Chair Barr. I have in front of me the H41 from the Federal Reserve, and in particular looking at the loans that the Federal Reserve has made to depository institutions. There's been a significant shift in particular as relates to other credit extensions. Other credit extensions is noted is that the Fed is taking collateral from the FDIC. That account, March 9, $0. March 16th, 1 week later, $57.6 billion. March 23rd, 1 week after that, $178.6 billion. So the Federal Reserve is taking collateral from the FDIC and loaning the FDIC money. Under what statutory authority is the Federal Reserve engaged in that?
Sir, the Federal Reserve is lending through the discount window to the bridge institutions that were established by the FDIC. So they're lending to banks. There's a provision in the statute that clearly contemplates that.
And so you're noting that when I read footnote 7 that would not have fallen under the line of either primary credit or secondary credit?
For the purposes of enhancing transparency to the public, that line was broken out so that everybody could see exactly what it was.
Okay, that is helpful. Then if I can shift to you, Chair Grunberg, as we look at this dramatic
Got some
increase,
PayPal gains, huh?
is there
Nice.
a reason that you used this facility rather than one, selling assets, or two, tapping your line of credit at the Treasury, which I believe is to the tune of $100 billion?
We certainly have sold assets to meet our liquidity needs, and these bridge institutions are nationally chartered banks eligible to borrow from the Fed and utilize that in order to manage the liquidity situation as well.
But is there a reason that you're not either A, utilizing in a more substantive way the credit line available from the Treasury, or B, selling assets? And the reason I ask this, so that maybe I can be more specific, does the FDIC have the same risk that we're seeing in other banks with unrealized gain or unrealized losses? And is that why you're tapping this facility rather than selling assets?
No, Congressman, we are selling assets to meet the obligations of the failed institution, and we're also managing the liquidity. These bridge banks have the authority and ability to access the Fed resources.
So you're both selling assets and borrowing from the Fed to the tune of $178 billion at the same time?
For these institutions to meet immediate liquidity demands, which we'll eventually get back.
And did the Treasury at any time discourage you from taking a loan from the line of credit from the Treasury for purposes of addressing the debt ceiling limit?
I think there were discussions in regard to that, but I think the principal purpose here, frankly, was liquidity management and also to be able to preserve liquidity in our deposit insurance fund.
I appreciate your time here today. I yield back. I'll now recognize the gentleman from North Carolina, Mr. Nickel, for 5 minutes.
Thank you, Mr. Chairman, and thank you to our witnesses for being here with us today. People in my district are already living paycheck to paycheck, and they're worried about making ends meet. They're already dealing with the rising costs of everyday goods and services, and the last thing they need to worry about right now is their bank or their employer's bank failing. That's why I'm working to provide transparency and accountability to this process. Where were the regulators? I want to know what the bank executives were doing in the months, weeks, and days leading up to this failure. My constituents deserve to know that we're going to hold bank executives accountable and ensure that this doesn't happen again. These bank failures rattled our financial system. Working families in my district need a stable economy they can rely on. They can't afford more uncertainty when it comes to their next paycheck. And right now, the looming debate over the debt ceiling crisis has the ability to rattle our economy even further. So, Vice Chair Barr, in just a few months, the United States Congress needs to raise the debt ceiling. If the U.S. defaulted on the debt, would it be really bad for our economy? Would it be really, really bad for our economy? Or would it be really, really, really bad for our economy?
The basic answer to that question is that Congress needs to increase the debt ceiling, that there's not other options around that. In the absence of an increase in the debt ceiling, it could cause enormous dislocation to our economy.
So, one really, two reallys, three reallys?
I wouldn't characterize it. I think that it's the right thing to do. I think Congress needs to do that, and really leave anything else about the debt ceiling up to discussions between the administration and Congress. Just to say, from an economic perspective, it would be quite unfortunate.
Thank you. Vice Chair Barr, the second largest banking failure in the United States history, $42 billion pulled in a day. Who was asleep at the wheel?
I think in the first instance, as I've said, bank management is responsible for running the bank. They failed in basic measures of interest rate risk and liquidity risk. They had very many outstanding matters requiring attention, matter requires immediate attention. They were deficient in governance and controls. They were rated a 3 overall with respect to the firm, which means they were not well managed. And at the end of the day, it's the job of the bank and their board of directors to run themselves the way they should. We, of course, are looking internally at our own supervision and our regulation in looking at ways that we could have forced the firm to do more faster or raise standards so that if the firm got into trouble, they had more capital and liquidity.
certainly hope there's some accountability. Chair Grunberg, moving to you now. First Citizens Bank, which is located in my congressional district, North Carolina's 13th district, was a successful bidder for Silicon Valley Bank. They have a proven track record in this space and are already instilling greater confidence in our banking system. Can you tell us about the evaluation process for the bids that were submitted and what made First Citizens the most attractive bidder?
Two reasons I'd say, Congressman. One, financially, it was the strongest bid for the FDIC.
Can I give up English?
And two, it was a bid for all the deposits of the institution and all of the loans of the institution. So that
You can't buy BBBY on your broker? What's your
provided,
broker?
operational certainty as well. So from both a financial standpoint and an operational standpoint, it was really the strongest bid we received.
And
Bird's
it took
rejecting
a while.
that 30 cents, but just
why wasn't
so
Silicon
slowly
Valley
coming
Bank
down.
purchased sooner? I think that certainly would have created more stability in this situation.
If we could have sold it that first weekend, that would have been desirable. The fact is, Silicon Valley was a pretty large institution, $200 billion in assets, and pretty complicated in terms of its business activity. So for a potential acquiring institution to do the due diligence over a weekend and reach a conclusion and make what was frankly not practical. And so we set up a bridge institution and for both of the failed banks, and we're able in a pretty orderly way to set up bidding processes for each. In fact, for Silicon Valley, we had considerable interest and got a couple of requests for additional time for interested parties to do due diligence. So we extended the bid date a couple of times to give people time, and we ended up, getting.
What does it tell you when you try and buy it?
27 bids from 18 different sources. So it ended up being a pretty constructive process.
Thank you very much. I yield back.
The gentlewoman from California, Mrs. Kim, is recognized for 5 minutes.
Thank you, Chairman. Let's examine what we're discussing here. At the time of its failure, Silicon Valley Bank was the 16th largest bank in the United States, with its assets more than tripling from $71 billion in 2019 to over $200 billion at the end of 2022. Obviously, we all know banks have its responsibility to manage its operation well. Unfortunately, our economy facing inflation not seen in decades and increasing interest rates,
For another bounce down here on
supervisory
GME.
missteps at the federal and state level failed to correct and mitigate SVB's rapid growth in its balance sheet and management risks. Mr. Barr, yesterday you mentioned that you first heard about SVB's interest risk and liquidity
Silvergate's getting a bounce
management,
here.
those issues back in February of this year. So I want to ask you, who decided to
That's
put
one of our levels, 1.8.
SVB under the horizontal review process, considering there were at least
kind of-
6
below
warnings
it a little
going
bit.
back to
But looks good.
2021,
VWAP
and
is
given
back to $2.
SVB's risk
I like it.
profile, how did you conclude that the firm did not merit actions beyond the horizontal review process?
Oh, really?
Thank you,
Might need
Representative
to like
Kim. I think it
clear cash or something.
that's one of the things we're trying to figure out in
Your
the review.
cookies.
The supervisors on the ground
Watching like a hawk.
saw the risk that you described, saw the interest rate risk, and saw
They
the
can go lower than
liability
this today
risk.
and still be good. This is
They
kind of
required the firm
below.
to make changes. The firm didn't make those
Like to see
changes
it
in
hold.
times. The concern of supervisors grew. You can see that from the
Buys
fall of
moving down
21
here
to the
finally.
deficiency rating in
The bear
22,
flag's
and
playing
then
out. Bull
further
flag was
action that
false.
year. But you're absolutely right that at the end of the day, the bank failed, and so
Well,
we need
it
to
seems
look at.
to me, reclaiming my time, it seems to me that you could have considered downgrading ratings or considering enforcement actions. And to me, it seems that supervisors kicked the can down the road and couldn't consider the
Strongly
full
support above it.
consequences of
It's
the
this level we're bouncing on.
inaction. But I want to ask
22
the next
area.
question.
2210
In
up to like
February, the
22.
Fed reported in its
40.
January senior loan officers opinion survey that it is seeing
Full
tighter
zone.
credit conditions. So, so it seems to me SVB's failure will only serve to exacerbate the tighter credit conditions. So I'm worried that
Maybe there's not really support until
as
1940 after this
entrepreneurs,
level.
they will soon find it more difficult to get a loan
Like
or
maybe
credit
$20 even.
to expand their businesses and hire workers due to tighter credit conditions. So, Mr. Barr, I want to ask you, how will you consider tighter credit conditions as part of your holistic capital review and Basel III endgame reforms?
Yeah, I think you can buy
We're
Fidelity.
looking to
It's probably
review our
Europe or
capital
something, you can't
requirements
buy
not
it.
for the current situation, but for the long term. Any capital requirements that we consider would go through notice and comment rulemaking and have a transition period, so they would not apply to the current economic circumstances that we're in. We're thinking about the long-term effects. We are, of course, paying attention to tightening credit conditions as part of our monetary policy decisions. Those factor into our forecast for the economy and therefore into our interest rate decisions.
Well, I'm asking you to please pause and keep the current market volatility and uncertainty in mind as you do that. Let me ask you, Mr. Grunberg, a question. Yesterday, you stated that you received 2 private bids to purchase SVB. This is after the FDIC was appointed as a receiver, and you said one was invalid because it did not get the approval of the board. And the second one indicated it was more expensive than liquidation. So in your prepared statement, you mentioned that the cost to the Deposit Insurance Fund of resolving SVB will cost about $20 billion. Can you tell us why FDIC board decided to deny the first bid? And did you see the second bid as more expensive than the $20 billion incurred by the insurance fund?
Well, I think the point is that neither bid was less expensive than liquidation. So liquidation would have been a less costly alternative than either acquisition at that point. And frankly, the limited bids and the quality of the bids we received
You're not
was
long
a
on
function of a
GME,
very
but you
compressed
believe in it
timeframe because we
long
just
term,
taken
for
over
sure?
the institution Friday morning, and this was Sunday afternoon. And we thought it was in the interest of the Deposit Insurance Fund to place the institution into a bridge so that we could manage it for a brief period of time and then organize an open bidding process so that interested parties would have a fair opportunity to bid on the institution. And that's ultimately what happened. And if it would be helpful, I'd be glad to respond in writing. I know
That would be fantastic. And with that, we'll recognize Ms. Pedersen of Colorado for 5 minutes.
Thank you, Mr. Chairman. I am the last on the list, I believe. Always am. So I just want to thank you all.
I think
for
I like
being
this
here
goal.
We're
today.
members of Congress. We don't rate it that way. If we can restart our time, I'm sorry to interrupt. I apologize.
Thank you, Mr. Chairman, and I really appreciate this incredibly important discussion. There are numerous areas that need to be examined to better understand the failure of Silicon Valley Bank and Signature Bank. But first, I want to thank you and the boards of the
BBBY,
FDIC and the Federal
ripping up their
Reserve and the
go-up.
Treasury Secretary for your leadership and ultimately bringing the resolution needed to stabilize the banking system and protect depositors. I had text messages and emails and phone calls from constituents and from people across Colorado who were absolutely terrified that they were going to lose everything.
I don't know this
and
girl,
that
never
They
mind.
were going to be unable to make payroll. So while the response took some time, and I think it did foster a lot of misinformation being spread, ultimately, thank you so much for doing what was necessary to protect our economy. But we're, of course, here today because we want to make sure that we're learning from what could have been done better and evaluating what we need to do in changing times. And I think that one of the most challenging issues that each of us face in this committee and for all of you is how we adjust our regulations and responses in a time when information spreads like wildfire, and in this case created a panic across our system and threatened our entire economy. Previously, a bank run would take days. In 2008, Washington Mutual saw over $16 billion in withdrawals over 10 days. With SVB, the bank run happened in a matter of hours, with a record $42 billion being withdrawn in a single day. And while SVB clearly wasn't managing their risk and was not listening to the warnings from the FDIC, I don't think any bank could have survived a run like this. And so, Mr. Grunberg, knowing that this panic occurred through social media in response to the suggestion that not all depositors would be protected when the FDIC took over SVB, what lessons can regulators take from this to improve their public communication when a future bank fails? And knowing how quickly depositors can immediately move their money in this new technological age. And specifically, I know you're going to take time, and we'll hear a lot more about this in the future. What do you think is needed to expedite the responses necessary to mitigate something like this from happening again?
Well, to prevent it from happening again really raises all the supervisory and regulatory issues we've been talking about this morning. I do think in regard to deposit insurance, we should do more and perhaps a better job of explaining to the public how deposit insurance works, what is covered, what is not covered, what are the options available to people when they open a bank account. And I think that would also be one of the reasons to undertake this overall review of the deposit insurance system.
2 o'clock
See
little
what
pump there,
changes
2
might be
p.m. margin
considered
calls.
that would be helpful to the public.
Great, thank you for that.
Originally told myself I was in 5 years.
Vice Chair Barr,
5
in
years
just
takes a long
couple of
time when you're
weeks,
staring at a
we've seen
screen.
these 2 bank failures. We've seen efforts to prop up First
Rock
Republic Bank,
psychologically.
and we've also seen
Told about
issues
covered
with
calls.
Credit Suisse and the
Got
Deutsche Bank
pissed.
in Germany. I'm still getting questions from people in my district who
Yeah,
are
that balance.
concerned.
It's respecting it.
And
Genuine
so
respect
what
and that
message
support.
do you have
Very
for
good
them,
sign.
for our constituents and small businesses, to reassure them that our financial system is stable and that their money is secure?
Doing myself for brilliance and insight.
Well, I
You
think
talking about
that's an
HKD?
excellent point.
Okay,
I know
BBY has little
when
pops
many
like
of you
this
talk to banks,
basically
you
every
know,
day. This
in
is,
your own
you didn't
in
give
districts,
it,
they're
you didn't
telling you
give
the
how
same
much.
thing,
I
which
said,
is that
how do you define
the
a
banks are sound and
a run?
resilient. I think if you look at the actions we took
If
a
that's what you're
couple and a
going
half
on
weeks
about.
ago, those actions demonstrate that we're committed to ensuring that all deposits are safe. We're prepared to use those tools for any size institution as needed, if appropriate, to keep the system safe and sound. So the basic message is that
Yeah, it better be
the
a
banking
joke.
system
All
is
back
sound
under
and
your
resilient.
cave.
Great, thank you. I really appreciate it. And I yield back, and congratulations, since I'm the last one.
Well, gentlelady yields back. The last one on the Democratic side.
Biden moving up here.
So panelists don't get too excited. We'll now have.
They're back.
Oh, we have 2? I'm sorry, Chairman Meeks. I'm very sorry. That's not getting better news for you guys. Sorry. We'll now recognize the gentleman from Florida, Mr. Donalds, for 5 minutes.
Thank you, Mr. Chairman, panelists. I know it's already been an interesting day. Thanks for being here.
Fun.
Vice Chair
See you later.
Barr, says here you were confirmed July 19th, 2022. So you came in kind of in the middle, according to your own testimony, of when the San Francisco Fed was having examinatory issues at SVB. Is that fair?
The examiner report with respect to the whole firm as a whole was done in July 2022, and that's when I arrived.
Okay. According to your testimony, you say here at the end of 21, supervisors at the SF Fed found deficiencies with
And
bank
that's it for
liquidity
BBY.
risk, resulting in 6 supervisory findings. In May of 22, there were 3 additional findings
Vitol, back at the
associated with
highs.
ineffective board management, et cetera. In October of 22, supervisors met with the bank's senior management to express concerns about the interest rate profile. In February 23rd of 2023, your staff alerted you to these issues, and then we know the
want
rest
more
of the
GME
story.
calls.
Is it your assessment that there are
Respecting the
serious
support.
supervisory issues at the
What are they
San
doing the same
Francisco
thing
Fed?
yesterday?
We're doing the review of that now, and I don't want to prejudge the outcome of it. There were clearly
Well,
supervisory
Mr. Barr, I'm not going to
failures.
ask you to prejudge. I'm going to prejudge. As an American citizen, as a member of Congress, don't you think it's it is a rational judgment that if all these supervisory findings were existing for the last 2 years and this still resulted that there are supervisory issues at the San Francisco Fed?
Sorry, was that was a question? Yeah.
Do you think it's a good assumption to make?
I don't want to assume. I want to go look at the facts. We're going to go look at the facts in this review. I think that overall, at the Federal Reserve, without pointing any fingers in any direction, that there were significant supervisory failings. I said that at the outset of the hearing, that if you have a bank like this that's failing, there are serious management issues, there are supervisory failings, there are regulatory failings, and we're committed to looking at all of those.
And that's fair. Let me throw this out to you. Mr. Chairman, for the record, I want to put into the record, Wall Street Journal article dated November 11th, 2022, rising interest rate hikes, hit bank bond holdings. In this article, it is actually a comment in here by Thomas Honig, former president of the Federal Reserve Bank of Kansas City, former vice chairman of the FDIC, and he says if they go high enough, you can actually be losing money on those assets. He was generally speaking about banks, but not specific banks. This is highlighting that his concern, somebody who was in your shoes and Mr. Grunberg's shoes, was concerned about rising interest rates on bank portfolios writ large. Do you agree with that statement?
Yes, I think interest rate risk, again, is a core risk. We look at it across the system, and banks are supervised for that. It is absolutely essential they manage that risk.
Mr. Barr, let me ask you a question. Do you think that this committee should be talking to SF Fed President Mary Daly? Do you think that she would have some color on these issues that happened at Silicon Valley Bank?
Birds.
I think
looks like.
The committee's decisions about
UAP's pretty
witnesses
high,
is
though,
far
so I think it
outside my
holds there.
expertise.
Let me ask you this question, because actually we've been talking a lot about concerns from a supervisory perspective. You have a speech dated March
How are you
9th,
3Xing your money on HST?
2023 at the Peterson Institute for International Economics here in DC. March 9th is an interesting day.
You're playing with
That's
shares.
the day that SVB blew up. In your speech, you say,
There's no 3X.
the banks we regulate,
Went
in
up $1.
contrast to stable coins and crypto markets, are well protected from bank runs through a robust array of supervisory requirements. You still stand by that statement?
As I said earlier in the hearing, I
Three
think that
times
it demonstrates the need
position?
for humility
Yeah, it's showing
about
a
our
good bounce.
ability to understand
It is
the
respecting that
causes and
support back here.
consequences of financial difficulties.
Nice
So, of
range-
course, that
range
statement in this context is turned out to be incorrect.
Okay, that's fair. Let me ask you this, one last thing. And Mr. Chairman, for the record, I also have another article I want to submit. The U.S. needs a new
Eyes coming
bank
down a little bit
supervisory
here.
system, written by Peter Whelison, who is at the American Enterprise Institute. And in part, it talks about some of the shortcomings of the current supervisory system. In short, I will say this in the final 22 seconds of my testimony. It's been for the last 14
Yeah,
years
hold
in
on.
Congress, we view Dodd-Frank as the
double
holy
bottom,
grail
same as this day.
for safe and sound banking.
If you're going to move to VWAP
And if
before
we're going to be
close.
honest with ourselves, what has been the holy grail for quote unquote safe and sound banking is cheap or free money for balance sheets to look good. But when rates rise, not all balance sheets look good. And that's not just banking, that's in a lot of places. So maybe we should take a look at our supervisory system overall. I yield back.
Gentleman's time has expired. The gentleman from Nevada, Mr. Horsford, is now recognized for 5 minutes.
Thank you to the chairman and ranking member and to the regulators for appearing before the committee. I want to
BBY
start
getting all
by
poppy again.
saying the work that was done to address the Silicon Valley and Signature Bank collapse and ensure
Yeah, it's
the health
interesting how
and
that HST
resiliency of the U.S.
rallies
banking
after the dividend
system
date. It's very unusual.
is vital. And I want to commend those that were involved in the swift action and the decisive steps that were taken to protect businesses' payroll, particularly small businesses and their employees who we heard from at that time. Now, while depositors were protected, shareholders and bondholders need to bear the cost for any potential mismanagement. And I'm eagerly awaiting the full examination of these bank reviews and the upcoming reports that you will be providing. Now, while the collapse of the Silicon Valley and Signature Bank may have occurred due to unique and isolated factors, the panic that their failures caused quickly became a private or a sector-wide issue. And I'm glad to say that the original crisis of confidence was subsided and cooler heads did prevail. I fear that the consequences will continue to materialize as we go on. For example, consolidation of deposits within the largest systemically important banks will only continue if the sense of risk within the financial system persists. Uninsured depositors are leaving our mid-sized banks because they feel that their money is safer elsewhere, even as these banks showed continued strength and sound financial footing. Deposit insurance is crucial for many of my constituents to get a sense of peace of mind, and we cannot have the perception of a two-tiered banking system in this country where only the largest banks are protected. So, Chairman Grunberg, as we look to increase confidence in the banking system with a particular focus on small and medium banks, how would an increase in the FDIC
BBY, back
insurance
to the
limit
highs here.
prevent further consolidation of deposits at the largest banks?
Well, I think, Congressman, I think that question is raised by this episode. The decision to guarantee the uninsured deposits of these two institutions really have implications for the entire deposit insurance system, and we need to consider it. And I'd like to do it comprehensively, looking at all the aspects of our deposit insurance regime, and then come back by May 1 with a report that the
Bath up
FDIC will
2%.
put out, which will also provide
Open the day at
some policy
80.86.
options for consideration.
81.
Right. One other area that I'm concerned about, I've already heard multiple development projects, particularly housing projects in my district that are struggling to
if I
get
can roll.
financing due to a pull back of credit from community banks. While I understand the need to review capital requirements, I think you'd agree, Vice Chair Barr, that no bank can meet $40 billion plus in depositor demands from capital alone. So, Vice Chair Barr, I would really urge you to consider the effects of increased capital requirements on the lending of healthy community banks. However, I do believe that action must be taken. So would you be able to discuss any additional strategies the Fed would be able to pursue to address the problems that we have seen at Silicon Valley and Signature banks without reducing credit industry-wide?
Thank you very much. First of all, the capital
Yeah, to
review
make a
that we're
day's
doing
wage,
does not apply to
holding dividend
community
stocks,
banks.
you need
We're not
like
intending to increase capital requirements on
at least
community banks.
$500,000.
My understanding from
dividends.
looking at the community banking system is that it is well capitalized and stable and is serving its
Really need like
communities. We're
$750,000
looking at larger institutions.
on your lifestyle.
If we do that, we're going to do it through a notice and comment rulemaking process. That takes a good bit of
Maybe
time, and
81
they're
cents.
transition rules. So we're not
I
talking
haven't
about
ordered a roll
capital
my
rules that in any way
one
that
strike
apply
cash
now.
good puts on
We're talking
BBBY.
about how to make sure that the capital and liquidity rules in the future are appropriate.
Okay. And then finally, there were reports that after Silicon Valley went into receivership, they literally advertised that their FDIC guarantee as a way to attract depositors. Is that true? And if so, what's being done? They cannot now benefit from the policy after we helped save them.
That's a fair question, Congressman. We placed Silicon Valley into a bridge institution. There may have been some communications of the kind you described. When we heard about it, we put an end to it.
Thank you. Thank you, Mr. Chairman. I yield back.
Gentleman from Nebraska, Mr. Flood, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Vice Chair Barr, you've disclosed that Silicon Valley Bank's composite CAMELS rating was a 3 out of 5. In response to Ranking Member Waters' question
holding
earlier,
dividends.
you disclosed that their liquidity rating
5%,
was a much
6%,
stronger 2
4%.
Furthermore, you
Not chilling on
testified
any
that
yachts
the
with
Federal
electric
Reserve
helicopter.
examiners cited Silicon Valley Bank 7 separate
That's if
times,
you have
and
many,
you
many
testified that
million.
examiners were aware of Silicon Valley Bank's
Need some
interest
growth.
rate risk
Need
last
some
year.
real estate.
Why wasn't that risk reflected in
Business,
Silicon
cash
Valley
flow.
Bank's liquidity rating?
I think it's an excellent point. One of the things we're looking at the review is, given the extent of difficulties, the problems the firm was having,
Yeah, I
how did
like
the
that idea.
regulators come up with this particular,
Electric
supervisors
helicopter.
come up with this
I haven't seen that one
particular
yet.
approach? Its composite
Guess
rating
they have, like,
was not well managed.
Quadcopters for humans.
And its holding company rating was deficient, that is
That'd be
also
an
not
electric
well
helicopter.
managed. But it
Yeah.
has a 2 for
Human-sized
liquidity
drone or
and it
whatever, how those
conditionally
are.
meets expectations for liquidity. And so we're trying to understand how that is
Emo's
consistent
good. I have
with the
Emo in the
other
long term.
material. I mentioned earlier
Not
too
enough
that,
for
you
the
know, I'm
Fed.
highlighting the liquidity and governance
3M,
and
yeah,
interest
3M
rate
just
risk
lowered
findings.
their
But there were
dividend, I
many
think.
other findings at the firm that had not been addressed at the time they failed. And so the question is, you know, why wasn't that escalated and why wasn't
don't know, we'll
further
see in the
action
next one. I think
taken?
they
I think
just lowered
it's
it.
a legitimate and fair question.
Was that
a pretty
composite
good price.
score, that composite CAMELS rating, ever downgraded in 2021 following the examiner's citations?
I don't know the answer to what happened in 2021. The 2022 rating was the first time the firm had a composite rating for all of its activities as it entered the large and foreign banking organization group.
Vice Chair Barr, was Silicon Valley Bank's liquidity rating ever downgraded following the examiner's citations in 2022, or is that the same issue as you just described with the large bank status, their liquidity rating? 'Cause
The overall rating for the firm, of which this would be a part, was done that summer. There was a process after that of looking at both liquidity
Electric air
risk and
taxes?
interest rate risk.
This
And my
next one in
understanding
Paris?
is part of the horizontal review that was being conducted at the beginning of
That is neat.
2023.
Who's
The
sponsoring
examiners
that?
were looking at, you know, what was the appropriate level.
Okay, every quarter, the FDIC releases its quarterly banking profile. This profile includes a public disclosure of the total assets of FDIC-insured
Yeah, no, I've
institutions
definitely
that
seen
are
'em.
deemed "quote-unquote" problem banks. In
That's what
December of
EBTL is.
2022, the FDIC's problem bank list included total assets of only $47.5
Yeah, BY
billion.
projecting the new high so
Although
far.
the banks on the FDIC's problem list are not public, given the size of Silicon Valley Bank, it's reasonable for me to conclude that Silicon Valley Bank was not on the FDIC's problem bank list, released just 3 months before its collapse. Mr. Chairman, given the several supervisory findings identifying various issues with Silicon Valley Bank's practices since 2021, including the issuance of matters requiring immediate attention from those supervisors, were those findings communicated to the FDIC?
I can tell you, Congressman, that the criteria
and
to
shut
get on
down.
the problem bank list is to be rated a 4 or 5 on the CAMELS rating scale of 1 to 5. And at that time, Silicon Valley was not rated a 4 or 5, so we wouldn't have been in a position to put it on the problem bank list.
Vice Chairman Barr, why wasn't this information shared for the purposes of the FDIC's problem bank list?
As Chairman Grumman just indicated, the FDIC makes an independent judgment with respect to its list based on the ratings of the firm, and the firm was not rated lower than a 3.
Chairman Gruenberg, has Silicon Valley Bank ever previously been on the FDIC's list of problem banks?
The reason I hesitate is we put the aggregate assets of the institutions on the problem list. We don't indicate the individual institutions.
Here you can do that?
No, I take your
And
point.
this is a
I take
question
your
from
point.
Congress.
Yeah, well, I believe I can come back and answer your question if I may. Could we follow up for the record? But be glad to do that. I just want to check, but yes, the answers will come back with an answer.
The answer is yes?
We will come back with an answer for you if that's okay.
Okay. Thank you for your testimony. I still think there are lots of questions regarding what happened here, especially with Silicon Valley Bank, and I appreciate your time. I yield back.
I'll go to the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. Let me thank all of you for your responsibilities and the duties and what you've done. You know, it's funny when you've been here for a
Teleporters.
while, you know, a lot of folks are here talking
Green candle
about
back up.
Dodd-Frank should be the golden rule, but if you were here in 2008 when there was no Dodd-Frank, that was a crisis. That was something, this is nothing, I mean, I wish some of my colleagues who are here, who were not here, we are a long way away from where we were in 2008. And the bank's system is much stronger now than it was 2008. And I say thank God that we had Dodd-Frank at that particular time. So I want to thank you for that. But as a result, let me just ask, maybe Vice Chair Barr, as part of your internal review, you've indicated that you plan to evaluate whether the application of more stringent standards would have prompted SVB to better manage risks. So as part of that, do you expect to look into whether more frequent stress testing for a bank of SVB's size would be appropriate?
Yes, Representative Meeks, we'll look at stress testing. We'll look at really all the enhanced prudential standards, liquidity standards, capital standards,
left
stress
alone.
testing. All of that will be part of our review with respect to SVB, and it'll help inform broader questions we've been working on since I arrived in July about
That
what the
BBBY
capital
hanging
framework
out
for
up
the
there.
system should look like.
Now, are stress test results for our largest banks, those that are above $250 billion, are they are available to the public? Is
Check
that
these
not
guys'
correct?
website.
Yes, the stress testing results are available annually to the public.
And I understand that because of SVB's rapid growth and the timing of when the bank crossed the $100 billion asset threshold, SVB would not have been subject to stress testing until 2024. But when a bank with about $100 billion in asset size is subject to stress testing, who has access to those results? Would, for example, an individual or small business client of the bank be able to see those results?
So under the current framework you correctly described, the Federal Reserve's rules established in 2019 would provide that SVB would be subject for the first time to stress testing in 2024. There is currently, under that structure that was put in place in 2019, no stress testing for firms below the 100 billion level, and that's part of the framework.
So could you expound a little bit more on how helpful it might be for a depositor, for example, to get to see those results, especially depositors who are uninsured, that have uninsured deposits?
So stress testing results for the firms that are in stress testing are published annually. For firms that are below that level in the current framework, they're not required for that kind of stress test. They do internal liquidity stress test as a normal part of their requirements on a quarterly basis. That's an internal proprietary action by them, subject to supervisory review. In the case of SVB, they conducted their liquidity stress test, but the supervisors found that the stress tests essentially were not stressful enough. They were not realistic.
So, I mean, that's, but I believe there's an issue that customers and investors who bank with institutions that are large enough to have triggered a systemic risk exception do not have the transparency into the risk management and scenario plan that their banks may have underway. But in the limited time I have, let me just follow up on a couple of questions that some other people had asked. I am thinking about small banks and community banks, which are very important, and talking about depository insurance, and I know someone was talking about that. Now, to me, not a lot of people, especially in the community banks, have $250,000 in the bank. So this would, but in trying to help strengthen those banks, what I would like to see is some of the small businesses may have more than $250,000 in the bank, and they have to pay employees. And I would like them to be giving them some business. So do you think that, and I don't know, but that there should be some, when you look at depository insurance, a difference between small businesses and personal, as far as that's concerned going forward?
Congressman, that's a good question, and it's one of the things we'll be looking at in the report that we're going to submit on May 1 and laying out some policy considerations to take into account here.
Thank you. I'm out of time, so I'll yield back.
Another gentleman from New York, Mr. Lawler, is recognized.
Thank you, Chairman. Chairman Grunberg, just to follow up on that line of questioning, yes or no, should the FDIC insurance limit be raised?
Let us do the work on this and then come back to you with a report.
Well, in the 2008 collapse, we raised it from 100 to 250,000. We made it permanent in 2010. It has not been raised since then. Do you think it should be raised?
I don't know the answer to that question right now, Congressman.
Okay. Did the Fed, the FDIC, and the Treasury have the tools needed to deal with this crisis when you were made aware of the situation with SVB? Do you all believe, yes or no, that you had the tools needed to deal with this?
Yeah, yes, we have the tools we need.
Yes?
I agree, yes.
Yes?
I agree, we had the tools to
Okay.
prevent a
Did the Fed, the FDIC, and the Treasury have the tools needed to prevent it? Yes or no?
I think that's a very difficult question to answer. I don't have a yes or no answer for it. I think we can do better at supervision and regulation, but whether we could have prevented the collapse
There's
in
no
24
answer for
hours of this
expected EPS.
institution, I don't know the answer to that.
Positive is good.
I agree with Michael's point, but from a supervisory basis, I think there was an opportunity.
I'm sorry, Congressman, can you repeat your question?
Yes or no? Do you think the Treasury had the tools needed to prevent this from happening
The Treasury had the tools to use the systemic risk exception
and used it?
and recommendation to prevent a crisis.
So the FDIC and the Treasury do believe it. The Fed, not sure yet. But so in that case, do you think the Federal Reserve failed here in its role?
I think fundamentally, as I've said, it's the responsibility of bank management to run the bank. The bank managers failed in basic risk management.
Right, but you provided
Maybe you get a little
the Federal Reserve and the San
Continue to
Francisco
show signs of
Fed
support here.
provided guidance, provided notices, and failed to follow up on that, correct?
I would say that there was follow-up. The question is whether the follow-up was stringent enough, and that's part of the review we're looking at.
But stringent enough really means that the individual people may or may not have done the job that they were supposed to do, correct? Because if you give the notice and you reach out, isn't it incumbent on the individual supervisors to actually follow up and make sure that the bank is doing what it needs to do?
It's incumbent on the bank to take the actions that the supervisors are directing them to take, and it's incumbent on the supervisors to check on that.
Did the supervisors fail to check on that?
No, I didn't say that. What I said is that it's incumbent on the supervisors to do that. I think it's a legitimate.
Did they do that?
I think it's a legitimate and fair question to ask whether they were stringent enough, whether they used enough tools to force the bank managers to do what was obviously right.
With respect, that is semantics. Did they do the job they were supposed to do? Did they follow up?
The reason I'm having difficulty answering the question is I believe they did follow up, but the bank managers did not perform on the job, and that's why we're looking.
Were California and New York regulators equipped with the appropriate tools to handle this? Or should these banks, specifically SVB, given their size, been federally chartered instead of state chartered?
I think that our country benefits from having a wide diversity of kinds and sizes of institutions and the diversity of chartering authorities that we have, so I'm not recommending that we change that.
Okay. When did any of you first speak with Superintendent Harris regarding Signature Bank? Just date, please.
I'd want to check the record on that. If I may, I will come back to you. I just want to be sure we're accurate.
Okay. Do either of you know when you first spoke to Superintendent Harris?
I do not. I mean, Signature Bank is an FDIC in New York state-regulated institution, but I don't know when I first had a conversation about it.
Okay. Chairman Grunberg, when was the decision made to close Signature Bank, and what criteria were used to determine whether or not Signature Bank met the systemic risk exception?
Those are two questions, Congressman. The decision to close the bank is the authority for the state, and the state made that decision on Sunday. And what was the question in regard to the systemic risk exception?
What criteria was used to determine that?
Oh, I think we had before us a failure of two institutions, both Silicon Valley and Signature, and we also had before us evidence of significant liquidity stress at other institutions, and we had data in terms of deposit outflows, and I think that was basically the data we relied on in making this judgment.
If the chair will submit that data for the record and answer for this,
Yes.
would you be willing to do that? The data
Yes, of course.
related to systemic risk designation.
Yes.
Okay.
Thank you,
Or
Mr.
systemic risk event. We'll now go to the gentleman from Iowa, Mr. Nunn, for 5 minutes.
Thank you, Mr. Chair. Thank you for being here today. If you would just, with a show of hands, do you believe that, as most Americans do, as I've said and as the President said, that taxpayers should not be on the hook for that? Would you agree with that statement?
Yes.
Further, would you agree with the statement that we should have diversity within our banking system?
Spy ripping up here.
Yes.
Choppy today. Not a huge range either.
Specifically, then, would
Pretty
you be
tight.
supporting our regional banks, our small and local banks,
Directionless.
and recognize
But we did
the
have a big
undue
gap
burden
up,
that
so
they potentially
just holding high levels,
are going to be
really.
saddled with as a result
Still up
of
over
a
1%.
FDI assessment because of these two
Bed
banks?
Bath is holding up these highs. That's pretty good.
As you may know, Congressman, I responded to that issue, and the answer is the FDIC has authority under the law to consider who benefits from the assistance provided, and we'll take that into account with particular attention and sensitivity to the impact on community banks.
I appreciate that, Mr. Gutenberg. I want to specifically talk to Mr. Barr here. For the diversity in banks, when you do your holistic capital review of banks under $10 billion, what would that look like?
We're not anticipating in any way raising capital requirements with respect to community banks. It's not part of my holistic review.
Good. I'm glad to hear that. Second, I'll highlight here $22 billion, as we say in Iowa. That's a lot of money. And in fact, it's 20% of the entire FDIC's fund for this. In order to make that up, special assessments will inevitably have to be part of this. Do you see that being passed along to the top banks primarily, or how will you calibrate that?
Well, Congressman, it's relevant to my response before. We're required by law to pay for any cost to the Deposit Insurance Fund caused by the coverage of the uninsured deposits through a special assessment. We have to do that by notice and public notice and rulemaking, and we have authority under the law to consider the types of entities that benefit from any action
Oh,
taken
you see that
for
pop?
assistance provided.
So I understand
Caught
that,
it just in
but I
time.
wanna
Look at that,
highlight
new high on
the
EBTL.
difference here. We had two banks that had
Big
90%
explosive
of their
technical
depositors
move.
uninsured at any level.
A lot of
My-
volume there.
Most banks across America are at 47%. My state of Iowa, in Des Moines alone, it's 70%. And my rural guys, it's
22% on
7%. I mean, these
EBTL.
are farmers who are looking to plant this spring who know that they have a good deposit there. It's small businesses that are supported by this. What they don't need is ultimately, to my original question, a increase on their cost of living, on their cost of doing business by a special assessment that disproportionately punishes those who are at the medium and small size. Are you committed to making sure that's a priority for you?
Yes.
Excellent. Last question. I want to be brief here. Silicon Valley Bank did not have a chief risk officer, Mr. Barr, for how many months?
I believe it was approximately 8 months.
So almost a year. During that time, they did have 4 members who served on something called the Governance and Corporate Responsibility Committee. And these 4 members were actually on their risk committee, but had no, as I understand it, actual experience in managing material risk. Were these individuals focused on the wrong thing, and was there no true risk management being taken at Silicon Valley Bank in the lead up to the fail?
I can't speak to the particular individuals. I can say that the supervisors told the board of directors and the bank that the board oversight with respect to risk management was deficient. That was one of the findings that was made in the summer of 2022.
So then, did beginner risk management of interest rate risk and liquidity risk cause this bank to fail, SVB specifically?
Yes, ultimately, they mismanaged their interest rate and their liquidity risk, and their very large percentage of uninsured depositors had a massive and unexpected run. As I said, $42 billion on a Thursday, and expected another $100 billion on Friday, and that was just a devastating run for the institution.
So I'd like to ask this question then, and I hope that Mary Daly has the opportunity, Mr. Chair, to testify in person before this committee. But as you're overseeing this, why did she tout the regional Fed's work on cataloging climate risks, even going so far as to assemble a team to study how these risks are likely to impact the Fed's future reserve mandates? And I'll state here that one of SVB's memos from their supervisory credit group claimed they had been working closely with the Fed to inform its agenda priorities, namely fiscal risk to banks from climate change. Were the regulators focused on the wrong risk posed by this administration? Yes or no?
The supervisors were focused overall in the system on interest rate risk, credit risk, cybersecurity risk, traditional risk in the banking system. There are some supervisors who are focused on climate change.
But there was no risk officer to look at the actual dramatic overage that they had at this.
I think it's bottoming.
I'm sorry, you're talking about the bank risk officer?
Thank you, Mr. Chair. I yield back my time. I'll submit the rest of the questions independently.
Gentlewoman
Yeah,
from
it's a streaming
Texas,
service.
Ms. Dela Cruz is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, witnesses, for being here today. What we've learned in the wake of the first run on a major U.S. bank since the Great Recession is that the management team of Silicon Valley Bank took, quite frankly, foolish actions that no informed financial institution should ever make. Now, by taking on deposits from their customers, which is short-term in definition, and by long-term bonds, when interest rates were low, now that is before President Biden's inflation crisis, they chose to become vulnerable. When inflation
Oh, yep, gotta cut her off.
Now, that is before President Biden's inflation crisis, they chose to become vulnerable. When inflation
Oh, yeah, they did. Something happened. He rarely respecting that.
research paper
Our calls.
a second ago that some were focused on climate change. My question is to you, Mr. Barr. I realize you didn't come into your role until July 2022, but isn't it correct that when you did, you quickly announced your holistic view of Fed regulations and your own Fed special scenario analysis for weather and climate risks?
Those are a few different items. I announced that I was doing a holistic capital review, which was looking at capital in the system, whether it was at appropriate levels. We've been conducting that really since July. There's a separate thing, which is that in the beginning of this year, we piloted for the globally systemically important banks, GSIBs, a pilot of climate scenario analysis to evaluate how they were addressing climate risk in the system. That's separate from basically what most supervisors are doing most of the time, which is highlighted in our November 2022 supervision report, which is looking at interest rate risk, credit risk, liquidity risk.
Which we could both agree that interest rate risk, liquidity risk are within your job scope, but is climate risk really something that you should be focused on? When we saw all of the red flags on this bank. Now, correct me if I'm wrong, but isn't the role of the vice chair for supervision to focus on bank supervision and regulation? Yes or no?
Yes, that is in fact what I am focused on.
Oh, same hearing from
So
today, yeah.
if that's the case, then were you distracted from the mission of your role, which again is supervision and regulation, and instead focused on climate?
No, I would disagree respectfully with that. The way that we're looking at climate risk is about the risk that climate change might pose to the financial system and to individual banks. It's a very narrow role focused on financial risk, not climate policy more generally. And I think, as I was saying before, we need to be humble about regulators' ability or banks' ability to understand all the risks in front of us. It's prudent to look at long-term risks as well as really obvious and central risks right in front of us, like interest rate risk and liquidity risk.
Well,
by
I would say
ripping
that
up
what we
here,
saw
about
with
to make a new
Silicon
high.
Valley was obvious risk. It looks like the mismanagement, it was flagged. There were fair warning signs. And while I appreciate
BBY, let's hit
that
$1 today.
you were able to focus some attention on the actual supervision part of the bank regulation, we see a gap here. And I think that we would like you to focus on your job as the vice chair of supervision in the wake of
didn't sell now,
SVB's
Ace.
collapse. And
Up like
I feel like this
4
was
cents.
a little too late of when you all finally stepped in to look at it. So thank you. With that, Mr. Chair, I yield back.
We'll now recognize the gentlewoman from Indiana, Mrs. Houchin.
Thank you, Mr. Chairman. We are here today to really determine who knew what when, who did what when. Is this a failure of Silicon Valley Bank? Is it a factor of lack of adequate oversight or lack of regulation? I'm happy to hear many of you testify today in admission it was largely a factor of lack of oversight. We've heard discussions today about FSOC, the Federal Stability Oversight Council. Vice Chair Barr, what's the purpose of FSOC?
I'm sorry, the question is, what is the purpose of FSOC?
What is the purpose? What is the mission of FSOC?
The FSOC is an entity that brings together regulators from around the financial system, market regulators and bank regulators, to look at risks in the system and to try and coordinate across those agencies.
Right. So it was created by Dodd-Frank in 2010 to provide, according to FSOC's website, comprehensive monitoring of the stability of our nation's financial system. It's chaired by the Secretary of the Treasury. It includes the Fed, the OCC, CFPB, FDIC, CFTC. In fact, all of our witnesses today take part in those meetings. Do you not? Yes or no?
Yes, each of the three of us participate in FSOC as member agencies.
And the function of FSOC, is it also to identify risk to the financial stability of the United States? Mr. Barr, yes or no?
Yes, that is among its functions.
Following an executive order by President Biden in May of 2021, entitled Climate-Related Financial Risk, FSOC now also evaluates climate-related financial risk. Is that right, Mr. Barr?
That predates my time, and we're not in charge of running the FSOC, so I don't know the sequence of events, but
I
it is the
assume
case.
that it is now part of FSOC's charge to monitor and evaluate for systemic risk also?
I'm sorry, I couldn't hear the last sentence.
I assume it's also part of FSOC's charge to monitor and evaluate for systemic risk.
Yes, that, as I indicated previously, is a core function of FSOC, is to look at risks across the financial system.
In a quick review of the FSOC meeting minutes dated December 16th, 2022, 5 pages were devoted to, quote, climate-related financial risk. Mr. Barr, many of those comments came from you. I couldn't find any pages devoted to market and news reports of the apparent looming problem with Signature Valley Bank and Signature Bank. In fact, in December of 2022, Signature Valley Bank was listed on the S&P Global Marketplace as the top U.S. bank by proportion of uninsured deposits at nearly 94%. Only 4 other banks were estimated to be above 80%, including Signature Bank, but none of that was mentioned in your December 16th meeting. Are those factors not important to comprehensive monitoring of the stability of our nation's financial system, Mr. Barr?
I was asked at the meeting you were describing to discuss one risk to the financial system, and that was with respect to climate risk.
Let me just ask that question one more time. Are those factors not important to the comprehensive monitoring of the stability of our nation's financial system? The debt ratio, the uninsured ratio, is that not important?
The standard factors we think about in banking, among those factors are interest rate risk and liquidity risk. Those are core issues that we do in the bread and butter supervision every day.
So do you not consider the uninsured ratio as part of a factor of systemic risk?
We look with respect to microprudential
Grabbing some
supervision
shorts
of
up here. It
individual
looks like a triple
firms. We're
top.
looking at their liquidity risk, and one element of their liquidity risk is the extent to which they rely on uninsured deposits. That includes uninsured deposits from financial entities, uninsured deposits from operating businesses, and then their insured deposit base. So it is a core part of what we think about when we think about liquidity risk.
But none of that was discussed in the December meeting relative to Signature Bank or Silicon Valley Bank or any system gap.
as I said, the specific request to me in that meeting was to talk about this issue. We obviously talk about broader
Many other
issues all the
yeah,
time.
I get that. Secretary Lang, earlier Chairman Huizenga was asking about the minutes taken at the meetings for FSOC. You said the meeting minutes are published after the next meeting. However, it seems there's more detailed information than what is shared publicly, and that the closed executive session meeting minutes are not shared at all. Will you commit to providing this committee with unredacted minutes from every FSOC meeting since the March 10th meeting, including closed executive sessions?
Congresswoman, I'm aware of 2 FSOC meetings since these events, March 12th.
Will you
and
commit to
March
providing the
24th.
meeting minutes for the executive sessions?
They were executive sessions, and we do produce minutes, and we will release them.
Thank you. I yield back.
We'll now go to our final 2 questions. So the penultimate questioner, Mr. Ogles of Tennessee, is now recognized for 5 minutes.
Well, good afternoon, and thank you for being here. I know it's been a long day. I'll try to be brief because I know you guys have to be exhausted. You know, Mr. Barr, when you look at increasing interest rates, especially in a rapid environment, you know, is that going to create risks when it comes to deposit structure for these, well, really any bank, but certainly as it pertains to small and mid-sized banks?
As interest rates change, whether they go up or down, they create risks for banks, and the expectation is that banks manage those risks, and most banks in the country do manage those risks quite effectively.
Now, the regulatory regime that's in place, do they give specific guidance as it pertains to those risks in a rapidly changing environment?
We do have standard guidelines that are issued to banks about how they conduct their internal liquidity stress tests. Those tests are supposed to be designed to stress stressful environments with significant increases and decreases in interest rates. So they're not directionally guided. They're supposed to test up and down.
Well, as far as some of the guidance that was given specifically to SVB, and I think my colleague from across the aisle said they blew you guys off, what types of guidance or alerts were given to SVB?
So Silicon Valley Bank was required to conduct internal liquidity stress tests on a quarterly basis once it reached a certain size. It conducted those tests, and the guidance back from the supervisors was that the tests were inadequate.
Now, so understanding that you have a bank that grew rapidly in a very short period of time, there was even a Wall Street Journal article dating back to November 11th of 2022, singling out SVB as a potential risk to the banking system. So clearly it was on people's radar. At any point, I think you stated earlier that, you know, you need further regulatory action from this body to further give you teeth, if you will, as you move forward. Did you ever request a hearing on SVB of this committee of jurisdiction, understanding that there was potential risk in the market?
Representative, I haven't asked this body for additional authority. I said we were conducting a review of our existing authority to see where we could have done better on supervision and regulation.
Well, you know, when I think about this situation, and I think about my district, which is although it has part of Nashville, it's predominantly suburban and rural. What's going to end up happening is my small banks, my community banks, are going to end up bailing out a couple of banks that are too large to fail. And so I'm curious, Mr. Grunberg, you know, if my banks receive an assessment from the FDIC and they decide to blow you guys off, is there going to be some sort of regulatory action? Are you going to send them a bill? Are you going to enforce that assessment?
Well, Congressman, and this has come up previously, we're required by law to the extent there's losses to the Deposit Insurance Fund as a result of the coverage of uninsured deposits, to impose a special assessment on the banking industry. And we're required to do that through a notice and comment rulemaking process. Right. And as I indicated, we also have authority.
So I guess to the heart of the question, though, is would you go to the bank and say, we want our money? Is Yes or no?
The answer is, if they were subject to the assessment, the answer would be yes. We do have authority to consider the types of entities that benefit from any action taken or assistance provided.
Well, see, the thing that's important here, though, is I've got to go back to my district and tell my banks they're not going to get screwed over in this process. And what I've heard today is a bunch of tap dancing and no assurances to my district and my banks that they're not going to have to bail out basically the failures of the regulatory bodies that were empowered to do a job. And if you found yourself unable to do that job, you could have come to the committee jurisdiction and asked for support. But I find no evidence that you did so. Mr. Chairman, I yield back my time.
Gentleman yields back time. We'll now go to the ultimate questioner, the gentleman from Wisconsin, Mr. Fitzgerald, for 5 minutes.
Thank you, Mr. Chair. Yeah, I've heard that the same question asked 100 different ways over 2 days. The thing that I'm concerned about is it seems like a bank, shutting down a bank is messy. And I'm not sure if we're nimble enough or if the Fed or the FDIC is nimble enough that if we have multiple institutions that are all failing at the same time as to whether or not we could address this, because there seems like a 3-day period in which everybody was kind of making arbitrary, I'll say arbitrary decisions, not necessarily guided by any specifics. And if there is a table of specifics on what is the red flare that says this bank is in trouble, we need to act quickly, I'm not convinced after 2 days of testimony that that actually happened that way. So I would ask either one of you to first comment on, can you instill more confidence that in fact we do know what we're doing and we can react quickly, and if it is multiple banks, that we're going to be in a good place. And then I have one more question after that.
Well, I can say in regard to Signature that they basically ran out of money to meet their obligations, and that was the reason the bank failed. As I indicated earlier, they barely met their obligations at the end of the business day on that Friday, and it was clear to the state regulator, New York State, as well as to us, that they could not open on Monday and get to the end of the day based on the liquidity they had, and that was the reason the bank was closed by the state. And I'll let Vice Chairman Barr speak to Silicon Valley, but it was a pretty straightforward decision and a traditional one.
Turca? Seriously?
Similarly, Silicon Valley Bank basically was unable to meet its obligations in the ordinary course of business. They suffered a devastating run, a $42 billion run on Thursday. On Friday, they expected
for GNS?
to face a run of $100 billion, and they did not have the collateral sufficient to support discount window letting, and so they were not able to meet their obligations, and they were closed.
And then the last question or comment, I'll just, Ms. Liang, when were you informed, first of all, that there was a possibility of Silicon Valley Bank defaulting? And was the president made aware of that? How much conversation was happening within the White House? And were there conversations with specific depositors or those that had an interest? Like Governor Gavin Newsom in California.
Just right at that 3 o'clock.
Further learned that the state makes a decision on actually shutting down the bank. What were those conversations like, and could you characterize them for me?
So I learned, Treasury learned, or I learned, I can speak for myself here, of the issues at Silicon Valley.
CNS closed, getting wild.
Either Wednesday evening or Thursday, after it issued its statement, its earnings report, saying that it had a loss.
Bed Bath holding up pretty high.
Capital. We heard certainly Thursday night of concerns at the institution.
Holding up above 80 cents.
Very, very rapid deposit withdrawals. And then on Friday morning, we learned the California state regulator had closed it, and the FDIC.
Dude, we can't hear you.
Receiver. We did.
What?
That was our situation. Over the day of Friday and Saturday, we heard from many many people, institutions, businesses, wondering how they could access their deposits, could they make payroll.
Big old red candle and
And so
spy,
we were
man. What
gathering
the heck?
information and consulting regularly with the Federal Reserve and the FDIC. So
Did
that
you,
by
did you speak to,
Sunday, we could
did
make
you
a
speak to
decision.
Governor Newsom at any point?
I did not.
Did anybody at the White House talk to Governor Newsom?
I do not know.
Okay, thank you. I yield back.
Gentleman yields back. With prior agreement between the ranking member and the chair, I'll now recognize the ranking member for such time as she may consume, and then I'll close.
Thank you very much, Mr. Chairman. Chairman McHenry, I thank you for working with me on holding this bipartisan hearing, and I look forward to additional hearings on these bank failures. Importantly, we need to hear directly from the CEOs of SVB and Signature Bank. I also want to thank our witnesses and their staffs for the countless hours they've spent since the failure of SVB and Signature Bank. The economy is stronger today because of your decisive actions. I look forward to hearing from you again when you have completed your review of the bank failures. And I expect those reviews will consider the various matters raised by myself and committee members here today. In listening to the concerns of members on both sides of the aisle, I must say I'm heartened by how much agreement there was. I heard Republicans argue for
Spy
our
right
bank
back up.
regulators
Wear your big
to be
wig
more
there.
aggressive in their bank supervision, to do more on-site exams, escalate penalties more quickly, apply enhanced prudential
Birds coming
regulations
down.
for all banks over 100 billion,
BBBY.
expand deposit insurance,
GME rejecting that 50
and
moving
protect
average.
community banks
SI back to the
from bearing the
lows.
burden of these bank failures. I
$1.82.
and my Democratic colleagues couldn't agree more. And so I look forward to
Maybe the
working with
plunge
Chairman
protection team
Henry
out. Why did
on
plunge though? That was
legislative
weird.
reforms to effectuate those reforms quickly. Again, I thank the witnesses for being here
Give us
today
another engulfing candle.
and doing
Tease me.
everything that you could possibly do to respond to the questions and the concerns that you were presented with today. Thank you. I yield back.
There it
I wanna thank
is.
the ranking member.
Now it's coming down a
and,
little bit.
I want to thank the ranking member on our joint call for this.
RSI divergence here on the 5 minute
The
also.
agreement we had was to pursue this to find out the facts. I think that's the way the committee comported itself today. I think I won't speak ill of the Senate, but you had a hearing yesterday, and this today was a different hearing. That was the expectation that the ranking member and I both had, and I think it met those expectations. But bottom line for you as the panel, there's bipartisan frustration with many of your answers. There's a question of accountability and an appearance of a lack of accountability. I hope you hear this clearly, not as a partisan act, but as a sincere concern. I think furthermore, there's a lack of transparency. Transparency in the decision-making by you sitting on this panel to answer for your decisions in that week and that first weekend. And while I think we're able to start painting a picture of what happened, there's still much that we need to understand, specifically timelines of what you knew when and how you responded. I think those are very important things for you three on this panel to answer fully for, in the name of transparency, but frankly, in the name of building confidence. So there are still questions.
Turkish still
that
going?
Somehow, after 3 weeks, that many of you,
Yeah, 45%,
many of you have
jeez.
given here, that you're going to check with staff, you're not sure.
Was this another one going after shorts?
This is not a gotcha hearing. This is not a surprise thing. We expect a little more detail than what you provided in many of your answers, specifically the timeline, the data used, and the evidence for your decision-making. And we need leadership. Leadership in that key moment of that week, we want to understand that, the decisions, the decision-making. And we've put you in these positions. You've all Senate confirmed in very
How
powerful
true that
positions
is.
in our government. We want you to be capable of achieving good outcomes for the American people and the American economy. We want you to be competent in carrying that out, and that's why we have oversight. And over 5 hours in, you've certainly submitted yourselves to oversight. We will have written questions. For the record, we ask that you respond in a timely manner. But the final note I'll say is understand, in a time where there may be a bit of a political divide in America, I don't think you heard that, by and large, in this hearing, both sides of the aisle. There's sincere concern. And so we ask you to submit in writing these questions. And we know here on Capitol Hill that our work's not done. And we will have oversight of this, independent of your actions and your coordinated effort on oversight with these reports. So I'd like to thank Vice Chair Barr, Chairman Grunberg, Undersecretary Lang. Thank you for being here today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair. The questions will be forwarded to them for a response. I would ask the witnesses and their team behind them
That's true, no halts there.
no later than April 28th, 2023.
They want it to
as
go.
you certainly work to your self-imposed deadline of May 1st. We are also working to conduct our review together
Oh,
with
the
the Government
turntables.
Accountability Office. We ask for your full participation in data and
Sell
evidence in
it.
particular to support that investigation and oversight. The hearing is adjourned.
That's it. No more banks. I've had enough.
So what you're
I know
saying?
you're a Nike guy.
What
but,
you're saying?
Ken, but-
Lulu is now a consumer staple. Is that what you're saying?
Turker's still going, man.
Move it over to that category just yet.
Yeah, $130 joggers. What's not a staple about that? But the stock is
ECT up
reliable.
8.
And at the same time, you got the Micron report that kind of
That looks
suggests
good.
maybe
Nice-
they're seeing some
nice
light
grind
at
up
the end of
that
the tunnel on
moving
probably a
average.
much more important sector ultimately and
You're gonna
more
break out
indicative
up
of
here.
the economy. But stocks on a great day. You put these two together, and I can kind of see where the rally comes from.
Well, chips in general, combine
True, they
Micron's
know.
earnings and the theory behind Micron's earnings that the worst is over.
Watch
That might
the
be
yoga
the bigger
now.
story coming out of it because
Evital coming down.
They missed on earnings.
Back
They,
to
they
VWAP,
they
it looks
missed
like.
on revenue, but the general
Birds
theory
just
is
below
that
VWAP.
the worst. This was their worst quarter, and they're starting to turn the corner. Not only did Micron take a bid from them, but all the
BBBY.
chips did.
Made a new high on the
Combine
day.
that with Intel's Investor Day.
Nice,
where
it's
they're
over
putting
80
out some
cents. Let's
better
see here.
news, and chips are
See if we can hold that.
strong across the board, Oliver. The S&P sector on chips up 1.9% on information technology.
Micron now up almost 8% on the day. This is not NVIDIA. This is not AMD. That's pretty big by Micron standards.
Yeah. Oh, Micron not historically a volatile stock.
You see
so
Gen A.
this is more named the grind. So for it to move like this, yeah, fairly significant.
They still lost money on the bottom line.
Yes.
You can see the pain, but it's mostly on the trailing basis. So that outlook is definitely
Gen
key
A.
here. Thinking about the main driving force of this market right now, though, Kev, when we've got inflation on Friday, is this type of rally putting us on the path to break out, you think, or is this still the major hurdle that we got to get through with PCE?
You know, since the beginning of early to mid-February, Oliver, you look at the movement in the major parts of this market, like the U.S. dollar that you mentioned, like yields that you mentioned, like even crude oil that you mentioned, the VIX, they're all calming. They're all lower. I mean, now crude oil has come back off its lows, but it's still down from early to mid-February. All these are giving people just a little better feeling about this. It looks like the problems that erupted from banks are dissipating. That gets better on a day-to-day basis. The headline risk isn't there from the banks. Could pop up again at any moment, but right now, every day that there's no news is pretty good news for banking. So I think there's a little bit of relief in some of these numbers, Oliver. Housing getting significantly better, data point after data point, but Oliver, still, income and outlays on Friday has to come in favorable or more pressure.
Exactly. Good reminder, too, on housing, because we had mortgage apps solid again. Penny
Republican
home
U.S.
sales
Representative
solid.
Hearn
Thanks, guys.
says
We
Fed
began
Chair
the
Powell
Hampshire
in
started
meeting
here
indicated
with
one
some of the
more
big
interest rate
movers
hike this
behind
year.
the strength today. Let's talk some more about the banks and the structural situation of finance here in America with Cullen Roche. He's a CIO at Discipline Funds. Cullen, where do you stand now that we've had a couple weeks to process the bank fallout? Is there fallout? Is there still debris? Is there more to come? Tell me where you're at right now.
Yeah, so I've shown you their tools before, and they're, you know, the Fed's favorite tool is starting to work here. So, but, you know,
there's good and bad. You got more props for us today, Cullen?
No, that's it. Just this big sledgehammer. But no, in all seriousness, the good news coming out of this is that we now know this is different from 2008 in that the Fed isn't going to be surprised by anything that comes up and hits the banks really hard. So, you know, this is actually one thing that the Fed is very good at. They're very good at responding to these measures of illiquidity or problems in the banking sector and solving them quickly. And so, you know, they've got so many tools in place following 2008 and then the 2020 hiccup that I don't think that a 2008 type of liquidity or banking panic is really a big worry here. We know they're going to jump on that stuff quickly. But the bigger worry in the long run really is that the Fed is still sort of, in my view, fighting the last war. They're worried about inflation still. They still think that there's a high risk of this being the 1970s. And, you know, we've talked about, I think last time I was on, I talked about how inflation risk was transitioning into credit risk. And the weird thing with Fed policy now is that where they're at is going to exacerbate credit risk going forward. So the risk now, in my view, moves to credit risk going forward into 2023 and beyond. And that risk is going to be exacerbated by the Fed's current positioning.
Okay, so the Fed really, to address inflation, has only got that one big sledgehammer tool.
Saudi Arabia has joined a China-led security bloc and trade alliance with China, Russia, India, Pakistan, and others.
Maybe a wider tool belt of options. Does that mean we've moved past it, that they've, sutured the wounds and we're good to go?
Well, I don't think the banks are necessarily out of the woods. I mean, the biggest worry for me actually coming out of this whole event is that you're just going to see sort of a slow bleed of deposits continuing to flow out of, especially the smaller banks, where people are sort of sitting around wondering, you know, hey, it seems like the federal government really only supports these 8 big, you know, global systemically important banks. So why am I even risking leaving my money in some of these smaller banks? And so you have this scenario here where you could get almost like a, you know, not a run on the banks, but kind of like a slow trot out of the banks here, where people are just slowly bleeding deposits out into the bigger banks, or also into, you know, just money market funds and treasury bills, where the banks are slowly bleeding deposits. But I don't think that this is going to become a sort of 2008 in large part because the Fed is going to be so responsive to liquidity problems within the banking sector.
I know you want to, you've got some charts on credit. I want to get to those, but just to go with that a little bit more without getting too kind of off the rails here, because there's a lot of folks who interpret that slow drip of deposits out and concentrating now into the bigger banks as nationalization of banks or a major
new high on the SPY, 481
kind of economic understanding. I mean, is this a big problem, Cullen? Because I mean, I see this. Isn't this kind of what happens in every sector to some extent? You know, I could have gone to buy games and electronics at a billion different stores in the 90s. Now I download them all online from one of 2 places. Everything that happens on the internet basically happens in 3 or 4 search giants. And is this just not kind of what happens over time? These cloud companies are all going to get gobbled up by Salesforce and a few others over the next decade. Why shouldn't the money flow up into the top 10 banks who demonstrated they can handle it?
Look at that
it's
move
kind
on
of a
SPY.
good question. I mean, we have, what, 4,500 banks in this country. You know, I think Canada has like 5 or 6, you know, that are at least important. So, I mean, there's actually a reasonable perspective here where you kind of sit around and you ask, you know, do we have about 1,000 or 2,000 more banks than we actually need in this country? And, you know, the FDIC is sort of in an interesting position here because FDIC insurance is really designed to protect smaller banks. You know, the more sensitive banks to these sorts of runs. And so, you know, the FDIC is in a weird spot where they can't come out and really say, hey, we're going to, or the Treasury can't come out and say, hey, we're going to support all deposits. But at the same time, they have to sort of position themselves in a way where the globally systemic important banks are the ones that they really have to protect, because you can't have a situation where SVB is happening to something like Bank of America, because that's obviously just a much, much bigger systemically important problem.
Yeah, okay. So even if the money does flow up, it might command some type of increased scrutiny or changes to make sure the stuff doesn't happen now. The money's getting more concentrated.
Yeah, but if it flows, I mean, I think the bigger point is that if some of the money flows out of these banks and some of these small, really sensitive banks actually fail, I mean, in the long run, maybe that's not such a bad thing. I think there's a good argument to be made that we shouldn't just have 8 monopolistic or oligopolistic types of banks, but the argument that, hey, maybe we have about 1,000 more banks in this country than we need is not an unreasonable one in my view.
Yeah, I hear that. Okay, so monitoring
trading on the long time frame, I see it being bullish.
Very well
should have stuck with it today. I ended up taking the short, which worked.
What are you looking at?
But I should have been looking for really dip buys.
I know that one of the things you track is lending standards. How do we measure
that? I guess the 400 level is
yeah,
kind
so
of
we're
throwing
kind
off
of
a little
in this
bit.
classic part of the credit cycle where consumers
that.
have actually, they respond to Fed tightening
But now
typically by borrowing more because the economy starts to slow in certain sectors, and so consumers actually start to borrow more at this point. But that's also the point where, as rates rise, where the Fed's starting to get really aggressive, the lending standards actually surge. And so lending standards are surging, which means that it's going to actually become harder for consumers to start borrowing more and more going forward. And so that's really the big risk in my view going forward, is that is it going to be harder and harder for consumers to maintain their living standards because of the high rate of inflation we've experienced by borrowing more, or will banks snuff this out? And that's actually the biggest risk of this whole banking panic, is that banks are now much more likely to increase lending standards even further because they're in total risk-off mode. They're moving out of a view where they're profit maximizers to more of a view where
Russia said that it will no longer
give
the United States advance notice of its missile threats.
Anything that was remotely risky in the last 12 months that was on their loan books, they are cutting all that stuff. If you're a high-risk borrower at a 7% mortgage rate, you are out of luck. So going forward, I think lending standards are going to tighten further. Consumer credit is likely to start rolling over, and you start to see more of a situation where total loans start to roll over too, and that's indicative of just slower growth.
There's quite a bit of volatility in the chart that we're looking at here for lending standards, just because of COVID, basically, where there was this extreme tightening.
Won't quit, man.
But then it reversed
massive
quickly.
green
Is
candle.
there a possibility
Or
that
170.
can happen again if
Kind of the next
there
level, I
isn't,
guess,
like,
I have on
another
here.
big domino to fall?
Not a whole lot of
there's
big
this knee-jerk
resistances,
response,
though.
But then maybe 6 months from now, we're going, okay, actually, we thought maybe there'd be some skeletons in the closet. Closet was empty.
And really, the next big one is this 405, and then that gap
It could.
fill.
A lot of this is so contingent on where the Fed is at in 6 months, and the risk that I alluded to earlier was that the Fed is so worried about inflation being a perpetual concern going into 2024 that the likelihood that they're going to still be tight in 6 months, in my view, is very high. I think they're going to be at 5% basically the rest of the year. The outlier risk is that would flip all this upside down is, does something bigger, more panicky occur where the Fed then, I keep saying they're not going to pivot, they're going to backpedal at some point. And is there going to be an event that forces them to backpedal? And when I say backpedal, I mean they're going to drop rates to 2.5 overnight, or 2, or who knows, something. If it's big and bad enough, they drop it back to 0, and that causes the flip of everything here, where then lending standards loosen just because Fed policy loosens so much and credit becomes so much easier.
Okay, well, we'll get there when we get there, one step at a time. Right now,
Sure,
it
it's
looks
kind
like
of bouncing
credit
on that
tightening
level,
response, and
2340
based on
or
last
so.
chart we were looking at from yield curve inversions, that probably total loans begin to slow down, to your point. Thanks a lot, Colin. Always a good macro look. Appreciate it.
Yep, good seeing you.
Colin's a CIA.
Yeah, it wasn't a whole lot of downside. I think we caught
Ross Gerber on deck.
biggest downside move today from distant Gulfing down to here.
California, as the bank fallout was centered there. But
Overall, not a huge move intraday, really. Like,
stocks on the mind of
pretty
the
small
Gerbs when we
body.
come back.
Still 40 minutes, I guess. You could just keep getting crazy. Seems like it's going to. Carvana is still up a little bit. Another percent from earlier. Yeah, breaking out, new high. Mexico City, huh? That's like top 10 cities sizes in the world. Top 5 even, population wise. Only flown through. Did have a dip. HKD. Up 3.3. Sure, I think it's top 10 and top 5 population. Modern industrial landscape. I think it was like, I don't know what it was. I remember when we flew in there, I looked it up, and at that point I think it was like top 3 even. Which I was really surprised about. But maybe I was mistaken. iBorrow's still down. Oh, never mind. Back up. GME cost to borrow 14%. Come down quite a bit, and tons of shares. 2.4 million, 14%. See the borrow fee here. It was 34, now it's 15. Sometimes that means it's about to rip. Sometimes we get rips when it comes down. When the shares become available. I don't know why. Elbiz. Oh, Elbiz is pretty low, 9.8. Oh, it's Evital that has almost always a high one. Yeah, this thing doesn't know what less than 100% a borrow fee is. 122% is low for it. I'm gonna have to cut it. I've got time to do a recap video. Thank you guys for your support. Ace, again, thank you for your memberships today. Big hugs. Thanks for your dono. Much appreciated, guys. Yeah, fun hanging out, listening to all those hearings. Crazy. Thanks, Donaro. Thanks, Ace. Thanks, Kuro. Thanks, Big Hugs. Thanks, Tree. Thanks, Christopher. Thanks, Mahmood. Yeah, we'll do a recap video. Should be up in like 30 minutes or so. I'll jump on for the premiere for that. And yeah, go over the plays. I got more exposure to GME today. And some other stuff. Lost a little bit on futures. Small though. I'm a good loser, so I should be good at trading. Good at being a loser. See you, Jonathan. Thank you. Thank you, guys. All right, we'll see you soon. Peace out.